So a huge good morning to everyone who's joined us this morning. My name is Neil Hudson-Basing. I'm the Corporate Events Manager at London South Bank University. I'm absolutely delighted to be joined by Graham and Sarah on stage as we launch our 4th annual conference between LSBU and PQ Magazine. So on behalf of the Business School and PQ Magazine, delighted to have you here this morning. I'm going to start off with some housekeeping, if that's okay. And first off, I'd just like to kick off with a respect and dignity statement for webinars. So everyone speaking at or attending an LSBU event, whether in person or virtually, should be treated with respect, dignity and courtesy. LSBU operates an environment built on equality, inclusion and acceptance. We value contributions, feedback and comments and wish to create a space for sharing, learning, celebrating and bringing communities together. LSBU does not tolerate any form of bullying, abuse, harassment or discrimination. Inappropriate behaviour, including behaviour that potentially impacts or contradicts LSBU's reputations and values, and that of PQ Magazine, I'm sure, will be treated seriously and acted upon. Anyone exhibiting any of this behaviour will also be removed from the webinar. We want our events to be an enjoyable and warm experience for all. Thank you for adhering to these guidelines. And off the back of that, our events really have been a warm and enjoyable experience for all. We're really keen to break down that virtual wall that we're all facing at the moment, which we've just been speaking about. So please do use the chat box throughout the event to share your thoughts and comments. And it's lovely to see people making use of that already, telling us where you're joining us from in the country, in the world. One of the wonders of virtual events is we're opening up to a whole new audience that we might not have seen before. The next function along is the Q&A box, and I'd like to ask you to reserve your questions for the Q&A box so we don't lose them in the chat box. Each speaker has factored in Q&A time into their talk, and we'll try to get round to those. Just to let you know that with the Q&A box, you can upvote on the questions that you most want to see answered with using the thumbs up symbol. So if there's something you particularly want asked, give it a thumbs up and it will boost it to the top. The next function along is the raise your hand function, and we won't be using that during today's event. One thing I would like to say is just please bear in mind that because this is virtual, we do sometimes face tech issues, and please, we really appreciate your patience when those happen. They happen rarely, but they do happen, so thanks for bearing with us. We'd like you to share your thoughts about today's event and the discussion points that come up on our Twitter pages, and I'll share those handles in the chat box in a minute. At lunchtime between 12:45 and 1:15, we will be holding a breakaway networking session on Zoom Pro, and I'll share the link to that in the chat box shortly, as well as the meeting ID. You'll need to leave this event to join that, but you can log back in at any time using that original link. And I'll also be sharing links to the LSBU Business School Professional Lecture Series, which we've now just launched our 3rd installment of, given it's the demand for it back in 2020. Without further ado, I'd like to hand over to the Dean of LSBU's Business School, my wonderful colleague, Sarah Moore-Williams.
Thank you, Neil. Hello, good morning, everybody, and welcome to London South Bank University. It is my absolute pleasure to welcome you to this conference today that we love running in association with PQ Magazine. We formed a fabulous partnership, I think, with PQ, and it's an absolute pleasure to work with Graham every year on this conference. A little bit about the business school before we get going, just to give you some context. London South Bank University has been going for about 130 years now, nearly, based in Southwark at the Elephant and Castle, serving the local community to upskill them for work. That was its original mission, developing employability skills for the local community to ensure that they live a sustainable and the best life they possibly can, serving the community. And really our mission hasn't really changed that much since then, but obviously the skills that we deliver, the technology enhanced learning that we deliver obviously has significantly changed, but we're still based in the same district of Southwark. We still serve very much our local community as well as now a global community, and it's still, our education is all about upskilling local people to provide them with the local skills needed to function in business, in technology, and in particular at the moment in the NHS. So our mission hasn't really changed, and that goes to the very core of what we do. The business school's been going for nearly 50 years now, and again we take those values and we embed them in everything that we do. We run 4 core undergraduate programs. One of the biggest is obviously our accounting and finance program, which is accredited by ACCA, CIMA and ICAEW. And we have excellent links with the profession and with the accounting industry as a whole, in particular with PQ magazine. I myself am an accountant. I'm ACCM and FCCA person myself, and practiced accountancy for about 15 years within industry before going into academe. So the school is actually led by an accountant, and accounting is very much at the heart of what we do. But obviously, it's not, accounting's changed, okay? In the olden days, and certainly when I studied many, many years ago now, it was very much about the technical skills of accounting. It was about bookkeeping, processes, and keeping things in order. We still do that, and we still do that beautifully. But the skill set now needed for an accountant is much broader than ever before. We need to communicate the data. We need to help people to make informed decisions within their business. And these skills, this skill of communication, advising, informing and leading, and it helping people to lead on strategy, is even more important now than it ever has been before. We are, as we all know, in unprecedented times. There are going to be huge problems with the economy as we come out of this COVID time, and huge changes in the way that business is delivered, in the way that we deliver services, including things like this conference today, including education, including health. Many, many companies will go into liquidation, and people will need help with things like insolvency and with also business startup. And then the world of tax, I'm certain, is going to change. We are going to come out with a huge bill as a society, and we need to pay that bill for all of the infrastructure that's gone into COVID. So how is that going to happen? How is the government going to get their money to pay for everything that's happened and everything that's needed going forward? And again, it is accountants that are at the heart of everything that will be necessary to inform government policy and business policy going forward. So from where I'm sitting, I see a shifting world for accountants, one that's moving away from processing to one that is informing and strategizing. And I believe that our skills are more important now than ever before, and that we will be very, very influential in how we move out of COVID. And in addition, the support that we can give to the sustainability of the planet continues. So I think we're at a very exciting time. I think we are needed, and that this conference is needed as well. We need to come together as an academic community, as a professional community. We need to share information, brainstorm, and be creative in this space. And this is what this conference is all about. So I'm really, really, really excited to be hosting this conference with Graham. I hope you have a fabulous day. There is so much going on. I would like to thank the guest speakers now for their contributions. I know they're going to be fabulous. Thank you, Jill. Thank you, Prem. Thank you, Mervyn. Thank you now, and everybody else who is contributing towards today. And thank you to my team for sorting this out. I've got a marvellous team in Neil, in Sarah, and the accounting academics that have gone behind making today. So thank you now in advance. I know it's going to be fabulous. And thank you to you, the attendees. You're going to have a great day. Contribute, be curious, ask questions. Yeah, get the answers that you're looking for. Share ideas. That's what today's all about. So I'm going to stop talking now. I think I've spoken enough, and I'm going to hand over to my friend. I'm proud to call him my friend and colleague, Graham. Over to you, Graham. Thank you.
Thank you, Sarah, and a warm welcome, everyone. For those who don't know me, my name's Graham Hambly, and I am the editor of PQ magazine. I've been an accountancy journalist since 1984. And yes, I am that old, and the lockdown has not done this to me. I did it all to myself. I set up PQ magazine in about 2002, and it's the only independent magazine for part qualified accountants. We go to all the UK-based accountancy bodies, so that's ICB, AAT, CIMA, ACCA, CIPFA, ICAEW. We also make the magazine and the website available to university graduates and to academics as well. Just take a look at www.pqmagazine.com. We've got lots of great stuff. We've got study zones, test banks, videos. It's all there. And the magazine comes out each month and it's totally free. So it's a great resource for you. We call today's conference 2021 and Beyond, the new normal for accounting around the globe. It's our 4th with LSBU. Last year we tried to save the planet, but in truth, this one's late. We should have been seeing you all in November 2020, but unfortunately, something called the pandemic got in the way. So I'm sorry we're a little late, but I'm hoping that today will prove that the wait was worth it. Before we get to our first speaker, I just want to thank all our sponsors. They've been absolutely fantastic. I'm going to name them. So it's the AMLCC and FA Sims. There's the ACCA. There's CIMA, CIPFA, the ICAEW, ROGO, and of course Zero. We have to thank them for sharing our vision. They really wanted to get involved, and thank you for that. We have got an absolutely fantastic lineup today. It's the best we've ever had, to be honest. If you haven't heard Rob Whiteman after Tom, he's such a treat. He's got such a fantastic insight into the profession. We've got our current Accountancy Personality of the Year, Richard, just before lunch, and just after lunch, we've got my friend Lord Sikka. I knew him when he was just plain old Prem, but he's an absolute hoot. He will tell you sometimes the things you really don't want to know about the profession, but it's something I think he's a voice we always need to listen to. I always call him my Jiminy Cricket. He's someone who, it gives me a conscience sometimes, and I think that's really important. Do come and join me and Sarah, the head of the accounting department. That was Sarah, that's Dean. Me and Sarah will be there at lunchtime, ready for a chat. And also you'll hear me with all the panelists at 3:15. So I'm lucky for you, that's the next time you're going to see me. So first up today, and I can see he's just joined me on the screen, is Tom Scott. He's a board member of the International Accounting Standards Board. Tom has been a member of the IASB since April 2017. He joined, prior to that, he worked as an academic in the accounting field. Most recently, he was director and professor of accounting at the School of Accounting and Finance at the University of Waterloo, Canada. So we have gone global straight away, which is great. So Tom, I'm going to stop talking and hand over to you. Tom, the floor is yours.
Good morning. I want to just make sure my screen is being shared here. Apologies.
I can see your screen, Tom. It just needs to pop it into slideshow mode.
And my only problem is when I did this, my everything shrunk and I need to get it back. I apologize. If you have a suggestion, just.
If you just make it slideshow mode, if you go to
I apologize. All I'm seeing now is my thing and 4 names. I'm not seeing the larger screen. And what I don't quite know what I did to it.
If you go into
all right. So the first slide should say ISB update. And my name is Tom Scott. I'm a member of the International Accounting Standards Board, and I am pleased to be here to provide an ISB update. My comments are my own and would not necessarily reflect the views of the board. So I should have gone to a second slide. Is that correct, Neil?
Yep, you have.
Okay, good. So I'm going to cover our response to the COVID-19 crisis and then provide an update on our current work plan, highlighting the major consultations in process. I will briefly mention an IFRS Foundation Trustees consultation on sustainability and closed with our planned agenda consultation. So,
Tom, apparently if you click escape, it should come out of that. If you try that.
It's not doing anything.
No, okay, carry on as you are. It's fine.
Okay, apologies. So I'm now on the third slide. And there are three main takeaways related to IFRS and the COVID crisis. First, IFRS standards are performing well in the current environment. Second, stakeholders find it difficult to develop assumptions for their estimates due to the increased uncertainty. And third, we've moved quickly to take the targeted actions necessary to respond to the COVID crisis. Going now to our strategy for COVID. During the COVID crisis, we've been monitoring the application of IFRS standards and consulting regularly with our stakeholders to help us to identify challenges quickly. Our most common response has been to provide additional educational material. Where necessary, we have fast-tracked amendments to standards. We've also worked with stakeholders to facilitate their continued engagement in the standard setting process. Together with our stakeholders, we have promoted and supported the consistent application of IFRS standards across all jurisdictions. We have done this through continuous discussions with national standard setters, regulators, accounting firms, and others about local issues and planned actions. Observations on application challenges. There are two important observations. The first is that while some reporting challenges have arisen in this environment, in general, feedback has indicated that IFRS standards are working well in practice. They have been robust in dealing with these unusual circumstances. For example, stakeholders, including investors, have said the IFRS 9 expected credit loss model provides useful information. We're monitoring instances where local authorities have created exceptions to IFRS. The second is that the identified challenges have not arisen from a lack of clarity in the requirements of the relevant standards, but for the most part because of the heightened economic uncertainties attendant to the COVID crisis. The nature of the challenges varies among companies and jurisdictions depending on their specific facts and circumstances. For example, companies find it more challenging to estimate items in their financial statements and make assumptions about the future. A related article published on our website highlights the need for companies to have a robust process to ensure that they can provide transparent and relevant disclosures in these times. When necessary and appropriate, we've taken targeted action quickly. In particular, we have issued an amendment to IFRS 16, providing optional practical relief for lessees and accounting for some rent concessions occurring as a direct consequence of the pandemic. The relief allows lessees to elect not to assess whether some rent concessions are lease modifications, and instead to account for them as if they were not modifications. In addition, we have published educational materials to help companies apply requirements. For example, in IFRS 9, we explain the application of the expected credit loss model during these uncertain times. The material stresses the need for judgments and for estimates to be based on reasonable and supportable information. Before issuing the amendment to IFRS 16, the ISB had published educational material highlighting the relevant requirements in accounting for rent concessions. Engaging with stakeholders is an essential part of who we are. As a nonprofit organization that provides a set of global accounting standards, we earn the trust of our stakeholders through the quality of our standards and the transparency and completeness of our processes. In this regard, the board has continued to operate virtually and effectively throughout the crisis. We continue to advance projects, support implementation, and meet with our regular consultative groups. Thanks to the efforts of our technical support staff, we ran a successful virtual conference in September of 2020. We have improved both the content available on our website as well as the ability of our website to facilitate user access. A challenge during this crisis has been the management of timelines. We've advanced time-sensitive projects such as the amendments to IFRS 9 related to interest rate benchmark reform, extended the comment period on some published and forthcoming consultation documents, deferred the effective date of classification of liabilities as current or non-current, and bundled narrow scope amendments. We've continued to fulfill our role as a global standard setter while being sensitive to the needs and challenges of our stakeholders. I'm now going to move to the update on our current work plan. We have 4 exposure drafts highlighted in red, 4 other consultation documents highlighted in blue, an agenda consultation for our work plan for the next 5 years, ongoing work on dynamic risk management, and finally a consultation by the IFRS Foundation Board of Trustees on whether the IFRS Foundation should play a more significant role in sustainability reporting. I will now review a subset of these projects, plus some other planned projects in more detail. The general presentation and disclosures exposure draft is primarily about performance reporting. It responds to long-held investor requests for improvements. The main focus is the statement of profit or loss, although there are recommendations for the cash flow statement and the statement of financial position. The 3 main areas of improvement are requiring additional defined subtotals in the statement of profit or loss that should provide more relevant and comparable information, strengthening the requirements for disaggregation that should provide more relevant information, and 3, requiring disclosures in the notes about management performance measures that should enhance their quality and transparency. Let me look at each of these briefly. IFRS standards currently require only that companies present revenue and profit or loss in the income statement. While companies sometimes present subtotals, the information is neither consistent nor comparable. For example, many companies report an operating profit. However, companies do their own thing with significant variation. This makes it difficult for investors. Company statements often provide minimal disaggregation, especially in the statement of profit or loss. We will provide guidance to companies on how to group items, require companies to provide better analysis of their expenses, and to disclose unusual items. Our disaggregation requirement should lead to more line items that are more informative. Finally, while alternative performance measures have become ubiquitous, there are significant concerns over their quality and transparency. Most companies report additional performance numbers that are defined by a company's management. Such information can be useful to investors as it provides insight into how the company's management sees its business. To enhance the quality of these numbers, we plan to require that companies report on management performance measures in the notes to their financial statements. For each management performance measure, companies will explain why each measure is informative, identify and explain any changes in the measures over time, and reconcile each one to the nearest IFRS-defined measure. This information should be in a single note to the financial statements. This will not only make the information more transparent and easier to find, it will also bring the information into the scope of audit and thus increase reporting discipline. The second project is the review of the IFRS for SME standard. Many companies that are smaller and not publicly accountable use the IFRS for small and medium-sized enterprises standard. As well, the standard informs many jurisdictions that maintain their own requirements for non-publicly accountable companies. The standard is reviewed every few years. The results of the last review were published in 2015 to be effective for January 1, 2017. A great many stakeholders work in or with these companies, and these standards need to be responsive to the needs of the sector. Questions posed concern the strategy and general framework for the review, sections of the IFRS for SME standard that could be aligned with IFRS standards, and some new topics important to the sector. We are currently reviewing responses and will continue discussing with stakeholders. The next project features a discussion paper, Better Disclosures on Business Combinations and Goodwill and Impairment. This project was established following the post-implementation review of IFRS 3. The comment period has just closed. The project has two major goals. The first is to provide better information about acquisitions through enhanced disclosures. The primary improvement is to require information that helps investors better understand an acquisition and its subsequent performance, including management's objectives for the business combination, what metrics management will use to monitor whether those objectives are being achieved, and using the metrics to assess progress in achieving the objectives in subsequent periods. To keep these disclosures manageable, they are limited to acquisitions that are reviewed by the company's Chief Operating Decision Maker, or CODM. The discussion paper also proposes some additional new disclosures that apply to all material acquisitions, including one on expected synergies at the time of acquisition. The second major goal is to review the accounting for goodwill and assess its benefits and costs. Some argue that the current impairment-only model leads to impairments that are too little and too late. The board has concluded that it would be difficult to improve the effectiveness of the impairment test at a reasonable cost. Prompted by the concerns of some stakeholders, the discussion paper provides an opportunity to assess the question, should amortization be reintroduced? The board members' opinions are varied. However, the initial position in the discussion paper is to retain the impairment-only model. The board is looking for help from stakeholders to reach a conclusive answer to the debate over the merits of the impairment-only approach versus the amortized with impairment testing approach. The board thinks it can reduce the cost and complexity of the impairment test without harming the effectiveness. It proposes relief from the mandatory annual quantitative impairment test and a move to a trigger-based test. A company would only conduct the impairment test if there is an indicator that goodwill may be impaired. As well, costs can be reduced by removing the restriction on including cash flows from a future restructuring or an enhancement to an asset's performance, as well as by permitting the use of post-tax cash flows and discount rates. The board proposes to retain the requirement to identify and recognize indefinite-lived intangibles separately from goodwill. IFRS 3 does not apply to business combinations when both the acquiring company and the acquired company are controlled by a common parent. These cases are referred to as business combinations under common control. In some jurisdictions, this is a relatively common occurrence. There is a discussion paper out for comment. It proposes to use the acquisition method set out in IFRS 3 when there are external stakeholders of the acquiring company, but combine the companies on a book value basis in all other cases. IFRS due process requires post-implementation reviews once standards have been in place for at least 2 years. We're in the process of reviewing 3 related standards: IFRS 10 consolidated financial statements, IFRS 11 joint arrangements, and IFRS 12 disclosure of interests in other companies. In a post-implementation review, the board proactively seeks feedback to ensure that a standard is working well and as intended. This normally happens once for any major standard or major amendment to a standard. If the review suggests problems, then the board considers how best to address them. Sometimes this involves better educational materials, but sometimes the standard may need to be amended. The review document has just been published and we welcome feedback. Many jurisdictions have companies whose activities are governed by regulatory agreements that can create rights and obligations for the company. The current standard, IFRS 14, is essentially a placeholder that permits companies in some jurisdictions to use their previous non-IFRS GAAP for rate-regulated companies. The exposure draft provides a basis for recognizing regulatory assets and liabilities and regulatory income and expenses that is consistent with the conceptual framework. This should provide more useful information about the financial position and performance of rate-regulated companies. The next item is our disclosure initiative, targeted standards level review of disclosures. This is an effort to improve disclosures by producing principles for disclosure guidance and corresponding requirements. Present disclosure sections and standards often require compliance with a list of disclosure items. There is a significant concern that a myopic focus on this list can result in companies simply checking off items on the list and supplying information that is not material, while other information that would be material to investors is not disclosed. A primary change will be to provide in each standard an overall disclosure objective, along with specific disclosure objectives that capture user needs. The objectives will be supplemented by specific items that may be helpful in meeting the objectives and that previously might have formed a required disclosure checklist. We think that this initiative will prompt companies to take a more thoughtful approach to developing disclosures that emphasize material information, while limiting the disclosure of immaterial information. We will test this approach on IAS 19 pensions and IFRS 13 fair value. We hope to refine our process for setting disclosure requirements while improving disclosures in these standards. An exposure draft should be published in the second quarter of the year. The IASB plans to publish an exposure draft to update its practice statement on management commentary. The management commentary will continue to focus on the needs of investors and creditors. There are 3 reasons for doing this at this time. First, narrative reporting has evolved since 2010 when the management commentary practice statement was initially published. In the interim, other frameworks and new ideas have developed. We plan to consolidate innovations from several frameworks and from integrated reporting. Second, there are gaps in reporting practice that need to be addressed. Concerns include a short-term focus with insufficient information on drivers of long-term prospects, a lack of precision in focus, reports touch on the right topics but do not provide sufficient useful information, and a fragmented focus. Important parts of the story are often omitted. Finally, investor and creditor information needs are changing. Information on intangible resources, relationships, and sustainability is growing in importance. We have set a clear objective for management commentary that is supported by a set of essential principles. The practice statement will be built around disclosure objectives that meet user needs. We identify 6 key areas of content to be included in a management commentary and provide objectives and guidance for each. These are a company's business model, its strategy, its resources and relationships, the external environment, the risk to which a company is exposed, and its performance and position. The exposure draft will be released in the second quarter of 2021. Another disclosure initiative relates to subsidiaries that are SMEs. This project focuses on creating a new disclosure standard within IFRS standards to provide a better benefit cost trade-off for subsidiaries that qualify as SMEs, that's small and medium-sized enterprises, but that need to follow IFRS recognition and measurement standards to facilitate consolidation at a higher level. The proposed standard will allow qualifying subsidiaries to employ IFRS standards recognition and measurement principles while providing a set of disclosures based on the IFRS for SMEs standard. There will be modifications to the IFRS for SMEs disclosures where differences between the IFRS and the IFRS for SMEs recognition and measurement principles warrant additional disclosure. An exposure draft will be published later this year. The board has some additional smaller projects as well as some larger projects that are in process. The latter include dynamic risk management, financial instruments with characteristics of equity, provisions, equity method accounting, pension benefits that depend on asset returns, extractive industries, and a post-implementation review of IFRS 9 financial instruments. I would be remiss if I did not mention a potentially important project for the IFRS Foundation on a topic with significant public profile, sustainability reporting. The IFRS Foundation's trustees normally monitor the board and make sure that the board is operating properly, but in this case, they have published and are currently reviewing feedback on a consultation paper. The document inquires as to whether the foundation should be more strongly involved in responding to the demand for global sustainability reporting standards, including on environmental issues. The trustees are assessing whether and how the foundation can play a constructive role on this important topic. Finally, we have a 5-year agenda consultation coming in the first half of this year. We'll be seeking advice on our strategic direction and work plan. This includes consulting on the criteria for selecting projects, as well as the actual selection of projects. Please watch for the agenda consultation and participate in identifying and selecting projects. I would like to finish by encouraging everyone to engage in our consultations and provide us with feedback. Thank you for the opportunity to share our plans with you. I now look forward to any questions that you may have.
Thank you so much, Tom, for that. We've got a few questions, if that's okay, and we've got a few minutes to answer them. Sarah asks, how can the standards that you've spoken about be better enforced to enhance disclosure?
So, just a tiny background. I mentioned we're a nonprofit. Oh, my screen is back. I can see bigger. We're a not-for-profit organization, and it's kind of a miracle. I joined in 2017, so no credit to me, but the IFRS Foundation was formed in 2001, and it's a not-for-profit. We weren't given any mandate by the UN or any government to set accounting standards. And so all of our standards and everything we do has to be adopted by the various jurisdictions. Different jurisdictions adopt in different ways. But we don't actually have any ability to compel anyone to do anything. So that, in answer to the question, I say that because fundamentally, whichever regulators are in charge of enforcing accounting standards and choose to adopt IFRS, they would be in charge with enforcement. So what we can do is we can write clear standards, make sure that we have really good implementation support. I should mention our interpretations committee where people write in with problems, and that can help. We clarify things, we write agenda decisions. So at that point, as long as we've done it clearly and we make clear what is required in disclosure, then the regulators have to actually do the enforcement.
Thank you. We have quite a few questions, but we've only got time for one more. So I'll come to Johnny's question. How would the IFRS's work on sustainability reporting interact with the already comprehensive GRI standards?
We actually, among the many groups urging us to consider this, are many of the groups have been involved creating sustainability reporting. And I think the fact that we're a global not-for-profit, the fact that we have a reputation for quality of standards and also for excellent governance and good processes, a lot of these organizations see the IFRS Foundation as sort of a place that can act as a nexus to coalesce all these groups. Because I think almost every group wants successful sustainability standards, and to really get there we need to coalesce. And so I think that's the reason that we've gotten involved, and we're exploring whether we can actually, I think, fulfill that function of coalescing. So we would expect to work very closely with almost all the other groups, and at least if we do enter, that would be our goal.
Thank you. And final question, and it will have to be a quick fire one. Do you think we as accountants can add to the sustainability agenda?
Yeah, because there's so many questions of just how do you do it? If you think about accounting, it's a very normative thing at the practical level in the sense that we have a problem, and to solve a problem, one typically needs you need some kind of idea of how you'd approach it, but to really figure out what would be the best approach, you need lots of information and to test it. And so accountants are all about providing useful information for solving problems. And this is clearly a significant global problem. And I think we have, as accountants, many skills that we can bring to helping fulfill the society's aspirations there. Obviously, it's a neat area because you get to participate with many other groups, engineers and others. But I think we do have some clear comparative advantages in developing and providing information and channeling it, and also just how to use the information in useful decision models.
Tom, thank you so much for joining us this morning and for sharing your experience and knowledge with us. It's great to see you. And someone's just pointed out, accountants will save the planet. That was actually the title of our last event with PQ magazine. So thank you very much, Tom.
Okay, thank you to everyone for listening. I hope you have a wonderful conference.
Thank you. I hope you can stick around with us. I would like to invite Rob to join us. Rob's talk is entitled, How Have Public Sector and Its Accountants Risen to the Challenges? Rob is the CEO of the Chartered Institute of Public Finance and Accountancy. Rob, would you like to join us? Hi there.
Good morning. How are you?
Good. How are you doing?
Very well. You can hear me okay, I hope.
We can hear you perfectly, and I'm going to hand over to you now.
All right. Well, good morning, everyone. It's very nice to see you all. I hope you're all having a good day. I'm Rob Whiteman, Chief Executive of CIPFA, and I'm going to talk for 25 minutes about the profession in the public sector and the challenges facing the public sector at the moment. Before I do that, the obvious thing to say for an old lag like me, who's probably heading for retirement now, is that for those of you who are partly qualified or studying or newly qualified, you really can have a great career in the profession, and you know, the profession is absolutely at the heart of the public sector. We talk about the public sector, but you know, don't forget its scale. It is over a third of the economy. It's the single biggest industry in the economy. The National Health Service, for example, we'll think of it at the moment in terms of the incredible work it's doing. It is one of the biggest organisations in the world, along with the Indian State Railway or the Chinese Red Army or Walmart. The NHS is one of the biggest organisations in the world. So there is incredible breadth in the public sector, from central government to the NHS to local government to the voluntary sector and charities and people that operate in and around the public sector. It really does matter. There is an enormous sense of reward and value from working in the public sector. And you know, just let me encourage you all in your studies and in your careers. If you ever find yourself coming into the public sector, don't hesitate to contact me or CIPFA if we can be of any help to you. I pride myself on being the world's most informal geezer. So yeah, do always feel free to drop me a line on LinkedIn. And you know, to some extent, perhaps it gets forgotten that a lot of accounting practice and control and things that are now taken for granted throughout the economy originated in the public sector. I was talking to one of my CIPFA council members yesterday, the Chamberlain of London, the Director of Finance of the City of London, who reminded me that he is the 80th post holder of that role, which dates back to 1377. And so there's a very, very long tradition of control and accounting in public bodies. And you know, do feel free to make contact with me. Huge challenges, of course, facing the public sector at the moment, with lots of uncertainties about what happens next. But I hope everyone would feel that the public sector is very good at dealing with a crisis. The way that not only things like the vaccination program is being rolled out, but the fact that vital services have continued, and lots of frontline workers, from people collecting your bins through to children's social workers, through to people in classrooms and schools. People are trying to keep services provided, often virtually, and public bodies did a remarkable job where they could in switching to virtual provision. And I'll say a bit more about that at the moment. Of course, for a lot of public bodies, that's happened at a time when their income has dwindled a great deal. Of course, public services are funded by taxation, but during a crisis, the level of taxation paid dips. Obviously, sadly, lots of people are furloughed or have lost their jobs, or businesses have closed, and so tax yield has fallen. And one of the ironies of the public sector is that usually just when you're most needed and the demand for services goes up, then the amount of income coming through the door goes down, because that's the nature of cycles, and the public sector is often most needed at the downturn in a cycle. More benefits need to be paid out, more services need to be provided, but actually that's at a time when tax yield falls. And of course, if you think about everything from things that are closed and not collecting income, from leisure centres to libraries to car parks, actually many public services have seen their income nigh on collapse, often by as much as 50%, at a time that they see the demand for new services. All of a sudden, local authorities, for example, had to invent shielding programs and getting food and shopping to people who needed to shield, and so services needed to be invented at a time when income has collapsed, and that's led to huge funding gaps. And CIPFA is in a way an unusual accounting institute. We do train and qualify accountants, but we are also a standard setter for local public services, and we set accounting standards and we issue guidance. And so we did work with the government, and we've issued guidance about how to deal with the funding gap at the moment. If any of you work in local authorities, you'll know it's illegal not to have a balanced budget. And if you do have a position of not having a balanced budget, a local authority has to freeze all expenditure. Well, you can't freeze expenditure during a pandemic, just at a time when you're having to shield the public. So CIPFA worked with government, and we issued some temporary guidance in order to change the rules of financial management during the pandemic, in order to deal with this very large funding gap. But the time will come when it's going to have to be paid for. Public expenditure as a proportion of GDP has gone through the ceiling. The amount of debt that we have is now at its highest level for over 50 years. So government borrowing as a proportion of the economy is at the highest level since the early 1960s. In the early 1960s, it was paying off the debt from the Second World War, and that's when it dropped, when it was finally paid off. And so we see unprecedented debt levels that at some point will need to be paid off. And that's difficult, isn't it? Because public bodies and government are having to grapple with when will be the right time to raise taxes. The government, for example, has given local authorities the ability to raise council tax, the tax that you pay on your homes, by 5%. But that's not only politically difficult for those local authorities, it's much needed revenue that will balance the books. But of course, can you easily put taxes up at a time when families and communities are struggling and don't have resources? So when this is over, there are going to have to be some very difficult decisions made about what will the state be able to afford and not afford? How will we pay off this mountain of debt that has built up over the last year? Taxes will have to rise, and probably services will need to be cut as well. And that's all going to be incredibly difficult, because on the whole, before COVID came along, there are long-term pressures that push public spending up. We're getting older as a society. More people need social care. People live with chronic conditions for longer at the end of their life. So all developed economies see the costs of service provision going up because of the changing demographic that people are living longer. But how's that going to be funded, where governments try to avoid, obviously, putting up taxes if they can, but if they do decide to put up taxes, actually the timing of that, not to stall the economy and stop the green shoots of economic recovery. These are very difficult issues to deal with, and obviously it's something that the finance team at the Treasury and the Chancellor are very much looking at. All that said, one of the lessons that we'll have to think about after this is all over, what will be, were public services running on hot? Were they too stretched and didn't have enough resources to deal with an emergency? Because clearly when this pandemic came along, we didn't quite have the capacity to deal with it. We didn't have PPE. We didn't have ICU, emergency care beds. We have fewer ICU beds per capita than any country in Europe. So very often the public sector runs on what we call hot. It's running in crisis mode all the time because it doesn't quite have the resources that it needs. And actually, for people who work in the public sector, you'll know that the public sector is constantly thinking about its efficiency and how does it get greater productivity and how does it manage to reprioritize resources. So it's very common in the public sector that we're sort of running on the knife edge all the time. Did we go too far in the decade before this crisis came along? Did austerity mean that the public sector just didn't have enough fuel in the tank to deal with the early stages of the pandemic? It is expensive to stockpile PPE. It is expensive to have large-scale test and trace arrangements in place that might not be needed. It is expensive to have more ICU and emergency bed provision than you require at that present time. But actually, does a well-functioning state have to have those things on standby in case an emergency comes along? This may not be the last health pandemic that we deal with in the coming decades. And so I think when all of this is over, how does the public sector have a bit more firepower in the tank in order that it can deal with the early stages of emergencies is going to be a very difficult issue to grapple with, because of course the government and public services have lots of other priorities to deal with coming out of this pandemic, not least affordable housing and homelessness, for example, or incentive schemes to reprioritize the economy towards sustainable forms of energy and business. So, you know, in terms of these opening comments, I hope I've painted for you, you know, the public sector has responded very well to this enormous crisis, even though it came into the crisis having concerns about its ability to deal with the crisis because it had faced so many cuts in the decade before the crisis. And finance is absolutely at the heart of this going on. I'm on my fourth chief executive job now as chief executive of CIPFA, but before that I held 3 senior positions for large public sector bodies, and as a non-exec director, I chair a PLC, an investment fund in the city, and I also chair some local charities here where I live, involved in helping children from disadvantaged backgrounds. That's a very sort of public sector career. You can have lots of accountants become chief executives in the public sector. Accountancy and the profession really matters. CIPFA, the body that I lead, because we operate in the public sector, I'm told by people from the international umbrella body for the accountancy profession that we have more chief executives per head than any accountancy body in the world. I think that's because we operate in the public sector, and so many people in the profession in the public sector go through to chief executive roles. And finance is absolutely at the heart of grappling with these issues about where have we been, where are we now, and where are we going. So the public sector has grappled with the crisis, and it's dealt with innovation and resolve. Think of things like the decision to not give people their second vaccination within 3 weeks, but to put it to 12 weeks in order to vaccinate more people immediately, which is why the UK is ahead in the comparative league table. Whilst that would have been dealt with by epidemiologists in Public Health England, the finance team were side by side with them, modelling the cost and the rollout and what that would mean in terms of logistics. So yeah, just a nice little example of all these big policy decisions that government have to make. Finance is always at the right arm of decision makers, be they ministers or chief executives. And one of the other things, of course, that have to be grappled with is centralised versus localised approaches. What's the best way to mass vaccinate? Do you build big centres through a centralised national approach, or do you deal with existing local community infrastructure such as pharmacies that give the flu jabs every year? Of course, the answer is you do both, and service provision and distribution of resources is both a centralised national activity as well as a localised and devolved activity. And again, that's one of the joys of the profession in the public sector, that one works these things through in order to provide options for decision makers. Clearly, we're all a bit worried about the economy, the other side of this crisis. If after Easter we do begin to see the easing of restrictions in the domestic economy, local authorities, for example, have paid out £11 billion with emergency resources provided by government to businesses in order to try and keep them afloat through an emergency grant scheme. CIPFA and the profession through CIPFA was very involved in designing that with government at breakneck speed. But to what extent will that work, and to what extent will there be good businesses that can bounce back, supported by a bit of help from public money? To what extent, sadly, have those businesses gone down? We don't quite know the answer to yet, and we'll see that emerging in the coming months. Couple of comments, and then I'll break for some questions if there are any. Innovation is absolutely key to future service provision. Obviously, we are in a digital environment. One of the reasons that the mass vaccination program is working so well is that the booking system for that, again, designed at breakneck speed, means that, of course, some people are being phoned up and some people are getting their bookings in a traditional way if they don't have access to the internet. But on the whole, the majority of bookings are happening through an app in order to reduce the need for call centres or other face-to-face inquiries. Digital investment is absolutely key. And that has to be done in a very sort of careful way, because of course there are also huge cyber risks. We know that state institutions, public services are sadly particularly under attack from Russian state hackers and God knows who else. And so is doing this. We have had hospitals brought to their knees in the year before COVID happened by ransomware attacks, where they were sort of, had to pay over a lot of money, or they couldn't function. You'll be pleased to know as taxpayers that they weren't paid off. But the public sector is often at the very forefront of dealing with the need for digital services at speed, but doing so in a way that deals with the cyber issues that confront us. I wanted to say a few words then about the future. We often think about the specialisms in the profession. People work in audit, people work as management accountants, people work in assurance or internal audit or control, people work in the public sector. I think there's probably a new branch of the profession that will develop around sustainability. Clearly the movement in standards globally will be to non-financial information. How do entities monitor and report their effect on not only the environment, but also other measures of social value? That plays itself very much to the public sector. I guess I'd say we've been doing that for years, because no decision in the public sector can be made purely on a financial appraisal. We don't really operate for profit. We operate in order to use public resources to have the maximum utility. And so decisions are based on cost-benefit analysis of, if we spend this money, what effect will it have on service volumes, the economy, people's health and happiness. And so in a way, I think that a lot of the good practice that's in the public sector around accounting for things other than financial return actually comes to the forefront in the profession. And I think that that's a really good thing. And I do think we'll have sustainability or social value accountants as much as we have management accountants or auditors, etc. I think that will become a huge branch of what we do in the years ahead. All different parts of the economy need different skills, and being an accountant in the public sector is often the same as being an accountant in the corporate sector or in companies, but there are differences. I mean, on the whole, we worry a bit less about tax. We public bodies usually don't pay tax, so they can pay VAT and other things. But if you study CIPFA, or if you study with another accountancy body and come into the public sector, a bit less focus on tax, which is, but on the other hand, a lot more focus on cost-benefit analysis and measuring for social value. And something else about the public sector is that people need to have fairly advanced soft skills. We are a profession that often operates in public. We have to meet the community. We have to attend committee meetings. We're called to scrutiny, to be scrutinised by Parliament. And so the soft skills of being able to explain things in plain English are very important, and influencing skills are also very important. So, you know, I don't want to make big differences between the economy and the sectors. I think accountancy is accountancy is accountancy. But where I would say for some people, well, you know, if you're going to work in a particular industry, you need to be a really good management accountant, or you need to have really good audit skills, or you need to have a particular background. For the public sector, certainly these things around accounting for social value are important, but also soft skills. Finally, of course, I'd say public sector ethos is really important. I've loved my career. I've been privileged to have my career. I've held 4 chief executive positions, and I wouldn't have achieved that without being an accountant. Without my it's been the bedrock of my career, because it's given me a way to think and a way to approach strategy that has helped me run some very large organizations. Before CIPFA, I was responsible for border security and immigration with some 30,000 staff and a £2 billion budget, and people in 120 countries. And being an accountant is absolutely the bedrock of my management career, and it's a privilege, folks. And I really sort of encourage you all to think about the public sector. But public sector ethos matters a lot. I probably consider myself more a public servant than an accountant, and probably most people in the public service do. You're never going to be a millionaire. We don't do it purely for the money. We do it because you can have a good career and you can earn a reasonable salary, and you do get reasonable pension schemes in the public sector. But we really, you see people in the public sector because they are very, very, very motivated by adding value to their community and to society. And if that rocks your boat, you're always very welcome to think about a career in the public sector. Thank you very much.
Rob, thank you so much. What a fantastic note to end your talk on. We have questions. We've got a few minutes. We're actually going to, I think, because we've got a few questions, we're going to eat into the break a little bit. So we'll give ourselves a bit more space.
Okay. Well, I've got my coffee ready to. So go on.
Perfect. So, a question from Alice first. Will the crisis help or hinder the repeated efforts to address the issue of adult social care funding in the UK?
That's a great question, Alice. I think in the short term it will hinder it, because for what I said while talking to you, pressures are going up and funding is uncertain. Adult social care sits in local government, and local government is essentially funded by business rates and council tax, and business rates and council tax are being less collected because of where we are. It is recognised that we need a long-term funding solution for adult social care. Do we have an insurance scheme, for example? We have to insure ourselves for our contents of our home, or we have to insure our car. Will we have to insure ourselves for old age in order to pay for social care? Or will social care be paid by a new dedicated tax, rather like national insurance? Should we have a prepare for old age tax? Or is it paid for out of general taxation, but we just have to accept that general taxation will have to come up? Government's been looking at that for the last 5 or 6 years. There's a review taking place in Downing Street and the Department of Health happening at the moment, Alice. I think we'll get a solution to that within 2 or 3 years, because we're now at breaking point. In the meantime, for the next 6 months, things will get worse because the funding model is broken. And I think that will force the hand of government that sometimes government has to, move the deck chairs and introduce a new big bit of kit. And adult social care is top of the list of things that needs fundamental reform in terms of how it's paid for. It's a great question. Thank you, Alice.
Thank you. Our next question. Do you think the 17 billion of government contracts to private companies without a competitive tender for PPE, etc., will be investigated? Will there be repercussions?
Yeah, there will be. I mean, one of the problems, of course, with acting in an emergency is that you push money out the door and you know that it's more subject to fraud. One of the reasons that we have such strong procurement rules in the public sector and such strong controls, and things have to go through competitive tender, and we have to do due diligence, and you check that companies are able to meet your contracts. People making decisions have to declare if they have any conflicts of interest in order that they're in no way involved in these decisions. We award public money based on factors of probity. I'm afraid all that goes out the window in an emergency, and there are two lessons from that. Number one, don't get yourself in the position that you're in such a crisis. We should have had more PPE. We shouldn't have needed to buy so much in advance. The public is just going to have to accept that we pay a bit more tax in order that public services are ready to deal with an emergency. We don't run them down to the bone in order that we then have to deal with everything in a crisis. Lesson number two will be, there will be an investigation into all the money that's gone out the door, and I think people will get prosecuted, and I think people will go to prison. I mean, there has been fraud, and I think we shouldn't brush that under the carpet. It's always difficult, this. I think if you discover fraud, it's a public good. You're saying to the public, we have found out that we got done over, and you're putting other people off doing it. Of course, you do get bad publicity and bad press, and people say, what are those public services doing, getting defrauded? My personal view is we prosecute everybody to the nth degree, and we publicise it, and we admit that we've been defrauded as public bodies, but we demonstrate we're gonna put it right.
Thank you. Next question is a bit of a long one from Johnny. Should the government not view the public sector as much needed infrastructure and an effective injection in the economy? When going into recession as we're doing, the government should stimulate things, as per Keynes. There may be worries about national debt, but some economists think we should have more freedom to create money to fund these things without a detrimental effect on inflation. Former NHS accountant here, now in academia.
No, great, bloody good question, Johnny. So Gladstone's golden rule, of course, was that over the lifetime of an economic cycle, you only borrow to invest in railways, infrastructure, hospitals. Over the lifetime of a cycle, you don't borrow to provide day-to-day services. Day-to-day services are funded by the taxes we pay on a day-to-day basis. During a time of a recession, you may have to borrow to fund services, to pay benefits, etc. But over the lifetime of a cycle, you should only be borrowing to fund in infrastructure. I still think that's essentially right, in that if we borrow to fund services only or too much, we are in effect passing the bill to the next generation to pay. And future generations will have less service because more of their taxes will have to go towards paying off the debt rather than providing day-to-day services. And of course, interest rates are at a 300-year low. So although the government has got a huge mountain of debt, there is an argument that now is the time to borrow, because actually the amount of money that government is spending on servicing its debt is relatively light in terms of the last decade or two. So I think when the crisis ends and we're no longer paying out in an emergency, the government will invest in infrastructure. It will want to pump prime the economy by more HS2s, more investment in infrastructure, housing. We have a housing crisis in many parts of the economy. And I think the government will do that. And politics has changed a little bit, hasn't it? Without getting all political, alternative right populism that we see through Trump or Johnson is a mixture of the right and left. It's not traditional conservatism that wants to make the state as small as possible. Actually, it's sort of on the right of politics, on nationalism and issues like immigration, but it can be on the left of politics in terms of spending public money in the way that left of centre has traditionally done. So at the moment, traditional politics is all a bit up in the air, and you see Conservatives proposing to spend more money than Jeremy Corbyn was going to spend. Work that one out. So I think at the moment, both the main parties are spending parties. We're not going to see a return instantly to austerity. As an accountant, I would say that extra spending has to be on infrastructure and investment and pump priming the economy. We do actually have to balance the books on day-to-day services. Otherwise, we're just leading to a bigger mountain of debt for future generations to pay off. And intergenerational inequity is a big issue. You know, at the whole, you know, just to sort of give you something to think about, folks, when old age pensions were introduced a century ago, old people tended to be amongst the poorest in the population. Therefore, as taxpayers, we funded their pensions 100 years ago in order that people could live with dignity in old age. 100 years later, pensioners are often wealthier than other parts of the economy. Younger people are paying taxes even though they've got less money than the pensioners that they're paying. Now that these issues of intergenerational inequality are going to be a big factor of rebalancing the books. My personal view is, if you've got the money, you know, you shouldn't get a winter fuel allowance if you're a millionaire. And I think state pensions have got to be means tested, and we've got to cut down the amount of money that we spend on general universal provision for retirement benefits. That goes down like a bucket of sick, doesn't it? And if you think about when Theresa May lost her general election, it was because during that election campaign, she said she was going to reinvent how social care was paid for, and it was so unpopular, she went from being way ahead in the polls to nearly losing the election. So the politics of this stuff is enormous, but it's a great question, and I hope I've given you a straight answer that yes, now is a time to borrow because interest rates are cheap. Now is a time to invest. But at the end of the day, you can't borrow money to spend on day-to-day revenue services. We're going to have to balance the books, and we're going to have to make some difficult decisions, and taxes will have to go up.
Thank you. And we've got time for one more quick fire question, just so that people can grab a quick break. Roberta asks, how do you start looking at moving from the private to the public sector?
That's a great question. I guess the first thing to say is, you know, what really interests you. You know, sometimes people, I moved out of retail. I worked for WH Smith, and I moved into local government, and I'd always been really interested in, you know, my local community, and it really sort of, you know, I really wanted to work for a local council. People are very motivated about local government or working for the NHS. Actually, central government can be an enormous career. You can make decisions on, do we build battleships, you know, or do we build a new railway system? If you are interested, I suppose it depends, Roberta, on where you are in your career at the moment, what skills you've got, what sort of roles you can apply for. If you want to drop me an email, rob.whiteman@cipfa.org, or contact me on LinkedIn. I'll always link you up with somebody to talk about if you're interested in joining the public sector, and give you some tips.
Fantastic. Rob, thank you so much. Great to hear from you. Thank you for all your questions. Keep them coming in throughout the day. And Rob, I hope you can stick around for a while.
Okay, cheers everyone.
Thanks so much. We are going to go for a short break now, a quick comfort break before we're back at 10:45. We are going to be joined by Jill Atkins and Mervyn King. So grab a quick break and we'll see you shortly. Thank you. Welcome back from your break, everyone. I'm delighted to be joined by Professor Jill Atkins and Professor Mervyn King for our next session. The session is entitled Corporate Governance. Jill, are you starting us off?
No, Mervyn's going to speak first. I think Mervyn's going to talk for most of the time, the lion's share, I would say, and then I'm going to just talk a little bit at the end.
Fantastic. So for our audience, listen in. If you have any questions, please feel free to pop them in the Q&A box, and I'll be helping to kind of like get those to Jill and Mervyn shortly. Mervyn, we'll hand over to you to start with.
Thank you very much. I did prepare a slide presentation, which Neil has got, and I've asked him to send copies to all the delegates for their personal use. I decided just to talk about it because the slides would have taken too long and I would have eaten into Jill's time, which I didn't want to do. We're going to talk about corporate reporting. Of course, it's part of governance. But I want to take you back to the 17th and 18th century when there were unincorporated entities and with unlimited liability. And wealthy families gave risk capital to start businesses, but on bankruptcy, they were still liable to the creditors and the employees. They started balking against this, and the government of the day in the UK and in Massachusetts in America started debating, well, why don't we, as the government, create an artificial person and give it limited liability so that these wealthy families could subscribe for shares, equity, in these new artificial companies, but have limited liability in order to continue the raising of capital and the creation of jobs. And that's exactly what happened. And so you will see that the government, as the representative of the people, created the limited liability company. And we often today hear people saying society is the licensor of the company. Well, in fact, society was the creator of the limited liability company. And it is the medium through which most businesses today are conducted. But what happened because of the governance architecture is that these wealthy families, as the original subscribers of this company's equity, appointed the directors and mostly appointed members of the family as the directors. So having given the equity capital to start the business, the working capital, and being directors, they were seen by other stakeholders as the owners of the company. And they were the primary stakeholders. And this went right through the 18th to the 19th century and into the 20th century. And there were two events which reinforced this during the 20th century. The one was the famous Ford Motor Company case in 1919, when the Ford Motor Company had made excessive profits in those days, $65 million. And Henry Ford, the chairman, announced that it was going to be used to improve the plant of the motor company and also to increase the wages of employees to encourage them to work longer hours to meet the demand for the company's product, the Model T Ford. The Dodge brothers, who were then a minority shareholder and later became a competitor, complained and said, you cannot do this. We, the shareholder, are the primary stakeholder, and you should look after your primary stakeholder before the other stakeholders, and you should declare that excessive profit as a special dividend before you start increasing wages, etc. And Henry Ford, I always say he was the pioneer of responsible capitalism, unwittingly, refused, and the Dodge brothers went to court, and the court declared in their favor that a special dividend should be declared to shareholders. And so the primacy of the shareholder really took hold, and it went right through the 20th century and was reinforced again, in my judgment, by Milton Friedman, when he came out with his treatise, which won him a laureate prize, that the business of business is business. The sole purpose of the company is to make profit. Notwithstanding that the profit of most companies during the 20th century had been and were subsidized by society and the environment. And this was established through expedited research because the third industrial revolution, the computer age of between the 60s and the 80s. And it was shown by the analytics firm Ocean Terma in looking at the S&P 500, where iconic companies are listed, and they've brought it up to date in the last 3 months of 2020. It showed that by the 1980s, looking into the 1990s, that there was a realization that in the main companies, to the lesser extent we as individuals, were using natural assets faster than nature was regenerating them, clearly not a sustainable matter. And so that the model of focusing the board as individuals and as a collective, focusing on increasing the wealth of shareholders in the belief that this wealth would trickle down to the impoverished at the bottom, was fallacious. In fact, the trickle, as I always say, became treacle, and it stuck at the top, and eventually, in my view, exploded with the GFC. But by 1995, this was realized because of this expedited research. And by 1997, the Ocean Terma investigation showed that only about 20% of the market cap of iconic companies listed on the S&P 500 were shown as additives in a balance sheet according to US GAAP, or even if you applied the IFRS standards. And so this turned into the 21st century. And in the 21st century, in the first decade, several events happened which changed the thinking and, in my view, started changing the accountancy profession. I'm not an accountant. I'm a barrister, QC, former judge of the High Court. But I have been in business. I've chaired companies listed on the London Stock Exchange, European exchanges, and Southern African exchanges. So I'm in the very privileged position of having a huge academic background of corporate law, accounting principles, and being a practitioner. And it was for these reasons that I think I was asked to form a committee in South Africa to set down guidelines for the majority of my fellow citizens who had not been in the mainstream of the economy because of the apartheid legislation, as to how to direct and how to manage. And I was encouraged to do so by Mr. Mandela, whom I knew before he went into jail. And while he was in jail, I chaired an organization called Operation Hunger with his daughters. And so when he came out of jail, he and I often discussed certain issues. And it was the particular circumstances of South Africa that drove me to drive the committee to come out with a model in 1994, which assumed my name as the King Report, as the chairman. That was novel in the sense that what we said was the board as a collective should take account of the needs, interests, and expectations of its stakeholder groupings pertinent to the business of the company, but always make a decision in the long-term interests of the company. Now, that would result in trade-offs between the interests of the stakeholders. And that's why I have some trouble with this nomenclature of stakeholder capitalism coming out of the World Economic Forum. And the statement by the Roundtable in America in August of I think August 2019 it was, that we should stop focusing on the primacy of the shareholder and look at the interests of all stakeholders. And they then changed the primacy of the shareholder and called it shareholder capitalism, and called looking at the interests of all stakeholders stakeholder capitalism. Well, the era of corporate leaders in the 20th century, leading to a century of unsustainable development, was this focus on the primacy of the shareholder. So if we, the directors of the 21st century, had to focus on the interests of stakeholders and not focus on the long-term health of the company, well, I'm afraid companies would go bankrupt. So you take account of the needs, interests, and expectations, and I believe now hardships because of the pandemic and the impact on the economy. And so the GRI was formed. I was chairman of the United Nations on Governance and Oversight. and became chairman of the Global Reporting Initiative. The Global Reporting Initiative, so I know from its founding days, was focused and looked at things through a civil society lens. We asked the question, what are the impacts of the activities of a company and its product or service on the three critical dimensions for sustainable development: the economy, society, and the environment, and developed guidelines, now standards, the GRI. But with that focus, I wouldn't say we overlooked, but we were aware, but more in the byways of our minds rather than the highways of our minds. But it became to the highways of our minds 9 years ago when Sustainability Accountancy Standards Board was formed by Gene Rogers. And they started asking the question, will these three critical dimensions for sustainable development, meaning to make sure the impacts were such that those who came after us could also carry on in a sustainable manner, developing. Weren't they, the economy, society, and the environment, prosperity, people, and planet, having an impact on companies, on a company's financial condition, in accounting terms, its balance sheet, on a company's operating performance, in accounting language, its income statement and its cash flows, and on its risk profile, in accounting language, its market cap and its cost of capital? And the answer was in the affirmative. And so sustainability started being looked at in the last 5 years, at least, as something that had two sides to this coin. The one were the impacts on the three critical dimensions for sustainable development. The other were the impacts which the economy, an event like the collapse of Lehman Brothers, had on companies' balance sheets, operating performance, risk profile, and society, health and safety, coronavirus has on a company, and environment, climate change, has on a company. And the answer is clearly in the affirmative. Whilst all this was happening, the makeup of the market cap of companies was showing that the greater proportion of it were these, what became known as the ESG issues, environmental, social, and governance, the quality of governance, how people dealt with social issues and how people dealt with environmental issues, companies. And this ESG space became more and more important. So much so, IFAC called a meeting at the United Nations, which I helped organize, and we met. And it was under Chatham House rules, but now a matter of public knowledge, where the president and then chief executive of IFAC said, we have to concede, because at that time, it was about 2004, 5, I think. At that time, the research was showing that about 80% of the makeup of listed companies was made up of what was known as the non-financial aspects, an unfortunate term because they all have financial outcomes. And there were not additives in a balance sheet according to IFRS. And so IFAC said to issue an annual report made up only of the financial statements, duly audited according to ISA's International Standards of Auditing, does not mean that the board has discharged its duty of accountability. I was able to say, well, sustainability reporting is becoming more and more important, but without the numbers is quite meaningless. But what concerns me is that companies are starting to report in two silos, the financial report and a sustainability report, through the civil society lens, just looking at the impact on the 3 critical dimensions for sustainable development. And that was divorced from reality, because companies never operated on a basis that financial capital was in one room, intellectual capital in another, natural assets capital in another room or building. These things have always been integrated. And I use again the musical term symphony. There's a symphony between the resources used by a company to produce its product or render its service and its relationships with its stakeholders. The same as you can't have the violinist or the pianist in different rooms and the other instruments playing to create Mozart's symphony. You need them on the stage together, and you need them to combine and to connect. And so the argument developed, and His Royal Highness Prince Charles had started A4S, Accounting for Sustainability, talking about connected reporting, chaired by Sir Michael Peet of Peet Marwick fame. And Sir Michael flew to my then office in Amsterdam as chair of the GRI and said, "You're talking about integrated reporting. We're talking about connected reporting." I said, "Yes, connected reporting, there's still the dots you've got to connect. We have to move away from these silos." Anyway, debate continued, and integrated reporting, the statement of integrated reporting, won the day. And the famous meeting arranged through His Royal Highness at St. James's Palace, where the invitees were the executive of FASB, the executive of IFRS, IASB, sorry, I'm starting with the alphabet soup, the executives of GRI, of SASB, of CDSB, of CDP, etc., etc. All of them arrived with having got this gold embossed invitation from Prince Charles. And Sir Michael chaired, and I addressed the meeting on integrated thinking and doing an integrated report. And it was unanimously agreed that yet another body had to be formed, the International Integrated Reporting Council, of which I became the chair. And it took us some 2 years to develop the IR framework, working with iconic companies and professionals in over 60 countries. And the purpose of integrated reporting and thinking is the symphony of bringing together the thinking of the resources used by a company, and of course there are constraints in the world on resources, and the relationship between the company and stakeholders and the stakeholders of the company, to think on an integrated basis and then connect the financial with the so-called non-financial, but not in IFRS speak, not in GRI or SASB speak, but in clear, concise, and understandable language so that the users could understand it. But what had happened now is, because sustainability reporting was becoming more and more important, other framework providers entered the space. And for preparers, this became a matter of clutter and confusion, and also confusion in the minds of users, such as trustees of pension funds, to compare company A with company B in the same industry, one using SASB, one using the GRI standards. And really, they were looking at sustainability through different lenses. So much confusion. And as chair of the IIRC, together with my colleagues, we formed the Corporate Reporting Dialogue, which about 5 years ago started getting these framework providers in the ESG space together to try and harmonize these standards. So comparability was being diluted as a result, for example. So we started making some headway, but not successfully. In March 2019, and some of you may have been present, I think, Jill, you were present, I cannot remember, but as chair of the IIRC at the international conference, I took the opportunity with the executive of the GRI, of SASB, of FASB, of IFRS, CDSB, TCFD, everybody being in the room, to say I regarded it as a social outrage that people in the ESG space were creating standards and seeing themselves as competitors when they were dealing with public interest issues and all wanting to have the same public good outcome, namely to make reporting more informed and therefore making accountability more informed for users and for boards to discharge their duty of accountability. And to make it worse, they were all fishing from the same social pond, getting financed separately. And I am told this galvanized people into action. And, well, we know what happened during 2020. The pandemic and SDG 17 collaboration, huge collaboration, for example, in the finding of the vaccine. And there suddenly started to be collaboration between these framework providers. So the framework providers now started collaborating. We had the statement of the group of five, IIRC, SASB, CDSB, CDP, yes, and the IIRC, saying we intend to meet and to try and harmonize our standards, and using the integrated report as the connection between the financial and the so-called non-financial. The World Economic Forum, working with the Big Four, issued metrics for sustainability reporting, trying to get them harmonized. But over 60% of those metrics were GRI standards. IOSCO issued a statement saying to have sustainable finance, we have to take account of the ESG factors. The FRC issued a statement to say that in reporting in future, companies need to report in three sections: business, finance, and other aspects, essentially ESG factors. In the capital markets of the world, the great asset owners and asset managers were not only doing a due diligence of a company that issued a bond for bidding in the capital markets on a particular coupon, but we're also starting to do ESG audits, looking at the quality of governance, not a quantitative tick box, mindless exercise. It has a nominations committee, it has a preponderance of non-executive directors, etc., but what was the quality of governance? Was it mindful and outcomes-based to fit into reporting, which had become outcomes-based? And the whole basis of value creation was created with integrated reporting. What were the inputs into a company? What were its activities? And the critical question being asked was, how has the company made its money? Not how much money. How has it made its money? And that there would be internal outcomes, obviously, because the company had to sell its product or render its service at a margin to service its borrowings and to pay its wages and pay its creditors. But there would always be these impacts once the product went out into society. So through the GRI lens, the impacts would be on those three critical dimensions affecting sustainable development, meaning not to impact adversely on those that come after us to develop sustainably. And through an enterprise value lens, looking at how economic factors, such as the collapse of Lehman Brothers, the GFC, the impact it has on the balance sheet, on the operating performance, and on the cost of capital. And the social issues, health and safety, we've seen it with coronavirus. And of course, environment, climate change. The result was, once this collaboration took place, there had to be merger talks. And as you all know, SASB and the IIRC have announced their intention to merge, and that exercise is ongoing. And by June, I believe, I'm a party to it, the Value Reporting Foundation will be finalized. And I personally responded to the IFRS consultation paper at the request of the IFRS. And I followed IFAC, I had discussed with IFAC, and I followed IFAC's view that the time had come to establish an international sustainability standards board, and that the IFRS should expand its mandate to deal not only with financial issues, but also with sustainability issues, but looked at through this value creation, enterprise value creation lens. This didn't mean that we would stop looking at sustainability through a society lens, no. So if you look at the statement of intent of the group of five, you will see three boxes. The big box is the standards of the GRI, looking at the impacts on the three critical dimensions for sustainability development. Then a smaller box, the impacts of those three critical dimensions on the limited liability company. And then a smaller box, the financial reports, which have matured and have rigor, and IFRS operating in 144 jurisdictions and dealing with regulators in 144 countries, in my view, was the right body to start and be the huge stepping stone to the ultimate end game, to try and have a global corporate reporting system where you can have true comparability in the globe, which of course has become a village because of the internet. The other problem is the net was putting such a lot of information in the companies on sustainability issues that knowledge was being lost in information. And the chief financial officer, usually a chartered accountant, was not sitting in his or her corner office drafting an AFS according to IFRS for consideration by an audit committee and eventually audited according to ISAs. No. They were starting to look at this whole value creation process. And as an advisor in C-suites, I saw that the true change maker in the C-suite was the accountant, because he or she had had this public interest training and could see this value creation process. And I believed that it was a misnomer to call them chief financial officer. I believed they should be called a chief value officer. And I asked Jill to join me as my co-author. And by 2016, our book was published, Chief Value Officer, and IFAC issued a statement saying we were right, that it's actually a misnomer to call the person occupying that office a chief financial officer, because he or she is not doing his or her job just looking at the financial issues, but has to start looking at these impacts, both through the civil society lens, but more importantly from an enterprise value position, looking at it through the impacts on those three critical factors: the balance sheet, the operating performance, and the cost of capital. And so the chief value officer at my alma mater, where I'm a professor at the business school and working with the School of Accountancy, we're starting a course to accredit chartered accountants to become chief value officers. Jill is an associate professor at my alma mater, the Wits University, WITS, University in South Africa. And our modules have been developed, and we will be starting the course the end of this month, certainly the beginning of March, for accreditation to Chief Value Officer. And all I can tell you is that headhunters today are starting to advertise for Chief Value Officers. All I can tell you as well is that it's not only a South African university, because I've been pushing this for years, that starting this course, it's being started at a university in France. And it will start in the United Kingdom. Jill, am I correct? The course for Chief Value Officer. So all the accountants online, the ultimate aim is to have the chartered value officer. Of course, that's going to have some bureaucratic hurdles to overcome, but they will be overcome, in my judgment. So as recently as last night, the IFRS issued a statement to say the overwhelming response has been that we should expand our mandate and should include and should maybe form a sustainability standards board. And by this morning, I received a telephone call from an IFRS trustee to say, we know each other personally, Mervyn, I'm happy to tell you that a task team has been formed to establish an international sustainability standards board under the auspices of the IFRS. And we're going to work on this, and we hope to be able to announce it by November this year, the formation of that board at the United Nations. So that brings you right up to date from this morning. And what an exciting time to be an accountant. As I've said, I'm a barrister and a judge, but I am in the very fortunate position. I understand accounting principles, and I've been a practitioner for years. And I've been a director, chief executive, and I've done it. You name it, I've done it. I've got corporate scars all over my body from being in the corporate world. But it is exciting times, and it is timeless, because we are in a resource-constrained world, and we are in a world with species extinction. In the final chapter of our book, we deal with extinction accounting, another exciting development for the accountant. And my friend and colleague will end the session in talking about that. Jill, over to you.
Thank you very much, Mervyn, and hello, everybody. I'd like to just say that, as well as being a professor at Sheffield University in the UK, I'm also incredibly fortunate, as Mervyn mentioned, to hold a visiting professorship at Wits University in South Africa, and therefore have been very privileged to meet Mervyn and other colleagues and be able to work with them. It's been very exciting, and we're continuing to develop things. So I'm going to just talk about specifically a piece of work that I've been doing with Mervyn and also with Professor Warren Maroon at Wits University, which is a framework for extinction governance. So this is really focusing down on exactly what Mervyn finished with, which is species extinction. And this will be a chapter of a new book, which I'm hoping to finish very soon and will be published this year on extinction governance. So as many of you will be aware, particularly if you've heard me speak before, planet Earth is currently experiencing a sixth period of mass extinctions. There is an unprecedented ecological crisis with around 1 million species of flora and fauna threatened with extinction presently. As you may know, yesterday was a very important day in the UK. The Dasgupta review, which we've been waiting for, commissioned by the UK Treasury, was published yesterday, which highlights the urgent need for countries, economies, businesses and individuals to protect and enhance biodiversity. In the foreword to this incredible review, Sir David Attenborough states, "Economics is a discipline that shapes decisions of the utmost consequence and so matters to us all. The Dasgupta review at last puts biodiversity at its core and provides the compass that we urgently need. In doing so, it shows us how, by bringing economics and ecology together, we can help save the natural world at what may be the last minute, and in doing so, save ourselves." So the great Sir David Attenborough has talked about these things for a long, long time, but the UK now has this leading review, which I think is going to have global importance. I believe that given the biodiversity and extinction crisis we are now facing globally, we need to explore how biodiversity and financial risks, among other risks posed by species loss, should be incorporated as part of an organisation's broader approach to corporate governance and long-term sustainability. Not only economics, which is the focus of the Dasgupta review, but also finance, accounting and corporate governance need to change urgently to assist in protecting biodiversity worldwide. So far, there is no explicit consideration of biodiversity loss and species extinction within corporate governance frameworks. Biodiversity protection is implicitly included in corporate governance frameworks as part of ESG, as Mervyn was discussing earlier, which are holistic or stakeholder-driven, such as the South African King Principles. But it's not an explicit issue. Our extinction governance framework aims to conserve and enhance biodiversity from the perspective of financial risk management, but also recognises the importance of preventing extinction due to the intrinsic value of nature. Preventing extinction can be understood as an integral part of a board of directors' fiduciary duties and imperative for ensuring that their organisations act ethically and as responsible corporate citizens. We therefore recommend that boards of directors ensure the highest ethical standards when it comes to evaluating and managing an organisation's relationship with biodiversity. We also recommend that boards address the extinction of species as a material ethical risk in an organisation's codes of conduct and best practice. Further, we suggest that company boards outline their responsibilities for protecting biodiversity and monitor how their processes, activities and outputs affect biodiversity. We recommend that at the strategic level, a governing body should reflect on how its objectives, operations and position in the value chain are reflected by a decline in biodiversity. There are many examples of this. Bees and pollinators is a good way of thinking about these issues, and ecosystem services. Our extinction governance framework suggests that companies should develop plans for mitigating the impacts of species extinction. The governing body should review any biodiversity protection policies, monitor their execution, and ensure that managers are held accountable for failing to achieve environmental and ecological objectives. In a recent book, which Mervyn mentioned, this is the book, Accountants Can Save the Planet, the Chief Value Officer. The concept of the Chief Value Officer, as Mervyn was saying, should replace the CFO by having a more holistic focus on value creation, as well as seeking to prevent value destruction or value erosion. In our extinction governance framework, we also suggest that an ecological value officer, or an EVO, should support the functions of the Chief Value Officer, or the CVO. Be an executive director who is concerned exclusively with financial performance is completely inconsistent with any integrated approach to managing economic, environmental and social concerns. A Chief Value Officer, or CVO, should champion a broader approach to strategy development, risk governance, operational management and stakeholder engagement, which recognises the importance of preventing loss of species and decline in biodiversity. Our EVO, Ecological Value Officer, focuses on protecting biodiversity and in this way seeks to prevent erosion of loss of value arising from the destruction of natural capital. Our extinction governance framework also provides recommendations for boards of directors in relation to their corporate charter, board selection and board appointments. Specifically, we recommend that any charter documenting a board's role and responsibilities should deal explicitly with extinction accounting. And extinction accounting is a mechanism which we've developed by which organisations can account for their impact on species and biodiversity. So basically, I'm not going to talk for much longer, but our extinction framework, our extinction governance framework, which includes extinction accounting, also focuses, of course, on stakeholder engagement and recommends that company boards should reflect on how stakeholders can be co-opted in the identification and mitigation of extinction-related risks and risks relating to biodiversity loss. For example, the providers of financial capital can offer much needed access to funds for conservation projects and raise awareness of the need to protect species and habitats. To conclude, our framework for extinction governance provides a means of integrating biodiversity loss and species protection into the corporate governance codes of practice for any country around the world. The framework can assist organisations the world over to address the current biodiversity and extinction crisis. COVID-19, as we know, has highlighted connections between biodiversity loss and human health. I think an extinction governance model provides one of many possible solutions to the urgent crisis highlighted in the almost 600-page Das Gupta review, which I'm still reading at the moment. As I said, it was only published yesterday. There is an urgent need to protect the natural world, and an extinction governance framework is a critical part of any toolkit aimed at saving the planet. And also coming back to what Mervyn's been saying about reporting, in the biodiversity reporting area, I think there is also an urgent need to harmonise reporting and disclosures, because at the moment there is a proliferation of biodiversity reporting standards all over the place. You know, we don't want to see the same sort of social outrage in the biodiversity space, which clutters reporting and which obfuscates the most important information on impacts on the companies arising from biodiversity loss, but also the impact of the company on biodiversity. So that's what I wanted to say today. Don't want to talk too long.
Thank you both so much for such an inspiring talk. And there's lots of comments in the chat box saying the same thing. One of our students said, "This is so inspiring. Jill's talk last year has changed my life, and it is so emotional to hear this amazing perspective from such an eminent professor as Mervyn King." So lots of comments like that. We have one question in the Q&A box, and then there's one in the chat box. Is there one key lesson we could learn from the impact of social changes in South Africa over the last 35 years, which finance professionals should keep in mind as we reinvent our business landscape following Brexit and the pandemic? Mervyn, you're on mute, Mervyn.
The answer to that is in the affirmative. As I said, it wasn't genius on my part to come up with this novel governance model in 1994. It was the special circumstances in South Africa that, because of the apartheid legislation, the majority of my fellow citizens had been excluded from the mainstream of the economy. And my committee, you can look up, Google King One report, you'll see my committee was reflective of what became known as our Rainbow Nation. And but I wittingly steered my committee away from the primacy of the shareholder model, because I knew if we'd come out with the model which was then prevalent in 1994, it would have been in Bell Pottinger's language of today, seen as white monopolistic capital, and would have been rejected. So I wittingly steered the committee away from current thinking and the way all of us were taught in silos, wittingly from it, to learn and understand the needs, interests, and expectations. And I say now, I mean, we never stop learning, that we have, as boards in the short term, have to make sure our company survives. So we've got short-term thinking. So we need a compromising, collaborative, integrated mindset, but compromising because of the hardships suffered by our stakeholders. But the stakeholders have to realize the companies also suffered hardships. So you need this compromise to survive during this survival mode. And let's say we get this herd immunity finished in 18 months or 2 years' time, and we get back to whatever the new normal is in 2 years' time, we're then in thriving mode. But we cannot, as directors, not discharge our duty of care to the company. We've got to think now, today, about the long-term issues, such as extinction of, Jill and I often talk about the humble bee. Without the bee, you don't have pollination. Without pollination, you don't have food. So it's critical. These are not issues or esoteric issues. And they're not issues I saw in the chat function, someone saying, this is all very inspiring, but what about SMEs? Well, the answer is, if the final consumer is a company listed on the London Stock Exchange, that company listed on the London Stock Exchange will be raising capital. To raise capital in the capital markets of the world, the great asset owners and asset managers today do not look at only do a financial due diligence. They do an ESG due diligence. And one of the things they ask, do you have a supply chain code of conduct? And are you monitoring what's happening in your supply chain? So companies are very careful to make sure their suppliers themselves are adopting good sustainability practices and are not just thinking of in silos of financial capital alone.
Thank you.
So,
Jill, we have time for a quick question for you, if that's okay, and then we just, I don't want to eat too much into the next session. Aaron asks, how important do you see accounting education in the fight for sustainability and biodiversity, and how do we come out of this old-fashioned view that profit is king?
Well, it's absolutely critical. I mean, accounting education in a university is increasingly incorporating sustainability issues. Certainly, I teach extinction accounting in corporate governance and in accounting modules at Sheffield. One of my PhD students has just completed, I don't know whether she's on this call today, Olga. She has looked at sustainability education in universities in the UK. In accounting, and found an increase in interest, and it's so important. I mean, as Mervyn stated very, very clearly in our Chief Value Officer book, you know, you can't have accountants who understand sustainability if they're not being educated in sustainability. So, you know, it shouldn't be just a tag-on issue at the end of a module or at the end of a course, and the same with professional accreditation and professional training of accountants. This is absolutely core. Integrated reporting should be you know, an important part of that education and training for practitioners. And I think that's going to be happening very soon now. One of the accounting bodies I'm aware of is looking at biodiversity very seriously as part of their agenda going forward. And I'm hoping to see that happen in all of the different accounting bodies, you know.
Thank you so much. I'm afraid that's all we've got time for. There are some questions in the Q&A box, so if you're happy to answer those, you can reply to those. That'd be fantastic. But really great to see you. Fantastic. She is here. Yes, fantastic. Jill, fantastic to see you. Mervyn, lovely to meet you, and I hope you can stick around for the rest of the conference. Thank you.
Thank you.
Thank you so much.
Everybody. Thanks, Neil.
Thank you, Francesca and
Thanks,
Caroline. I'd like you to ask you to join us.
Bye, Mervyn.
bye.
Hi there, Caroline.
Good morning.
How are you?
I'm good, Neil, thank you.
Thank you.
Hi,
So
Neil, I'm here too. It's Francesca. Unfortunately, I can't seem to turn my video on. I think you might need to do that for me.
There you go. No worries. There you go.
Thanks so much.
No problem at all. Hi, great to see you. Caroline, I have your slides ready to go.
I think what I was going to do was kick off and just provide a bit of context for today's session. So, welcome everyone, and thanks for joining us. What I'm going to cover is a bit of the context around ICAEW's carbon neutral journey, and it's a bit of a double act between me and my colleague Caroline, who will be going into some of the nuts and bolts of ICAEW's carbon neutral journey. And yeah, more than happy to take some time off our session to hear from Jill and Mervyn, such great kind of leaders in this space. So if you bear with me one moment, I'm just going to bring up my slides. So hopefully you can see those and they're all full screen and everything. Neil, if you can confirm that.
They are full screen now.
Super. So yeah, in the next 10 minutes or so, I just want to run through a bit of the history around sustainability at ICAEW, because I guess this is, you know, pretty important context when it comes to why and how we chose to become a carbon neutral organisation. So brief history, as I mentioned, ICAEW's sustainability area was established back in 2004 with a landmark publication, Sustainability, the Role of Accountants, still available and still very relevant today. Our focus has been on sustainability as a practice, and for us that means interpreting what it means for decision making within business. We were a professional body that was perhaps a bit later to the game in terms of sustainability. A lot of important work had already gone on in the space of sustainability reporting and the rising kind of interest around ESG. But we felt that to add value to this space, we wanted to focus less on the kind of product and service side around sustainability and more about what this means for decision making in business, what it is that people actually sit down to do when they're talking about sustainability. We take a very integrated approach when the sustainability team works closely with our other technical disciplines. So my team sits alongside our reporting, audit and assurance, corporate governance teams to ensure that we have alignment in standard setting and policy here, which I'm sure many of you all know has seemed to explode over the past 18 months or so. This work is very much informed by our members that work within the business community, and in particular in financial services.
Oh, you've gone on. We've lost your audio, Francesca. Francesca, we've lost your audio.
Finance. And I'm also pleased to let you know that, you know, back in 2020, we decided to ensure that all of our exam learning materials have been made available digitally, as opposed to printing the huge stacks of learning materials, which some of you might be familiar with. And we know that this saves about 262 tons of paper a year. So it's no small step that we've taken there. But we've noticed over time a number of significant shifts when we've been talking about sustainability. And I wanted to summarise those today in kind of 3 areas in particular. Most significantly, we think this has been responding to the real sustainability challenges that businesses are facing, seeing this as strategic issues rather than those kind of beyond the corporate boundary. And so these are summarised in the next 3 areas. So one is a shift, I think, from the idea of impacts to those of dependencies. So the impacts that you might see, I mean, anyone can have an impact. You know, you could be running a fleet of slave ships, but donate £1 million to Oxfam, and you could say you've had an impact. When we talk about dependencies, it's asking, and just, you know, bringing it back to what Mervyn was just mentioning, how are you dependent upon things like pollinators in order for a crop to flourish so that you can then sell that? This is the real mindset shift that we've been seeing going on, because it starts to bring that decision making within that corporate boundary. Similarly, we're talking about a shift from measurement towards valuation. So the idea of, you know, measurement is, well, how many extra-trillion tons of carbon do you produce a year, say? But valuing it starts to, it doesn't necessarily mean with a price figure in front of it. What it means is what does it mean for your business, and why does it matter? And then finally, we've seen a shift from the idea of siloed thinking into one of systems. And I think the kind of events of the past 12 months have taught us that we are very deeply connected to lots of different areas around the world. And so siloed thinking, you know, prevents us from understanding those huge risks that we face. ICAEW's role here is that we believe that our charter obligation as a professional body is to serve the public interest. So we've actually been using the UN Sustainable Development Goals to illuminate what that public interest is to us and help us understand and navigate, you know, what is a vision of what sustainability is. You know, I've been working in sustainability for a while, and it's incredibly difficult to describe, you know, a vision of a sustainable world without using, you know, sort of quite negative terms, whether it's, you know, clean that up, pick that up, what are you doing, everything's dying. And actually the UN SDGs provide us with a really positive vision that help us illuminate, you know, what is it we're aiming for in sustainability? We're aiming for prosperous economies in fair and just societies, and all in a flourishing and biodiverse environment. And encouraging those to kind of collaborate. Again, as Mervyn mentioned, you know, goal 17 is critical, achieving partnerships around the SDGs. We believe that we can do this by integrating, accelerating and scaling sustainability into mainstream decision making. This means not only integrating this into the qualification, but actually into the mindset of our 156,000 odd members, and making it relevant in all of the different contexts that they operate in. So COVID-19 did present us with, you know, a real opportunity, I think, to build on the sustainability work that we've done, and presenting a unique opportunity to accelerate that and scale a more sustainably driven economy. The excuses of an inability to act, to scale or change were disproven by the events of the past months. You know, we've seen huge change in the way business is done very rapidly, and the consequences of that not always positive. And so this is recognizing that if we don't, you know, face the real risks of climate, you know, countries will be in similar positions further down the line. But this doesn't mean that a sustainable recovery is a given. You know, I often revert back to the figure that in 2020, despite the fact that most people were grounded for an entire year, you know, not many people went on their usual annual holiday or flew around the world conducting business. Global emissions from flights, I believe, only went down around 7%. And so we've got a way to go in ensuring that a green and fair recovery can be built on the back of the pandemic. The enabling policy environment must be built for a green and fair recovery for it to be possible. And we believe that the accountancy profession has a significant role to play. So this is just a brief summary of some of the activities that we engaged in last year, and I'm happy to take questions on any of them. But we're called on the profession just this time last year. We were looking for it to be a mega year on climate, looking forward to the COP26 conference that was due in 2020 and is now delayed until the end of this year. And we, alongside 13 other accountancy professional bodies around the world, called on the profession to act on climate change. We also then had to call on the profession to ensure this was a crisis with a legacy just 2 short months later. In the face of the pandemic, we wanted to ensure that this wasn't a crisis where, you know, similar to the financial crisis, there didn't seem to be much lasting change as a result of what happened. And so in May, or early June, we signed an open letter to the Prime Minister calling for the UN SDGs to be used as a framework for that recovery. We also launched the Green Finance Education Charter in June. This is a charter which we launched with a number of different finance bodies, including accountancy professionals, but the CFA Society, the actuaries, Chartered Securities and Investment, Chartered Banker Institute, that committed us to integrate green finance into our education of our professionals. And so this was done and was to great success, and we really want to build on this to internationalise the charter so that more finance professionals are seeing green finance in those professional qualifications that they've taken. We committed to achieve carbon neutrality, and I'm not going to say too much more about that because Caroline's going to go into a bit more detail. And then finally, we launched a new sustainability and climate change community in November last year, which really brought together a lot of professionals. And it's free for anyone to join. You don't have to be an ICAEW member. And this is where we are corralling a lot of our expertise, inspiration, and kind of practical resources on climate change. So please do check some of those out. I just wanted to finish before I hand over to Caroline with a couple of resources that are available for you to look at, although my slides appear to have frozen. Sorry about this. Let me just try this again. I'll have to talk you through them because my slides appear to have frozen, but hopefully you can still see my screen. One of the resources we've been working with this year has been a WWF film called Our Planet Too Big to Fail. For those of you that attended last year's conference, I was talking about the predecessor to this film, Our Planet, Our Business. But this film was made during the pandemic, so it brings in the narrative of Build Back Better. And it's a great resource, I think, if you're in an organisation that's perhaps just getting started on its sustainability journey. It helps talk through, in particular, how the kind of finance community can drive tangible change within organisations and really come together to meet such global challenges as climate emergency and biodiversity loss. I also wanted to mention ICAEW's got a great podcast series called More Than a Number, which explores some of these issues and is freely available where you usually get your podcasts, and touches on, again, what the kind of the role of numerate professions are in actually driving change on some of these issues like climate, as you can see there, the SDGs, and how we can feed our growing population. So do check those out, and I'll make these slides available for any delegates that would like them. But without further ado, I'll stop sharing now and hand back over to my colleague Caroline, who's going to talk you through a bit about ICAEW's journey towards becoming a carbon neutral organisation.
Thank you, Francesca. Thank you. Yes, we're pleased to announce that in July last, ICAEW's board committed to carbon neutrality across our operations. And to effect that, we purchased a selection of offset projects in the autumn, and in tandem, the board also agreed to the review and implementation of a number of significant internal carbon reduction investments over the coming years. So in this presentation, I'll give you a brief overview of what were our drivers, an insight into some of the stages of that project, and a sprinkling of the learnings we've had on that evolving journey. So Neil is going to do my slides for me today. So Neil, can we go to the next slide, please? Thank you. So ICAEW has for a number of years a clear position, public voice and strong messaging on climate and sustainability. And this is evidenced in a number of ways, including that body of work of the sustainability team in our thought leadership area that Francesca presented to you earlier. Our Chief Executive is also passionate about this subject and the role of the profession in driving positive change. Therefore, our carbon neutrality aligns our actions with our voice, and we want to use the opportunity to lead the profession and where we can to influence further on this topic. We've also been incorporating more of the Sustainable Development Goals in our operational plan year on year, and I will come to that in a moment. So going forward then, I just want to stop for a moment and point to what the accountancy profession is doing right now in this space. And if I take a subset, the larger firms, so if we go to the next slide, please. So you'll see that all of the big four have carbon reduction strategies in place. And I think it's also vital, though, to consider the reach of our membership and the relative position of influence they hold. So we estimate they advise up to 3 million businesses. So the effect that they can have is like a cascade. So that's quite important to us. So going to the next slide, just how did we get here? So broadly, our carbon neutral approach reflects a sophisticated strategy on 2 prongs. So financial support for external carbon reducing projects against our entire greenhouse gas emissions now, in tandem with significant investment in internal decarbonisation actions over the next 10 years. So the next slide shows you that we've already done quite a bit of work in this area. So we started carbon reduction initiatives about 6 years ago, and we included areas such as recycling, non-landfill disposal of waste, and more efficient air conditioning and heating units. So effectively, on the back of those actions, we'd already achieved a 20% drop in our emissions before we embarked on the actual carbon neutrality project. And the numbers in this picture are pre-Corona-19, so they're not skewed. And I just focus on 2 of these. So it's interesting to note that the introduction of LED lighting in just 85% of our building, Chartered Accountants Hall, resulted in a 60% drop in power consumption. So as at the end of the year, so December, we finalised a further refurbishment, and we've now got 100% LED lighting in the building. The flights one, you'll see we'd already managed to achieve a reduction. And obviously before Corona and lockdowns, we had decided to cut travel budgets. So that would be a disincentive to travel. If we go to the next slide, we've undertaken to share the learnings from our journey with our members. So that's accountancy practices and other stakeholders, including the public sector and our members who work in businesses across the globe. And this is to educate, encourage, and inspire change. And I suppose if I take Sir Mervyn King's phrase and slightly paraphrase it, we wanted to be on the highways, not the byways of minds. I tend to advise that one of the first tasks is to measure your emissions so that as an organisation, you know where you're starting from. It also facilitates the setting of reduction targets, and it allows these to be managed and monitored, and also to know where the bulk of your emissions come from so you can take targeted action. So if you see there, I'm sharing with you ICAEW's breakdown. And I suppose you might find one of the more interesting figures is the 29% of our travel emissions that are accounted for by employee commuting. Okay, the next slide then talks about a very important subject, because those we've already shared our journey and learnings with, so other organisations, other professional bodies across all professions, they ask us how to get this subject onto their board's agenda. And in response, we encourage education and awareness raising. And we really recommend the series of films Francesca referred to, the Our Planet series, as a really good starting point. We also suggest that organisations set their reduction targets and ambitions high. For example, ICAEW is one of the few companies who does include the emissions arising from employee commuting in our footprint. So that's a scope 3 emission that we do feel responsible for. And ICAEW also set up an employee engagement forum called Club Climate, which is set up by Francesca. And it's been excellent for getting staff traction right across the business. So the next slide goes back to what I spoke about earlier, and along with this statement here for our members, we started to embed our commitment to change into our operational plan a few years ago. And we did this in a number of ways, particularly by aligning many, and I have to say a growing number of our actions with the SDGs. And our carbon neutrality strategy reflects ICAEW Council, which is our governing body. It reflects their endorsement of the goals about 5 years ago, and obviously specifically goal 13, take urgent action to combat climate change. So moving on, I do emphasise that organisations will need to create their own bespoke reduction roadmap with initiatives that are tailored around their operations. So the types of boilers you're starting with, data storage and all of that. This is our roadmap in terms of timeframes and targets. So you'll see that we have a 5-year target and a 10-year target. And I do want to say at this point that we are somewhat constrained by advances in sustainability technologies, because in present day terms, we are advised that 60% of our emissions will still need to be offset in 10 years' time. But I have to say we are also really hopeful and optimistic that there'll be more advances over time, which will permit a much lower irreducible residual, and action by other stakeholders, for example, travel providers, will also help us on that journey. So moving forward then to the next slide, we're not satisfied with just offsetting alone, but these are the offset projects that we are supporting. And we're very confident we have some, these are the internal projects rather that we are investing in. And it does reflect a strong commitment to spend money in this area. And moving to the next one then, the next slide is the offset projects that we've chosen. And what we found is that offsets are a core element of any carbon neutrality strategy. And the vast majority of organisations that wish to become carbon neutral do need to buy offsets or in another way offset their carbon. And this is against this irreducible residual, and which internal initiatives and actions alone can simply just not totally eliminate at this time. But our offsets will complement the internal reduction work we're undertaking and investing in. And the projects that we selected, they're either gold standard or VCS, which is voluntary carbon standard verified. And what's important for us as an organisation is that each one of these projects align with a number of the Sustainable Development Goals. So moving on to the next one, everybody asks us about the impact of Corona-19 lockdowns now on our planning and modelling. And we think, in summary, that our footprint will have dropped by 2/3 in the past year. And last autumn, before we purchased the offsets, we had to remodel our 5-year projections for an estimated fall in greenhouse gases, specifically due to the impact on the employee commuting element, and obviously reduced power consumption in our offices, and also foreign travel by our executives. As you know, ICAEW's membership is fairly well sprinkled across the world. So we did a lot of travelling. So yes, we do think we'll see a drop of probably 1.5 tonnes over the past year. Okay, so moving to the last summary slide. I do hope this presentation has helped to inform you to a small degree. It's a very quick run through. But do please watch out for a series of informative case studies which are going online in the coming months on our Sustainability Hub. And these will give more detail on the challenges we faced, the processes we followed, particularly due diligence on the offset providers and the offset projects, and also more detailed work on what we did on our roadmap. And so finally, just to reiterate on the next slide what Francesca said, we set up this sustainability committee last year, and it's been incredibly successful. And I do urge you to join it. It's a vibrant and fun initiative with lots of people who are clearly interested in this topic. So thank you.
Thank you both so much. Caroline, I've just asked you to start your video so we can see you. We have a couple of questions in the inbox, if that's okay to run through those. We've got a few minutes. So Paul asks, as a chartered accountant for ICAEW for nearly 20 years, it was great to see Francesca's slide 6. I'm delighted that ICAEW is making a stand on these issues. I was also slightly surprised that as I had not realised from the various newsletters I received that you were so active. How long will it be, therefore, before sustainability issues take more of a centre stage in the profession?
So it's probably a question for me, I think. I don't know how long it will be. I hope it will be quick enough that we can, solve some of these huge challenges like climate change and biodiversity loss, because we don't have the sort of 120-year time frame that we've had for financial reporting to develop to its current state. I think accountancy really needs to rapidly respond to some of these sustainability challenges. And for me, it's not about sustainability being a kind of a special interest group or, something that people opt into because they want to save the planet. This really needs to be into the mainstream of the mindset of the profession. And so what we're trying to do is take a really integrated approach to do that. We're not rushing into an SME and saying there's a climate emergency and saying the finance director must do something, because frankly, they'd say, I'll add it to my list of emergencies because cash flow is the biggest one right now. But what we're trying to do is integrate it into the overall mindset, as I said. So it's saying, are your costs rising? Is your cost of insurance rising? Is your cost of capital rising? Were you flooded this time last year, or are you at a flood risk right now? Or how uncomfortable was your building in the heat of the heat wave in the summer? Did your systems fail? Have you had supply chain disruption? All of these questions which chartered accountants should be asking already within the businesses that they run and advise. That's the way we're trying to integrate these sustainability messages and really provide support and guidance where we can. And Caroline mentioned, things like the case study element of, our own carbon neutrality journey. We're not a massive carbon emitter. We're a professional body. The fact that most of our emissions are related to staff travel should tell you that. And that's just our staff commuting. We don't all live miles and miles from the office typically. We're all using public infrastructure generally to drive to and from work. At the same time, it's recognising the leadership role that we can play in demonstrating that we, a larger medium-sized enterprise can make these decisions and make huge carbon savings. So that's really what we're trying to do, is help to mainstream it by making it practical, hopefully inspiring, and really bring people together on some of these issues. And that's what the ambition of the new community is.
Thank you. Another question. Many of the attendees are starting their careers working in junior posts. What practical ways can they start the conversation within organisations who are currently not working towards sustainability?
If I had £1 for every time this question got asked of me. I believe that young people have huge potential for leadership here. You think back to 2019 when literally children took to the streets in the school strikes for climate, and just how quickly we saw a massive governmental response around the world to those real demands that kind of Gen Z and millennial audiences were positioning. If you do watch the Our Planet Too Big to Fail film, there's a lot in there that speaks to that, and the fact that these young people are not only the future professionals, they are the future business leaders, they are also the future investors. Millennials are set to inherit a huge amount of wealth from the kind of baby boomer generation, and so those investment decisions are really going to drive massive change. Within organisations, I think you can be incredibly powerful as well. I think there's a kind of alignment of issues going on with environmental and diversity concerns. There was a survey done by the UN that was published just last week that's really interesting, because for the first time they reckon that about 2/3 of the world's population believe that the climate emergency is real and something needs to be done now to fix it. And what's interesting there is making sure that the kind of diversity of perspectives of age is heard. You think of the average age of a FTSE board member, I doubt it's in a millennial category. So actually we have to work with these two movements together to ensure that young voices are heard at all levels of decision making. I do think that young people have real power in organisations to bring some of these issues to bear, because they are the ones that have seen these types of issues integrated into their education already. And so they may actually be the experts in the room when it comes to issues like green finance or climate disclosure. And so go to their seniors, tell them and talk to them about these issues, do screenings of the film within your organisation, because I don't underestimate just how powerful it is to kind of capture someone's imagination about an issue, and then share that within the organisation, so that answers and real strategies can be developed to tackle these issues. Anyway, conscious that we're probably coming to the end of our time, and I definitely don't want to disrupt the next session.
No worries. Caroline, is there anything you'd like to add before we close?
No, I think Francesca summed it up. I think it's another quick win is the setting up of the Club Climate, the group that Francesca set up, which is a completely voluntary group that all staff with an interest in this topic can join, and it's a great communication forum, and it can share things like let's get recycling more in the building, and so that's another idea.
Fantastic. Thank you both so much for joining us. It's really great to see you and for sharing that. Thank you so much. We are ready for our next session now. We are joined by Professor Richard Murphy and Martin Rowley, and they are talking about taxing times. How do you account and pay for the pandemic? Richard, are you happy to join us? Hi there, Richard.
Hello.
Hello, how are you?
I'm very well.
Good.
Just get me in the screen. Even looking tidy.
We can see you and we can hear you perfectly. And hi there, Martin. Hi there. So
Hi.
I will hand over to you both.
Thank you. I don't know, Richard, do you want to go first or shall I?
I really don't mind. Martin, I thought you were going first. I'm going to be completely honest with you.
That's fine. Okay, so I'll go. So hello, everybody. I'm Martin Rowley. I'm a partner at Deloitte in our US business tax group in London. I also head up our Jersey tax practice in the Channel Islands. It might seem rather a strange mix. For my sins, I went to university in the United States when I was 18 and then went to law school, started out in the legal profession, and then joined Deloitte in 2012. I've been in London since 1997 practicing US tax law. And then the Jersey connection is because that's where I was actually brought up. And so I've headed up our tax practice over there for the last 3 years. What I wanted to talk about today was just a bit of a flavor of the international tax landscape. Well, I suppose domestic and international, really. What's happened, what I think is going to happen. Obviously, these are very challenging times. And a few other observations around taxation, the tax profession, and what that means for tax lawyers and accountants. I don't have any slides. I'll cover about 5 different things. So the first thing I want to talk about was the domestic and international tax landscape a year ago. That was dominated by a few things, the UK and European Union and Brexit. And obviously that was such a huge issue that really dominated, a year ago and even into last year in terms of what was that going to mean for the UK? What was that going to mean in terms of the potential for the UK to basically go out and strike its own course, not just in commerce, which was what a lot of the government focused on, but also in taxation and tax policy. One sort of aspect of the European Union, which may not be so well known among the broader populace, is that there is a move within the EU member states for an increasing degree of unification of tax policy. I don't think there'll ever be a situation where there will be a single set of tax rules that apply to all of the member states. They will still have their own domestic tax rules, and I don't think there would ever be the case that there is a single rate of tax across the European Union. Tax is obviously a big driver and tool really of economic policy. So it would be difficult to try and to conceive really of a situation where, for example, Greece on the one hand and let's say Denmark and Sweden on the other could actually have any sort of alignment in terms of tax policy and broader sort of fiscal measures. But that said, there is a very strong move within the European Union for consistent approach to taxation, avoiding tax evasion and tax avoidance, and gaming tax systems so that there is shifting of income from one jurisdiction that might have a lower tax rate out of a jurisdiction with a higher tax rate. So that is something that I think is a real feature of being part of the European Union. What the UK's freedom from that gives it is the ability actually to strike its own course and be a little more bold in terms of what it does with tax. So I think that was one of the things that was very much in the government's eye when they were negotiating the Brexit withdrawal, as I say, sort of a year and more ago. Another thing that was on the tax landscape a year ago was the US and the Trump administration. So back then, obviously that was when Trump, having in the first couple of years of his 4-year term, actually passed some fairly significant tax reform legislation, slashing the corporate tax rate from 35% to 21% in a move to make US multinationals more competitive in the global marketplace. With limited success, it has to be said. But then also with things like, for example, trade wars with China and Turkey and other countries, and associated tariffs and measures like that, which again are they are a kind of taxation. So I think that was something that, on the one hand, you saw the Trump administration looking to make tax less of a burden, but in other instances, certainly in their international sort of dealings and some of their conflicts with other jurisdictions, actually imposing additional taxation, if you will, which of course is then something of a drag on economies. Also, over a year ago, actions by the OECD and the European Union Code of Conduct Group, which is a body that in essence has taken upon itself to peer review certain jurisdictions year by year, and basically assess any that they believe to be promoting tax avoidance or tax evasion, and take measures with blacklists or other types of sanctions to try and thwart the promotion of tax avoidance. The OECD has for many years been looking to, when I said about the European Union, about harmonizing tax, again, not anything about a single tax rate, but harmonizing the approach to taxation. So for things like, for example, with intercompany pricing, with taxation of the digital economy, and other measures like that, VAT, so that there's a consistent framework that all countries adhere to make it more simple for international companies and investors to have an understanding that while they might be subject to different tax in different jurisdictions, there are broad similarities in the rules, if you will. And the OECD has had limited success in that, I think it's fair to say. One of the reasons for that really being is that it's so hard to get consensus. It's such a large body of countries that really it is very difficult. And obviously for them because it is a supranational body and it doesn't have any legislative power, it really is just trying to introduce guidance, if you will, that countries then say they will sign up to. That has been something where I think a lot of hard work has been done, but the degree of success has in some respects been quite limited. And then another thing that I think people were seeing over a year ago was an increased move to what I would call tax transparency and intergovernmental cooperation on tax collection and exchanges of information. When I talk about tax avoidance, there has been, for many years, the understanding that sophisticated taxpayers and wealthy taxpayers have potentially the incentive and the ability to seek ways either to shift income from high tax jurisdictions to lower tax jurisdictions, as I said, or actually in some instances to hide the income in jurisdictions where there is greater degrees of secrecy. Tied in with a lot of the work that the OECD and the European Union have done, there has been a general move and a recognition among many countries. They're not there yet in terms of every single country has signed up to this, but there is a broad adherence to the notion of tax transparency and cooperation in sharing information. So that if one country believes that there is the potential tax evasion by a taxpayer in their jurisdiction, with an appropriate request for information exchange to another jurisdiction, by way of bilateral and in some instances multilateral agreements, there is now that framework in place to do that. And that has indeed assisted a lot in a greater coordination of global taxation and collection of revenues, and resulting actually in greater efficiencies for a number of tax authorities in their tax take. So that was the landscape a year ago, and then COVID hit. And the world was obviously turned on its head in so many ways, not least in the area of taxation and fiscal policy. And what I mean by that is that one of the features of COVID, I mean, we certainly saw this in the UK, but I think in so many major trading nations, was the need for massive government borrowing. And I think, Richard may speak about this, sort of from an economist's perspective. But again, the reporting in the broadsheets and statements by, people like the Chancellor and what have you, there is this sort of broad recognition, if you will, that massive government borrowing today, that there is a need at some point to raise additional tax revenue to pay off that debt. That is the stated, and I see Richard shaking his head there, and I saw some notes that he had. So I think I'm very interested to hear what he says. But again, that's what governments are saying, and I think we are seeing, there is talk in terms of with the March budget in terms of what increases in tax rates there may be. Would there be in corporate rates? Would there be maybe some tweaking with capital gains rates, or even abolition of that? All sorts of talk about different policies that might levers really that might be applied to try and raise additional revenues. So tax increases, I think, is definitely something that is being talked about. Another thing that I think, if you see a lot of the commentary from really all major trading nations, is that when they're talking about a post-COVID world and post-COVID tax policies, everyone is signed up to this notion of green taxation. So tax policy that actually promotes environmental stewardship, the ESG agenda more broadly, and if you will, promoting things like, electric cars, renewables and this sort of thing, and maybe harsher tax regimes on what you might call dirty fuels. I talked about the United States before, and that is a country that for many, many years, because of a very strong oil lobby, there have been a lot of tax breaks for the oil companies, the oil multinationals in the United States. And there is this notion that over time, tax policy can be used in essence to help accelerate the move from some of the older sort of, carbon fossil fuels to a more green economy. And that's, not only with the producers, if you will, of energy, but also then in terms of consumption. And again, so you can have tax policy that might, for example, have lower VAT rates or no VAT, for example, on things like purchases of electric cars or these kinds of things. And all sorts of other measures that can be done both at a national and local level, really to encourage people to more quickly do what we are all being told at some point we will have to do. Definitely a greater focus on compliance. So again, I spoke previously about the world before COVID, that there's this greater cooperation and this understanding of a need to collect as much tax as possible. That is even more important now, obviously, for cash-strapped governments. It is absolutely essential. It's all very well having a headline tax rate of X%, but if you don't have a robust system in place whereby you can actually collect it and also penalize people if they fail to timely pay their tax liabilities, then it's pretty pointless raising taxes if you can't actually enforce. So that actually, I think COVID has and will further drive this move to global cooperation and seeking ways for governments really to assist one another in the collection of taxes. I spoke about Trump in the United States, obviously now with President Biden, and more recently with both the House and the Senate, so both houses of Congress now being Democrat. That is important for US tax policy because, and I mentioned before that Trump was able to get tax reform through when there was a split in the House and the Senate in terms of Democrats and in the House and Republican majority in the Senate. But now with all three, the House, the Senate, and the executive, the presidency being Democrat, there is the potential for Biden, in essence, to achieve more. We've not really seen yet what that's going to be, but as one might expect, with a more left-leaning government and the Democrats, being more in that sort of direction, is the possibility of higher taxation, focus on things like preferential capital gains rates for certain of the fund investors and this sort of thing. And some people would say, let's face it, the sort of the way a newspaper would describe it as probably taxing the rich. Beyond COVID, a feature of the tax landscape for many years that will continue is tax competition. And what I mean by that is, in essence, and the UK has actually been in the vanguard of this in some regard, in some respects. In essence, you can seek to attract inward investment by having a lower corporate tax rate. So there has actually, for many years now, we've witnessed a situation where a lot of Western nations have actually over time reduced their corporate tax rates in a way to try to attract further inward investment. And also, obviously, sort of the flip side of that is also to prevent existing headquartered companies in the jurisdiction in question not to seek to expatriate and move somewhere else. That will continue, but obviously it needs to be tempered now by the need to have actually, a very close eye on the amount of tax take and what is the right level of corporate taxation and the right rates. Taxing the digital economy is something that has really, I think, frustrated a lot of governments. This notion, and Richard may speak about this as well in terms of consumption taxes and what have you, but it's this really difficult concept of, with an income tax, traditionally, it was quite easy to see where income was realized, where it was generated and where it was realized, where it was earned and where it was taxed. But with a digital economy, the question is, well, where do Google, where do Apple, where do they actually earn their money? Do they earn it when you click on your mouse? Do they earn it at the point of delivery, or do they earn it at the point of production? And that is something that countries are really wrestling with in terms of what is the right rate and the right place to impose tax on that. Consumption taxes, this is a difficult one because I think different people have different views, but I think all would agree that at least there is the potential to use consumption taxes as a way to raise more revenue. So in a very simplistic world, if one wanted to reduce the rate of income tax, but have a higher rate of VAT, then you could, if you ran the numbers, presumably get to a level where at least, theoretically, you'd raise the same amount of tax overall. And the idea being that then you don't tax people for becoming wealthy, but what you do is actually tax the disposal of that wealth or the enjoyment of that wealth. And that is something that some countries, and certainly jurisdictions that haven't previously had consumption taxes. So, for example, in the United Arab Emirates, a couple of years ago, they introduced a VAT as really their principal way of raising tax revenues. Technology, tax compliance and enforcement, I think that's just going to accelerate. So tax is like every other area in terms of the sweeping changes that technology, AI and other advances have brought. Literally seeing things now where in some jurisdictions, the tax authorities actually, they don't require companies to file tax returns anymore. They already have basically access to a database that has the company's financial statements, if you will, on a real-time basis, and then they can assess tax on that. And we're seeing, in Jersey, where I said I spend half my time, the move to e-filing and this sort of thing for companies and what have you. And that is something that then lends itself to technology. So in closing, the one thing I'd like to just touch on is, what does this mean for people in the audience? What does this mean for the tax professionals of the future? A couple of thoughts on that. I think technology and speed of delivery, and as I said, things like data mining and those sorts of things, and just coming up with really new tools that assist people with what is an increasingly complex compliance environment. I think it's fair to say that in most countries now, tax compliance and actually filing returns has become more complex than ever. So what people will want is, because obviously that is a drag on your business and on for individuals, you know, in terms of the use of time. So the more quickly and efficiently you can do that, that is going to be a very powerful selling point. So I think a lot of tax professionals, you know, are not the sort of the accountants of old that you would think of, but actually people who are working with technology and helping people report and comply more swiftly and efficiently. And the last thing I'd say is that on the advisory side, so you've got compliance on the one hand, advisory on the other, I think a lot of tax advisors will continue moving in the direction of, when I started, you know, doing this 25 years or so ago, multinationals were very interested in what their global effective rate of tax was, and getting that as low as possible, not least because they were basically judged against their peers in whatever their particular industry was. So in pharmaceuticals, it was kind of recognized that your global effective tax rate should be around X%. In, you know, oil companies, it was another. And obviously, particularly for listed companies, you know, their share price would suffer if they were paying a higher rate of effective global tax rate than their peers. So there was this real sort of challenge for everybody to try and minimize their effective tax rate. That's gone, not least because of you know, a number of high-profile challenges to some of the practices that facilitated the reduction of tax rates. To now, most tax directors and treasurers of companies will talk about paying the right amount of tax. So it's not the least amount of tax; it's the right amount of tax. With that, I'll hand over to Richard.
Thank you very much, Martin. Let me take over, and I'm going to take a different perspective. First of all, a brief introduction as to who I am. I'm a chartered accountant, have been now for, something like 39 years. So I'm not in the youth end of the market anymore, although I reckon I've got over 20 years left in my career as yet. A sobering thought for some who might be present that I intend to practice for 60 years. I am, slightly by accident, a professor of accounting at Sheffield University at the moment. So this is your second Sheffield professor in a row, because I saw Jill Atkins was in the last session, and I presume that was my Sheffield colleague. I'm also a professor of sustainability at Anglia Ruskin University, and until last week, I was a professor of political economy at City University, London. In addition, I'm the director of Tax Research UK, which is what many people think I do most of my time on. But in fact, actually, I spend most of my time on the Corporate Accountability Network, working on issues around accounting reform these days. However, I think of myself as the political economist more than anything. And I want to put tax into that political economy environment. I'm going to come back to some of the points that Martin raised. But I think that we are at an absolutely seismic point, a Kuhnian shift, where we are going to see a change in the way in which governments in particular are going to think about tax, and in which economists are going to change the way they think about tax. And that's going to have a really big implication for the profession. I'm going to share my screen and run through a few slides, simply just because they might help some of the points I'm going to raise. So I'm hoping that that's going to give me what I want. And apparently it doesn't want to let me open my screen. Instead, it's going to do, oh God, I didn't realize I had to do this first. So apparently we're not going to share my screen. It told me I could do this, and apparently I can't. Look, let's ignore the fact I was going to share my screen.
I have your slides if you'd like me to share them.
If you wish to, please do.
Yep, give me 2 secs.
But I obviously haven't unlocked screen sharing for Zoom on this particular facility.
No worries, I can do that for you. Give me 2 seconds.
Slightly annoyingly, I actually upgraded Zoom a day or two ago, and I think it's probably re-locked me. How very annoying is that? Look, here we are. That's the first one. Let's move on from that. I'm going to talk about tax after coronavirus, which I happen to call TACS, which spells tax. And I'm going to suggest to you we're living in the AC world. Which is different from the BC world. The BC world was before coronavirus, and the AC world is after coronavirus. And I believe that the approach to tax in these two is going to be fundamentally different in more dramatic ways, I would suggest, than Martin has just talked about. Can you have the next slide? As I'm not in control of this, I think. So what we now know is something really fundamentally important, or which not everybody wants to recognize as yet. And that is that we now know that tax does not fund government spending, because in practice, over the last year, substantial parts of UK government spending, half of it, has not been paid for by tax. And that's true of many countries around Europe and elsewhere. In fact, it's been true since 1866 that tax does not fund government spending, because in that year, an act was passed in the UK that says whenever the UK government decides to spend, the Bank of England will create the money to let it do so, without it having any right to object at all. And that is what actually happens. Governments spend, and then they reclaim what they have spent by way of taxation to control potential inflation. But it has been assumed that actually this was not the case. It was assumed that governments had to collect tax first and then borrow before they could spend. Not true, because if you had to pay your tax using government-created currency, and you do in the UK, the government had to spend that currency into use in the first place. Now, what we now know then is that something quite different exists with regard to economic management of the economy. And that is that government spending, which has been proved to be absolutely fundamental over the last year, not just in tackling coronavirus, but in supporting 90% of businesses in the UK, which are surviving at present with government support. That is how fundamental the government now is to the support of private sector, is funded by three things: tax, borrowing, and M, which is what I call, because all economists like letters, which is the money that the government does and can create, and which has not created inflation since this process began in 2009 in UK and other countries around the world. Can we have the next slide? So, the first thing I want to say, therefore, is this idea that Martin referred to, that we've got to pay for the coronavirus crisis now by somehow repaying debt or anything else, is simply wrong. There is nothing to pay for at all, because it's already been paid, and it's been paid for with government-created money. Now, we could try and take that money back if we wished, but if we did, the banking system would probably collapse, because that money was actually used, quite a lot of it was used, to keep the banking system going last March. And if we took it away, there would be insufficient liquidity in the economy. What is more, if we took the money away, there'd be insufficient money going around, because actually without government support, there's insufficient lending going on at the moment to create money. And all our money supply is created by lending. So we have to keep the money that the government has created in the economy. Now, there's 800 billion of quantitative easing money now in the economy, and there's only 1.2 trillion or 1,200 billion of government debt. Now, the interesting thing is that we actually have less government debt now than we did before the coronavirus crisis started, because so far quantitative easing has created more money than there has been debt issued by the government. So there is, again, no national debt needing repaying, because there is no additional national debt as a consequence of the coronavirus crisis at all, despite what you are told day in, day out by people on the television. And this is the subject of some research I'm doing at the moment. And the Bank of England, the Office for National Statistics, the Office for Budget Responsibility, and the Treasury have all partaken in that work. And I thank them for their cooperation. But this is true. There is no new national debt. And thirdly, this money supply hasn't created inflation risk, and that's because we've had sufficient tax and we have unemployment. And when you have unemployment, real unemployment, you actually can't create domestic inflation. You can create external risk inflation by political actions like Brexit, but you can't create internal inflation without full employment. So tax is not going to need to rise at present to tackle the costs of coronavirus. In fact, it would be exactly the wrong thing to do that, although there's a lot of talk about the fact it's going to happen. And Martin referred to corporation tax and capital gains taxes, the speculation. It's not going to happen if the government is wise. I don't guarantee we have a wise government, by the way, but the OECD and the IMF Two of the most left-wing organizations in the world, of course, well known for their Marxist credentials, I am joking, of course, are both saying whatever you do, if you're a government at the moment, do not increase tax, but do increase your spending and do, if necessary, increase your quantitative easing. So tax increases right now would be disastrous. But can we have the next slide? Tax does have to raise enough revenue to prevent inflation. If we did see a consequence of this extra money being created that arose in inflation, we might think about it. I think it's much more likely that we will actually see the Bank of England being much more relaxed about inflation in the future than it is at present. There could also be some serious moves to actually tackle some of the consequences of quantitative easing. If anybody looks at the national statistics on savings at the moment, you will see that savings are skyrocketing right now. Basically, for every pound of quantitative easing that goes into the economy, as a matter of fact, this is simple double entry, by the way. If the government borrows, somebody has to save. Now, technically, money creation is borrowing because on your note, if you look at it, it says, I promise to pay the bearer on demand. And that therefore means that technically new money is a form of debt, but one you can only repay using itself, which makes it a decidedly odd form of debt. Nonetheless, it does mean that there's more saving in the economy. And that means that we are seeing a massive increase in inequality in the UK economy at present. It is likely that we will see governments seeking to tackle that, to basically say, tax it or spend it, to make sure that we actually do create opportunities where there might be an economic stimulus. So I think the threat of increases of taxes on wealth, if people don't start to spend, might be put into place rather than any significant changes at the moment, but they might come in due course. There's also increasing pressure, and this is the green dimension I want to talk about, rather than really the taxation dimension of it, to actually have the government spend for a Green New Deal. That is the economic transformation to deal with sustainability. You heard about it in the last session. I happen to be one of the co-authors of the Green New Deal, which was first authored in 2008. It's the basis of the idea now used heavily by the Democrats in the States. Literally, they took our ideas and used them. So I'm an author of this and have been for a long time. I believe that there's going to be a lot of spending required on that. And we've seen this morning, the Public Accounts Committee in the UK House of Commons saying the government isn't spending enough. And we saw yesterday the Treasury being told by a Cambridge academic in a report that the Treasury commissioned that they have got to do a lot more on the environment. So we are going to see a need for more spending there. That is potentially a reason why we might see taxes on the bads that were described by Martin, things like carbon fuels and so on. But the overall aim at the moment is to stimulate the economy, because the risk is, and again, if you look at newspapers today, I mean, The Guardian, for example, newspaper today has big features on this, less in the FT this morning. The only two papers I've really looked at in depth today, if I'm honest, but both of them are looking over time and recently about the implications of the withdrawal of things like furlough. And the potential risk is massive failure of business and a significant increase, I saw mentioned somewhere else this morning, in the risk of insolvencies this year. So government spending is still absolutely critical to keeping our economy going, but tax is not at present. But can we have the next one? So this is just a summary of actually quite a lot of that. I actually do think there might be some tax cuts to encourage a stimulus at the moment. For example, I don't think we're going to see Eat Out to Help Out again, because that wasn't a great success in retrospect. As COVID spreading exercises went, that was bad. But actually, we won't see an increase in consumption taxes. I think we might actually see a cut in consumption taxes right now for two reasons. One is that actually consumption taxes are at current levels deeply regressive. That means actually they increase wealth inequality, and that's a government concern. But also because they actually fall most heavily on the poorest members in society who spend all their income, they actually do encourage an economic stimulus like nothing else can. So that may well be there as part of a government agenda to create a new economic balance within society. What I'm trying to say is, in all of this, let's go to the next slide. Oh, we're going to have a really big change in the way that we think about tax. And that's my brief summary of what I'm trying to say overall. tax is not going to be seen as just a revenue raising mechanism which pays for government spending, which is how we thought of it in the past, because it doesn't pay for government spending. But what has happened over the last few years is an increasing realization in government and amongst economists that the conventional mechanism of controlling the economy, which was to change interest rates, can't work, won't work, because we daren't increase interest rates. They're currently officially 0.1% for the government. They're actually negative in reality. People are paying the government to take their money, and yet they're queuing up to do it. And the reason why that is not going to change is that if actually it was increased, the massive private debt burden inside our economy, which is really worrying, and is whereas government debt is not a problem, government debt is completely affordable, absolutely under control, and not a consequence that anybody should worry about at all. But the private debt burden is very significant. If they raised interest rates, literally, we would have potentially millions of households going bust in a very short period of time. If the interest rate only went to, say, 2%, which, you know, in my history terms is tiny, but at current terms is absolutely impossible. So tax is going to become the instrument for fiscal management of the economy. But that means that actually this compliance agenda, which Martin was talking about, the desire of the European Union to make sure that there are enforcement mechanisms in place, the anti-tax haven agenda in most countries, although not apparent in the UK at present, where we seem to be heading for becoming a tax haven again with free ports and other such things. But in most countries, that anti-tax haven agenda is going to become very more powerful. We have in fact seen the EU threatening, or the EU Parliament threatening Jersey in the last week or so with being listed as a tax haven once more, which I have to say, Martin may know my history of my relationship with Jersey, where I've been an active campaigner against its government and against its tax system for 15 years, and actually forced to change in 2010 because the European Union basically backed my ideas against Jersey. Jersey will be changing its practices to comply with the EU's demands, I have no doubt. And we are going to see pressure inside many countries, including the UK, for better tax compliance. Because if governments who want to use tax as an instrument for macroeconomic control of their economies are going to be really effective in doing so, they need to make sure that everybody is actually complying with that tax law. So the motivation for compliance is not going to be revenue, it's going to be making sure that actually the system delivers, so that every tax relief they give works as they want and it isn't evaded or avoided by someone. So we're going to see this totally different approach to tax management. I don't think Rishi Sunak is there yet. I think I saw slightly more of this from the opposition recently. Annalise Dodds probably hinted a bit more at this, but certainly isn't where I'd like her to be. I am writing policy in Scotland at present, although I don't think the SNP are entirely there yet. But the point is that we are seeing a political change about tax. These are going to be exciting times in taxation, but we have to understand why, and that is because tax has ceased to be a technical issue. It has become a forefront political issue for politicians and economists to control the economy and not just to discuss the amounts of money raised. That's enough. Let's go to questions. Thanks a lot.
Thank you both. We do have a few questions, and we've got quite a popular one as well. As the world increasingly changes, we are already seeing cryptocurrency like Bitcoin or Dogecoin going up. What do you believe will be tax implications around this area? Also, with the recent GameStop debacle where Wall Street was shorting GameStop, do you believe programs like Robinhood, eToro and Trading 212 could potentially help even the gap between the rich and the poor in society? And what do you see as tax implications around shorting stock in this nature? Quite a big one.
Wow.
Martin, we'll come to you first.
I was going to say, I think that's more one for Richard, if I'm honest, because I think those are largely questions for an economist, and then maybe I can layer in some practical implications for tax authorities in that regard, if that's okay, Richard.
Yeah, look, if I just talk about the cryptocurrency dimension, first of all, cryptocurrencies are not money. I know people like to think they're money, but they are about as useless actually as a Scottish pound note is in London. A Scottish pound note is worth money in Edinburgh, but you try and spend it in London and you'll discover it isn't of any use at all, even though in fact, pound for pound, it's identical. It's about as useful, therefore, as a Danish krone is in Germany. Utterly useless unless you go to a bureau de change. So they are actually instruments for speculation. They're not backed by government, they're not used to pay tax, and they therefore have a very limited role in the management of the economy. The big issue is, for tax authorities, can they be used as ways to get around the tax system, to evade tax responsibilities, to transmit money across borders in ways that avoids automatic information exchange of the type that Martin described, which has been a reasonable obsession, and one that I have encouraged for a very long time, of the OECD and the EU and others with regard to tackling tax abuse. Can they be used for that purpose? Yes. Are there therefore going to be very strong measures put in place to require that these platforms exchange data with tax authorities in the way that pressure has been put on Amazon and eBay and PayPal and others in recent years to exchange data? I'm sure that's going to happen. Authorities are not going to be happy to see their tax revenues leaking out of the system using these things. Perhaps you deal with the second part of the question about taxing of trading platforms, Martin?
Yeah, well, I mean, I traditionally, and actually just to sort of finish off your point there, Richard, the traditional model of taxation has been to tax, there has to be a tax event. It has to be, so it's either a transaction or the realization of a gain or the earning of income. So people often talk about, well, what is the event that gives rise to a tax liability? I think one thing that, if there were widespread use of these types of cryptocurrencies or other modes, if you will, of, as Richard said, that you can use in some ways, but that are not government backed, if you will, then you could see that if they became more widespread in use, and then there is a perceived risk to the overall tax take, then one thing that I think governments could do is go to something you see in certain areas of the corporate world, but and certainly in the capital markets, where you basically tax people's wealth rather than expenditure or a tax event. So another way this is done, for example, is where there is tax imposed on what's called a mark-to-market basis. So in essence, at a specific point in time, a determination is made of what the value is of this. If it is increased in value from the last time it was measured, then that delta is what gives rise to a tax liability. So that could be a mechanism that, if there were widespread use of cryptocurrencies or other assets that aren't susceptible to traditional modes of taxation, that governments could seek to do that. Another, I think, a challenge that would impose, though, and then maybe this is coming on to the second point about sort of trading platforms and what have you. Governments are increasingly concerned, is maybe they're very interested in understanding the concept of who owns wealth, who owns assets. So you talk about registers, you talk about registers of beneficial ownership. And again, I think that's going to be an important thing, because you could say, obviously, okay, well, that's fine, Martin, you're talking about, so you mark to market what someone's, the value and the change in value of someone's, Bitcoin holdings, but how would a government know that they have? So again, I think that, there is the challenge as well to then build in a much greater degree of actual understanding of where wealth lies. And I think that does go to what I think both Rich and I were saying about tax transparency and the sharing of information. The notion of people being able to sort of salt money away in a bank account somewhere offshore, those days are done.
Good. I worked hard to achieve that goal. Can I come back to one little point there about the taxation of wealth? And I see another question on the screen. I don't know whether that's the next one we were going to look at, Neil. But the taxation of wealth is something that is clearly on the agenda. I don't think it's the most effective way to actually tax wealth as yet in itself. There are, for example, much better ways to actually collect tax better in the short term than is to introduce a wealth tax. Capital gains tax, equalization with income tax would be an obvious way. Reduction in the capital gains tax annual allowance. Why does a wealthy person get 2 annual allowances when other people don't? It seems bizarre. Inheritance tax is a tax in absolutely desperate need of reform because it's just got so many gaping holes and it is ridiculous and it needs to be re-looked at from scratch. We have this absolutely absurd anomaly that actually if you work for a living in the UK, you pay a much higher rate of tax than you do if you have unearned income, which of course is why we've had all the IR35 problem and personal company incorporations and all those other things, which could be overcome by reintroducing something which I'm old enough to remember, but maybe I'm the only one in the room who can, and that is the investment income surcharge, which was 15% additional tax on investment income over the normal income tax rate on those who enjoyed investment income, which went in 1985, but basically replaced national insurance at near enough the same rate, and would try to provide some comparison between the two and would stop a lot of the current tax planning around that area. There could eventually, though, be a wealth tax. I did some work earlier this year and I showed that if wealth tax rates in the UK and the increase in wealth over the period from 2011 to 2018 have been taxed at the same rate as income had been taxed in that period, the UK would have taxed £174 billion extra a year on the increase in the value of wealth over that period. Now, I'm not saying it should do that. I'm saying there is obviously a tax base there. And included in that I see this question on rental income and so on. Of course, ownership of rental properties would be one of the tax bases that could be addressed.
Thank you. Martin, anything to add?
Just one observation on that in terms of imposing tax on sort of increase in wealth. I suppose that the sort of the other side of that coin is, would the government provide a rebate if the value of someone's investments fell? So I think, and so I think there are, all of the, there are challenges whenever you try and introduce some fundamental reform in this regard. I think it's important to think of sort of the, all of the ramifications of this as well, and the arguments about, okay, well, you can't just have a sort of one direction of traffic, if you will.
No, that's why I say we should actually walk carefully towards a wealth tax, and there are plenty of other better, shorter term options to do. Can we deal with this question on rental property, or is that the one you're choosing, Neil?
No, go for it. That's absolutely fine. We've got time for one more question, so that we'll make this
look, there's
the
a question
one.
in the chat on increase in income tax on property rental income will therefore force landlords to put properties into corporate entities, but actually that will give rise to other consequences on capital gains tax and corporation tax. Look, yes, there are sorts of issues here. Look, there is a simple imbalance inside our tax system still. Again, I'm old enough to remember when I got tax relief on my mortgage and actually offset the interest I paid on my mortgage against my income and literally paid less income tax as a result. But that disappeared in the 1980s onwards. And now the only people who can get any form of tax relief left at all basically are companies on their payments for all their interest on the purchase of properties for rent. But there are real problems in wrapping it up. I think the buy-to-let market was heavily tax orientated, obviously tax subsidized, and obviously unfair in the sense that it biased towards people of my age who could save as an alternative to their pension for buying a property, and against younger people who wanted to buy property. And I've got two youngest people, they're called my sons, who I'm concerned about in this respect, who could not access property as a result. It was an obvious intergenerational failure. So I'm really pleased that in fact the balance is being shifted back towards young people. Unfortunately, we still have not got the balance right on the taxation of property. We need to actually introduce capital gains tax on the eventual disposal of property by people, literally living people, or rather dead people. But when you actually die, I believe there should be a capital gains tax charge on your overall increase in the value of your property during your life. I now live in a property which is worth 400,000-ish. I mean, it's mine. I'm old enough to own it. How much have I ever really paid to buy a house? I think about 60,000 quid. The rest is basically inflation. Why should I enjoy the rest of all that gain tax-free? No, I don't think I should. I think that should be included in a tax base when I no longer need a property, which is when I or my spouse cop it. Well, you don't have a need for a property when you're dead. It's a fact. So we need to rethink tax on property again as well. At the moment, it's all a mess.
Thank you. We have run out of time for questions. I'm quite keen to give people a break in between this last session. We do have one question that I think is important because it's been a current theme today. We've been talking a lot about sustainability and governance. How do you think business would respond to a sustainable tax? If I could have quick fire answers.
Oh, well, I don't think it's a sustainability tax. I think it is more trying to, and I've done some work actually for a number of organisations around tax incentives. So it's providing tax breaks, if you will. So I think I'd talk rather than I'm talking about taxation of. I think it's trying to foster the green agenda and ESG, as I said, with actually fiscal stimulus around tax breaks.
I have designed a way to bring the costs of climate change transition onto the balance sheet. According to the Institute of Chartered Accountants, it's still the only one they've seen. It's called Sustainable Cost Accounting. You'll find it on my blog. I've submitted it to the IFRS and others. What it would do is make a lot of companies look a lot less profitable than they do at present, because they have so many implicit costs to face with regard to their climate transition. I agree with Martin, we're not talking about taxing companies for climate at the moment, except with regard to their consumption of bads like carbon, but we're actually talking about subsidizing how they make that transition to goods carbon free.
Thank you. Richard, could you pop, when you get a sec, if you could share your blog in the chat box, that would be brilliant. Someone's just asked off the back of that. That's all the time we've got time for questions. And there are a couple in there. So if you're happy to answer those written answers, that would be fantastic. We will now break until 1:15. We do have a networking session taking place over on Zoom Pro, so you can leave this session, go into Zoom Pro using the meeting ID or the link I've just shared in the chat box. Make sure you come back at 1:15, and we'll see you shortly for break. Richard, Martin, thank you so much.
Thank you.
Yeah, thanks.
Bye bye.
So welcome back to everyone who's joined us this morning, or if you're joining us for this afternoon, welcome to this event. We will be kicking off shortly with Lord Prem Sikka, who, with a keynote address entitled "Lord Sikka Sticks It to Them," and I'll be handing over to him soon.
Now, Prem, I must apologise. That was a working title when we first started out, and I was going to change it. And when I talked to you and asked you to do this, I said I want you to talk about the profession, whether we can, now press the reset button and it's time to go. I just couldn't stop. For me, you've been sticking it to them for so long now, and to me as well. You, as I said earlier today, you were my little Jiminy Cricket on my shoulder, who always said, Graham, but you thought about education. Instead, all accountants should be taught ethics. All accountants should be, and lo and behold, 20 years later, now you've got a module for ACCA students all about ethics, and they have to sit an ethics module for over 20 hours. But when you first brought it up, everyone said you were a fool, but actually all you were was a man before your time. So this is Prem Sikka to me. You're Lord Sikka now, which always makes you laugh.
I'm still Prem.
But you shouldn't. For years, me and Prem used to go to my one time. I took you out to lunch once a year, and you always insisted it was Pizza Hut. Always a man of the people is our Prem. He loved the cellar bar, and there's one just around the corner from the ACCA. We'd always meet up just before the ACCA or just after the ACA AGM, where you would go and ask them your awkward questions once a year and then disappear. Sometimes they listened, but most of the times they didn't, did they, Prem? But anyway, that's us just having a chat, because I haven't seen Prem for ages.
Just before you go public, Graham, I don't know if you picked up, I'm sure you probably have, about disclosures by Big Four accounting firms about the ethnicity pay gap.
Okay, I will, as I always do after a conversation with you.
Yeah, it's about 46% at PwC. That is staggering. And I'm reminded of the early 1980s small inquiry by the Commission for Racial Equality, where they said they were going to get their act together. So here we are, almost 40 years later, virtually, if anything, it's worse. And you'd be lucky to find more than half a dozen non-white partners in any of the Big Four accounting firms. So again, Richard's right. It says we are now public. Okay.
Okay, right. So what you need to do, Prem, everyone, this is Lord Sikka. I'll leave you in his kind hands. Everyone, enjoy this session.
Okay, well, good afternoon, everyone, and welcome back to the conference. It is my great pleasure to participate in this conference, and I'm very grateful to PQ Magazine and the London South Bank University for once again hosting this event. What I want to do is briefly look at how the world of accounting and auditing has changed for the last 20 years, or maybe it hasn't changed enough and we need to do more. So perhaps the starting point is to remind everyone that almost 20 years ago, we had one of the biggest corporate accounting scandals of all times, that related to a US company called Enron, which had assets of about 63.4 billion, and by the end of 2001, it had to enter bankruptcy. So what were the things that were highlighted after the Enron collapse? The first thing was that its financial statements were comparatively opaque. It set up a whole range of special purpose entities, and a loss of bad news, debts, losses were buried in those entities. Secondly, it used what's a lot of people call then a remarkable new accounting tool, which was called mark-to-market. In other words, mark-to-market is not really based on actual costs, but it is based on so-called fair values of assets, which are very hard to pin down. So mark-to-market, in a sense, enabled Enron to inflate its balance sheet, report hefty profits, and the rest, as they say, is history. One of the things we learned from the Enron scandal was that the management, the directors that is, had considerable discretion on choice of accounting policies, which it adopted. Has any of that really changed? It had compliant auditors who collected considerable fees from auditing and non-auditing services. And in other words, the audit firm had considerable fee dependence upon the company, which many people would argue compromised their independence. And of course, the Enron scandal also brought down Arthur Andersen, who were the auditors. The company was also heavily into tax avoidance. It had performance-related executive pay. The directors also held shares and share options in the company. And the value of these securities depended upon the profit and earnings. And of course, that gave directors all the incentive to play accounting games. The regulators were shown to be too compliant, and one of the reasons was that they perhaps argued they were understaffed or were not up to the game. We don't know. As regards corporate governance, there was shareholder-centric corporate governance. The board was basically responsible to the shareholders. So that is the kind of a background to Enron collapse in 2001. After Enron, there was some frenzied regulation making, and in the US, they passed the Sarbanes-Oxley Act in 2002, which restricted sale of some of the consultancy services by auditors to their audit clients. In the UK, around about that time, we modified our corporate governance code, and it was argued that the companies that should comply with that, of course, that was voluntary. We also revamped the ethical code issued by the FRC. So what actually has changed since then in the UK? We have had a regular parade of accounting scandals in the UK. Some of the names will be familiar to you, like Carillion, BHS, Tesco, BT, Quindel, Autonomy, Rolls-Royce, London Capital and Finance, Cattles, Conviviality, Connaught, Patisserie Valerie, and many others have been making headlines. And of course, we can't quite forget the banking crash of the 2007 and 8. And in every bank which collapsed, the auditors had given a clean bill of health. And in some cases, the bank collapsed within a week of the auditors giving a clean bill of health. So now we've been told that the bank financial statements are so good that they can be used as a basis for determining whether it has adequate capital. Well, if anyone looks at a bank balance sheet, you will see that it has items which are made up of historical costs, amortized costs, net realizable values, present values, such as for pensions and leasing. It has fair value. Yes, mark to market is now institutionalized. There are fair market values and even internally generated numbers, which some would call mark to model or mark to myth, internally generated numbers for goodwill. So all that the bank balance sheets are doing is adding up the numbers in various values and costs, and the answer does not really represent any kind of capital maintenance. Indeed, there is no notion of capital maintenance in the IFRSs. So the banks at the moment are not maintaining money, real or physical capital. All we have is a random addition of various numbers. And are we now storing up a problem for even more bank collapses? I think we are, and they will happen. And the accounting numbers will be found wanting once again. The auditing firms, especially the big four, continue to collect large fees, but deliver so little of any value, and that is a recurring issue. The Financial Reporting Council tells us each year, through its audit quality inspection reports, that 25 to 50% of the audits are deficient, i.e. they don't meet the current auditing standards, which are incredibly low to start with. So that is the state of auditing and accounting that we have in this country at the moment. Now, can you imagine somebody producing automobiles or washing machines or packets of crisps or aeroplanes and finding that 25 to 50% of their output is deficient? Would anyone really trust them? Would they really be allowed to remain in business, especially as the failure of those products can cause a lot of damage to innocent people? Yet the world of accounting has its own rhythms, and nothing seems to happen to these big accounting firms. So what I'm now going to do is just look at one or two examples of scandals in the UK and see what happened. So Carillion collapsed in 2018, in January 2018, and what we found that Carillion had the usual collection of non-executive directors, audit committees, remuneration committees, internal auditors, external auditors, but none seemed to be able to talk about what was really going on. The company also claimed to comply fully with the Corporate Governance Code. Of course, it is easy to say you comply. Who would say that they don't really comply? And the Corporate Governance Code does not really empower any stakeholder. You can't sue a company for it if they don't comply with it, and you can't go to any regulator and say somebody has not really complied and now you ought to take the directors to task. It is all voluntary. Carillion had aggressive accounting policies which inflated its profits and assets. Its audited accounts included over £1.1 billion of worthless contracts. In other words, the contract numbers were not based on the costs, but they were based on fair value, exactly the same problem as we had at Enron. Carillion had 1.5 billion of goodwill in its balance sheet, which had not really been amortized for years. And that was all in accordance with the goodwill accounting standard. Basically, the management argued that goodwill had not been impaired, prepared a model, generated a number, and that was basically about it. The inflated profits enabled Carillion to pay high dividends. It borrowed over 1.5 billion to fund dividends, which actually made everything worse. Of course, payment of dividends and declaration of higher earnings inflated profits also increased the value of the shares held by directors and share options too. Carillion collapsed with the liabilities of about £7 billion, which affected about 30,000 small businesses plus many others. And many of those will receive next to nothing. The pension scheme had a deficit of 2.6 billion. And even if the scheme is fully rescued by the Pension Protection Fund, its members may lose some of their pension rights because there is a cap on the percentage which can be rescued. For 19 years, Carillion was audited by KPMG. KPMG collected £29 million in audit and non-audit fees. So non-audit fees are still collected by the auditors after Enron. KPMG always gave the company a clean bill of health. The FRC's audit quality inspection reports, which are prepared by the FRC for at least 3 to 5 years before the collapse of Carillion, was saying that KPMG's approach to auditing goodwill has many deficiencies. But it didn't do anything about it, simply issued a report, and that's about it. There was no enforcement action of any kind taken by the FRC. At Carillion, some of the other Big Four accounting firms were also involved in various capacities. Deloitte ran the internal audit, and one might argue that the internal audit should be looking at the risks that the company faces, but presumably they were not really highlighted because the company never really changed its practices. Ernst & Young were advising Carillion on possible turnaround and collected 10.8 million in fees. That turnaround never really happened. Pricewaterhouse were advising on the pension scheme to Carillion. And as I said earlier, the pension scheme had a deficit. So in November 2020, that is nearly 3 years after the event, the city watchdog, the Financial Conduct Authorities, came to the conclusion that Carillion and some of its directors, and I quote, recklessly misled markets and investors. This is bizarre. Carillion is in liquidation. Rather than warning the people when Carillion was actually trading and by examining its financial statements, saying something meaningful, it comes up with this warning on 13th November 2020. So again, our regulators have been asleep. Company had considerably, what some people would say, questionable accounting practices. I would certainly say that. We are still awaiting a report from the Insolvency Service on what it is going to do with Carillion's directors, though it has currently issued some proceedings against a number of them. So what the Carillion episode shows us that the audit failures were that the risks of audit failures were borne by suppliers, employees, pension scheme members, taxpayers, and local communities. None of these people are present on the company boards. The audit report is not addressed to them, and the auditors don't really owe a duty of care to them. Another case was BHS, which collapsed in 2016, and it was audited by PwC, who had a long-standing relationship with the company's chief executive, Sir Philip Green. PwC also provided the non-auditing services, and the audit partner responsible for the audit of BHS, it transpired that he only spent 2 hours on the audit of the company. For the day-to-day control of the audit team, the day-to-day control of the audit team rested with a person with only 1 year's post-qualification experience. None of that would have come to light in the absence of a scandal. So one wonders what the normal practices of any big accounting firm are. The eventual FRC report said that PwC did not really make an assessment of the business's ability to remain a going concern. It also said that the auditors failed to perform adequate tests to verify fixed assets, investment, loans, income, costs, and much more. So again, it is an issue. BHS never published a cash flow statement because the accounting standards said that subsidiaries don't have to, the parent companies would. That means it was very difficult for any outsider to get insight into the liquidity, the cash flow position of the company. By the time you look at the parent company's accounts, well, of course, the cash flow statement is an aggregate of many subsidiaries, and you can't see the troubled position of any subsidiary. PwC charged $355,000 in audit fees in 2014. That is the last full year's accounts, which were published by BHS, but the non-audit fees were over £3 billion. Now, that is contrary to all the rules that we've been told the auditors should follow. Let's look at just one or two other cases as well. Patisserie Valerie collapsed into administration in January 2019 amidst allegations, the company's own words are, quote, amidst allegations of significant fraud. The company estimated that the black hole was about £40 million. KPMG subsequently became liquidators and said the black hole may well be £94 million. Grant Thornton audited the company for 12 years. They collected audit and non-audit fees. And one wonders whether that had any impact on the firm's independence. At the moment, Grant Thornton are facing a lawsuit of £200 million for negligence from Patisserie Valerie's liquidators. Tesco is another example of accounting games. In 2014, Tesco announced that it has identified a possible 250 million overstatement in its accounts. Now, the background to that is that the company chose accounting policies which were perhaps favorable. So Tesco booked supplier contributions, which it received, and these contributions were conditional on hitting sales target. Now, inside people knew that these targets could not be met. So basically they reached agreement with the suppliers that these targets would perhaps be met next year. In other words, in a nutshell, there was early recognition of the contributions received from suppliers. That boosted the accounts, the profit, that boosted perhaps executive pay as well. But eventually the company realized that it could not be sustained, and the company itself made an announcement to the world that as to what had happened. In March 2017, Tesco reached an agreement with the Serious Fraud Office, and under the agreement, it would not really be prosecuted, but the agreement is called a deferred prosecution agreement, effectively put on probation. It also agreed to pay a fine of £129 million. A number of investors were also compensated to the tune of about £85 million. The FRC began an investigation into Tesco's accounts, but some years later, it was basically dropped. And our laws are also deficient, and the SFO's case against a number of directors was also thrown out. And basically the judges said it was not really good enough. I'll come to that particular legal position in a moment. The scandal currently dominating the headlines is a German one, which relates to a company called Wirecard. So here there were rumors, there were red flags as way back as 2008, basically saying that the company's financial statements were problematic and that the numbers were being inflated. From time to time, the regulators in Singapore and elsewhere took action, but that basically did not really deter the people from doing anything. So there were accusations of suspect accounting in 2008, 2015, 2016, and each time Wirecard each time the regulators acted, but there was no real action taken by anyone. Ernst & Young were the auditors, and the newspaper reports allege that the firm did not even adequately verify the company's bank balances. Now, anyone who studied auditing would know that you try to independently corroborate the bank balances by writing directly to the bank and trying to do that. So we are awaiting a full report, but that again is a scandal which is dominating the current feed. So what kind of a response have we had to various scandals in the UK? Well, what we have on agenda are cosmetic reforms. Firstly, there's a Kingman report, which looks at the Financial Reporting Council. The real problem with regulators is the capture by the very people it is supposed to be regulating. And the related to that is what I call cognitive capture. That is, you think in such a way that your sympathies lie with those who are regulated. Okay, so that is about the Kingman report. So Kingman report has said that the FRC should be replaced by a new body called the Audit Reporting and Governance Authority. But there's a big hole in the Kingman report because it is ignoring that there are 4 other regulators of auditing. They're called the recognized supervisory bodies, effectively the professional bodies. If anything, they have even less independence than the FRC. They are simply the creatures of their own membership. And Kingman basically ignores that. The real issue is also, how do you create some barriers to capture? Now, Kingman report does not really adequately address that issue. Now, one way of dealing with that is to ensure that more than half of the governing body of the regulators is made up of lay people, lay stakeholders who have a direct interest in auditing. That is not what Kingman recommends. We also have reports by Competition and Markets Authority and Bryden Review. Again, they are deficient. For example, thinking back to the Enron scandal, and it is relevant now again, we are still wedded to a shareholder-centric model of corporate governance. That means companies have to react to pressures from shareholders. Shareholders in large companies don't have a long-term interest in companies. They generally want profits as quickly as possible, as high as possible, and they exert pressure. There is no proposal in the UK to reform auditor liability. Indeed, the Competition and Market Authority said it was not looking at that. So if the auditor liability regime is lax, that means there is less pressure on auditors to deliver. You must have pressure points. So we live in a world where if somebody sells ice cream or potato crisps or toffees, they have to make sure that their product will not harm any current or potential consumer. If it does, then the producer can be sued. There is no equivalent law in relation to accounting. And then it gets worse. Just to give you an example, UK has what is called the Criminal Finances Act 2017. Under this, companies and directors can be charged with a new offence, which is known as the failure to prevent offence. So under this act, they can be charged for the failure to prevent tax evasion. The Bribery Act 2010 also enables the regulators to charge the corporations and their senior management with failure to prevent bribery. However, there is no equivalent law dealing with false accounting, money laundering, or other financial crimes, but which is particularly relevant to the finance industry as well. The 3 reports I mentioned do not contain any proposals for dealing with the audit market. At the moment, there are barriers to entry to the audit market. So if you want to enter the audit market, you have to ensure that the entity which delivers the audit, i.e. a partnership or a limited liability company, is under the control of those who are licensed to carry out an audit. That means that big technology companies, for example, they can't enter the audit market. So we don't have any law which says that only pharmacists can own or control a drug company, or only pilots can own shares in an airline. But we have this peculiar thing in the world of audit, which means that there are huge barriers to entry. And that means even if firms deliver poor audits, they are safe. They still retain control of the market. There's no reform of auditor independence in any of these reports. Auditors would still be hired and paid by the companies. So it's a bit like you insisting that you be able to hire and pay your VAT inspector or an income tax inspector. Well, that is not permitted in any other field, but in the field of audit, you can hire your own auditor and pay the auditor. And there are no proposal in any of these reports to have audit-only firms. So my position is that the auditors must only audit and absolutely nothing else. So we don't need all these huge code of ethics telling us that certain kind of relationships you should not enter into. So I will have a completely separate audit firm from everything else. There is no transparency about audit. So if you go to AGMs in any company, you will find there's a one-line resolution moved to appoint the auditors, but nobody knows anything about the auditors. We don't know, people have not had the sight of any audit tender, the audit contract, any management representations. We are not told anything about the composition of audit team. We are not told anything about the time somebody spends on the job. We are not told anything about the recent regulatory action against a firm, for example, fines by the FRC. We are not told anything about the audit quality deficiencies. For example, what percentage of a company's audits have been found to be deficient by the FRC or anybody else. And we certainly are not given any sight of the audit files. Why are they so secret? What is in them that we are not supposed to see? There is still no reform of accounting. So I earlier mentioned how BHS did not publish cash flow statements. That is still the same. We still have mark to market, which means companies can cook up their figures. We still have essentially the same accounting standard on goodwill. So management have a discretion whether they want to write off the asset or not. So all those problems still exist. We have multiple regulators in auditing, at least 4 RSBs plus the FRC or its successor. And none of them have independence or will have independence from the industry, because the FRC's successor will still be colonized by big corporations and big accounting firms. Regulators still don't have any statutory access to auditor files and staff. Within the UK, they might, like the FRC, but can you imagine when a bank collapses, what happens? So Barings was a bank which collapsed in the 1990s. The Bank of England wanted to interview the staff of Deloitte and Coopers and Lybrand, who conducted the audit, partly through Singapore, but the Bank of England was unable to secure access to the Singapore files or the Singapore staff. And it was not really fully able to investigate the failure to discover the frauds which were perpetrated at that particular bank. So no law has been changed to facilitate that. Then we also have to ask ourselves a question. We live in a world where there is real-time movement of money. So are the ex-post audits of any use? What is the point of auditor coming sometime later and saying, by the way, there were some problems? Meanwhile, the financial transactions took place months ago. The money has basically flown. So should we be having real-time audits at financial institutions? My feeling is that is what we need, but that is not what any of these 3 reports are referred to are recommending. We also got to ask our question whether it is wise for financial institutions actually to be audited by big accounting firms who seem to be unable to deliver robust audits. Well, maybe the state should create its own independent auditor something equivalent to the National Audit Office to simply audit the financial institutions. That way the regulators can have unhindered access to the audit staff, auditor files, and they can also specify the audit objectives. But none of these things are on the agenda. So my feeling is that the reforms which have been proposed and may well be implemented this year are basically cosmetic. They fail to address the fundamental problems of accounting and auditing. And I'll be delighted to take any questions on this and perhaps provide more within the next few minutes. Thank you very much.
Thank you so much, Lord Sikka. We have quite a few questions in the Q&A box. To start with, we have one from Steve. Would Lord Sikka favour restricting auditors from any ability to limit their own liability?
The answer is yes, I would do that. And I think I would also change the current liability laws as well. I think we should be able, where there is auditor negligence and fraud, we should really hold all the partners to account, the whole organization. Under the LLPs at the moment, LLP legislation, generally partners who've not been involved with the audit basically escape liability, even though they might share the profits made by the other partners. So I think if they're sharing profits, they're going to share the liabilities as well. So we do need to change the auditor liability laws so that they do become a pressure point for improvement of quality.
Thank you. John asks, considering all these cases, would it be better if all auditors were public officials from the state and not private firms?
I think that is the way we probably need to go. You know, if somebody hears that a state official from HMRC is going to visit them, they will probably panic. If somebody is coming from the health and safety people, they will panic. You go to the airport and your passport is checked by a government official conducting an audit, well, of course, you behave. But when your friendly neighborhood financial auditor comes around, nobody panics. Nobody worries about this because they are basically hiring and paying that auditor, and the auditors are looked upon as somebody who could possibly advise them on all sorts of other things. So in no other walk of life, anybody is able to appoint or remunerate their own auditors or hire the auditor as an advisor. It only happens in financial auditing, and it is completely out of line with other practices.
Thank you. Someone asked, you mentioned that the auditors of Enron collapsed after the scandal due to their failings. So how have KPMG and Ernst & Young survived the scandals of Carillion and BHS?
Well, in the case of Enron, there was a fallout and many clients basically walked away. So that is what happened. Enron, Arthur Andersen was never really formally charged with anything. It was only because of the rumors and the Enron affair, which was soon followed by WorldCom, where again, I think the firm was implicated. So it was basically the response from the outside world. KPMG have survived in a whole variety of ways. In 2005, in the US, it was fined $456 million, which at that time was the highest ever fine, for enabling its clients to dodge taxes. Okay, and the Justice Office said that KPMG admitted, and I quote, criminal wrongdoing. So the next thing would have been to take action against KPMG. Of course, at that point, the firm called in its financial and political resources and fought that off. But those dangers remain. And even that alone should encourage us about reforms to the audit market. If a major supplier drops out, then what? Then big company audits will really be concentrated in just 3 firms, and that means little or no competition. I wrote a report about 2 years ago, in which we recommended a lot more joint audits, and we also recommended we recommended that the state itself should consider doing audits of the finance industry. So maybe that will happen eventually. But at the moment, I can't see the current government bringing any of that about.
Thank you. Paul just popped in the chat box. Arthur Anderson had their license to audit removed. That killed the firm very quickly. The license was soon reinstated, but it was too late.
Yeah, that's right. Yeah.
Another question. Will the auditing industry actually improve? I'm currently an audit trainee and I'm struggling to see what value it actually brings, especially after the points you have raised. The industry seems inherently flawed.
Well, that is a very interesting question. I think the industry basically been shortchanging people for the last 50 years or so. The last banking crash was a big wake-up call. It should have been followed by thorough reforms, but very few effective reforms have taken place. I think the other thing we've got to ask ourselves is, what is an audit really about? Is it just a ritual? In other words, you know, the people feel comforted that somebody's had an audit, and that is about it. You know, just like people feel comforted when a child is christened, a priest mumbles a few words and people say, oh, well, now everything is all right. Same happens at marriage. Well, you know, somebody mumbles a few words and you say, oh, well, that is okay now. It is all legitimized. Or when somebody dies, somebody mumbles a few words. So there are rituals. It seems to me audit is increasingly a comfort-producing ritual. But once you start looking at the detail, it does not really deliver a great deal, and it should. And that is really a big debate to be had. I think, to be fair, Bryden, in a sense, begins that conversation, but that conversation is not really going anywhere, and it won't go anywhere. So I think really we have to accept at some time in the future that large enterprises can only be audited by a state body.
Thank you. Joanne has a sustainability question. If we have sustainability targets that attract tax subsidies, who will give the insurance that the companies are genuinely compliant rather than greenwashing their accounts? Enron was applauded for its corporate social responsibility before it collapsed.
I think we need to change the board structures. We got to have stakeholder boards. So no reason why the boards should not have representatives of employees, representatives of consumers, representatives of local communities. So in a sense, you've got to change the system of corporate governance to inject this kind of a diversity agenda. At the moment, we don't. There is a talk about accounting firms doing the environmental audits, and my response is, well, I'm still waiting for them to do decent financial audits. And they had 100 years try at this. They're still struggling to do that. I can't see why they should be delivering the environmental audits. Maybe we should invite Friends of the Earth, Greenpeace, and others to deliver those kind of audits. And I think they would deliver, their audits would be far more effective. But certainly it is cheap for companies just to produce glossy pages, glossy brochures, to say that we are leaders in this and that. The truth is that they've not really been that good at many things. I think, again, if you look at the corporate governance code, I mean, we can look at sustainability in many ways. First of all, people themselves need to be sustained. The social infrastructure needs to be sustained. But the corporate governance code does not ask companies to pay decent wages, does not ask them not to engage in tax avoidance. And that is, you know, something which the big accounting firms relentlessly market, various tax dodging schemes. And I keep asking questions about it in Parliament and hardly ever get an answer from the ministers to saying what exactly they're going to do about it.
Thank you. We are running out of time for questions, but before we finish, we've got a number of students on the call, LSBU students and beyond from kind of across the country and indeed the world. It's a really global event. Just to finish off your session, what kind of like words of inspiration would you have for them?
I think it is within their own hands to change the direction of the world of accounting. They can make it far more ethical. They can make it far more humane. You know, we have to remember whatever happens in accounting has consequences for people. Just think about what happened to the creditors' employees at Carillion or BHS. So there are consequences. So they can change it. I think we need to change the model of accounting. So if I may just take a couple of minutes to give you an example. Every student has prepared an income statement. Let's think about the income statement. Income statement is a motor for class conflict and exploitation in our society. So, for example, if a company is generating wealth, that wealth is the outcome of the cooperation between those who provide finance capital, could be shareholders, those who provide human capital, could be employees, and those who provide social capital, whether it is education, healthcare, that is society. But when it comes to income statement, wages are considered to be a cost. Cost means it is a burden. You must reduce it. So all accountants are devoted to impoverishing employees. Your management accounting books will have chapters on how to extract more from labor. Okay, payment of tax to society is considered to be a cost. So you have a whole tax avoidance industry devoted to that. But somehow payment to shareholders in the form of dividends is considered to be a reward. Why? Why this kind of a different treatment of the payments to three main categories of capital providers? So accounting has basically legitimized the non-payment of taxes, poor wages, and exploitation of society as a whole. So we need to completely rethink the way we prepare financial statements. At the moment, they don't serve the interests of society. We are told they are aimed at shareholders. If you look at large companies, some of the institutions of shareholding is only for 22 seconds. And your ordinary shareholders probably hold shares for about a month. In other words, whole of financial reporting and auditing is aimed at speculators. And if you look on the London stock market for the last 10 years, the money extracted by the stock market in the form of dividends and share buybacks is far more than any money which is raised through the issue of new shares. So we have this kind of a speculative frenzy, and financial statements have become central to that. And they don't really serve the needs of society. At best, they only serve the needs of speculators. So fundamental rethink is needed in order to ensure that accounting and auditing deliver value to society as a whole.
Thank you so much. That's all we've got time for. Lord Sikka, it's fantastic to see you again. Thank you for joining us today. I hope you'll be able to stick around for a little bit more of today's conference.
I certainly will. Thank you very much for inviting me.
Thank you so much. Richard, I'd like you to join us for your session. We're joined by Richard Sims with a session entitled The Money Launderers. Richard is the Managing Director for AMLCC and FA Sims and Partners. Richard, good to see you again too.
Hello, Neil. How are you today? Can you hear me okay?
Yeah, perfect. Richard, I'll hand over to you.
Good news. Let me get the screen share set up now. Be there in a second. Good. I hope you can all now see, hopefully, get this running.
Perfect.
It's come up now, Neil. Can you see the slides? Is that okay?
Yeah, all good.
Perfect. Good news. Good news. Okay. Good afternoon, ladies and gentlemen. I hope you're all keeping well. I know it's a strange time for all of us, and I'll try and kind of put the business bit we're talking about today to one side of the all the health issues we're all sort of running alongside at the moment. So let's just stick the business we can do from that point of view. I've got about 25 minutes to talk about AML to you guys, what's going on in the world at the moment, and I thought I'd just pick a few things that have been happening and chat them through with you just to make sure you know where you stand. If you have any questions at all, please feel free to fire them across as we go. I'm very happy to pick them up as we go through, very relaxed from that side. Just so you know, don't feel you have to hold back from that side. Who am I, by the way? I run a business called AMLCC, anti-money laundering compliance company, start again. And spent a lot of time over the last, well, probably 10 years going around the UK, doing talks and presentations on AML to many folks like your good selves, and had a lot of fun doing that. And AMLCC itself is an anti-money laundering product. We also have our insolvency business. So not only am I compliance based, I'm also doing the job that is regulated as well. So quite a unique position there, but I'll briefly move on from there. Fantastic, guys. Well, welcome all along the way. Okay, so I thought we'd just have a quick chat about what's happening in the world at the moment, particularly in the COVID-19 situation. How has it affected the world of money laundering and our businesses, of course, how our business changed by that, and a few updates if I can on the legislation and guidance. So you see a few changes there. And what does the future look like? What might we see going ahead from here? Okay, let's start at the very beginning. If we can do, fantastic. This is a very brief refresher. Now, I'll take a view that most of you will know a reasonable amount about money laundering. You may or may not do so. I'm going to start from the very beginning, just to give you a bit of a refresher of what's going on from that side of I can do. Okay, so very briefly, money laundering is pretty much doing anything with the process of crime. What are the processes of crime, you might say? Processes of crime basically are generated from criminal activity. Basically, then the criminal's goal is then to distance themselves where they can away from those criminal proceeds, or to integrate those criminal proceeds into the world as normal. So effectively try and pretend those are genuinely earned assets or income, or to distance themselves from ownership of documentation there. For example, you might have picked up on the Panama Papers and Mossack Fonseca stuff from a few years ago, where basically people were holding assets overseas in disguised names, etc., to get around various provisions from there. So that's just a very quick run through of what money laundering is from that side. Okay. Cool. So what we've seen basically, and I'm picking this up from, this is nothing, this is not inside information at all. This is information that's out in the public domain at the moment. Basically saying we haven't seen much drop in the need to launder money. There's not been much change in the desire of criminals to launder those funds. We've found that there's been a more difficult for cash to move, because you imagine, as you and I may not have traveled very far in the last 12 months, it's been more difficult to that sort of drop the volume down. So it's made it more difficult for people to physically carry cash across borders, internationally, etc. So that's led to the launderers having to be as clever as possible in terms of how they move money around. So suggestion is that's going through integrated into freight, cryptocurrencies, of course, and trade-based money laundering. Trade-based money laundering, in case you're not necessarily familiar with that, that's where basically what would appear to be legitimate buying and selling activities take place, but in fact the margins and the value of assets are being misrepresented or adjusting to allow effectively value transfer between two different locations or two different businesses or entities. Okay, just a very brief version of that. Use of mule accounts, again, you may be familiar with that. That's where basically individuals receive cash from third parties, deposit them as if they are their monies into the banking system. Doesn't flag up necessary an issue. Those funds end up in the accounts of criminals, basically. So again, that's still ongoing now and is a big issue, I think, at the moment. Okay. So this is an interesting question. I look at this, as I mentioned before, because we do this work day to day ourselves. So we're not accountants per se, because we're insolvency practitioners, but we're regulated in the same way as accountants. So we have the same issues to address. So how does remote working, shielding, self-isolation, how does that change the way accountants do their business? How does that affect the way we are at the moment? Now, my concern is, and I'll tell you how we're operating at the moment, we're doing a kind of mix of in the office, out the office, because we've got staff training, we've got various provisions that make it very difficult for us to work entirely remotely. And we've realized from the first lockdown, it didn't work particularly well for us from that side. So we have a mix of some staff in, some staff out. Now I'm talking to you from home today, and I'm largely based from home at the moment because of my workload means I can get more done if I'm not traveling. But does that concern me, that people working from home and people not being supervised as closely as they were in the past, does that worry me that the compliance issues might drop? Well, yes, it does. Of course it does. It worries me that are our systems robust enough to make sure that they can withstand people working remotely. Now, that's the question I put back to yourselves is basically, are the systems in place, the systems you're using, are they strong enough? Are they robust enough? Do you have checks on those systems? Otherwise, are those systems checked to make sure they're working? Are they fed back to make sure that those systems are fit for purpose? So that's the point that I'm really making, that let's make sure that our systems are compliant. Now, that's not helped by another point around, but there's a question just popped up there, which I think Prem is looking for an answer to now. So I don't know if you can see the questions, guys. The question is basically, detection of fraud is a hot topic at the moment. It is the duty of management to identify these issues within the company. Should this become, oh, it's gone now. Okay, I think Prem's answered that one, so that's gone. Perfect. In which case I shall leave that to those guys. Perfect.
I can read that to you if you like.
Don't mind if that is deemed an answer. That I'm sure it is a very good answer, so I'm happy to move on from that one. I'm very relaxed on that, but I can pick it back up again. Don't mind. It's been very relaxed. So if Neil, just shout if you want me to go back to that one. Otherwise, I'll crack on, but happy to fill in where you want to. How's that?
Crack on. We can come back. We can come back to it.
No problem at all. Fantastic. Okay, fine. I'm just keeping an eye on them coming in. That's all. So perfect. Okay. So if we're not working as a team anymore as much as we were, so we're not monitoring things as closely as we could have been from that point of view, it has to be digitally monitored. The system has to take that strain. So that's the point in there. Let's hope we can just keep a close eye on that, because regulators will no doubt be wondering, are you doing everything correctly? Have you adjusted your systems to adjust to this new working environment? Okay. We're also then picking up on the idea of verifying the idea of people. So let's imagine you've got a new customer coming to work with you. You've not met that customer because, let's say, for example, they don't want to leave home. Hey, who's rushing outside at the moment? So they don't want to leave home. They want to basically be able to deal with you remotely. So again, that's kind of part of where we were going to as a sector potentially, because I think there's no doubt that more remote client interactions were going to kind of take place. And there are some practices out there already who are purely remote focused and may never meet clients, specializing in certain sectors, for example. So what happened was that the FATF you might have come across, which is the Financial Action Task Force based over in Paris, global anti-money laundering sort of standard settings body, they put out some guidance. The UK picked up on that, and in particular for our sector, what was then known as the Accountancy Affinity Group picked up on that and issued some guidance for us about how we could respond to that. And why it's important is, first of all, what's the AAG? If you've not heard of them before, AAG are all the AML supervisors in our sector, in the accounting sector. So there's 14 overall supervisors. AAG, I think, is probably just the 13. I don't know if HMRC is part of AAG. Question mark there, but certainly at least 13 of all the professional bodies are members of AAG. Okay, so they issued some guidance which basically said, and it's guidance you need to have a look at if you can get a chance. If you've got to Google this AAG guidance, it should come up. If not, I can let it a link to this back through Neil later on. But basically it says you can, if correctly done, potentially use a video call to verify the identity of a client. Okay, so this is stuff that's come out. This was issued last March, so it's not quite a year old yet. But you need to read, if you're going to look at this and use this at all, please make sure you read through that entire AAG guidance note, because it's quite clear there's certain steps you need to follow, and it's not suitable for certain high risk situations. So it's very much part of your risk-based approach to managing your practice risk for this. So just have a look at that if you get a chance. All the professional bodies, as far as I know, subscribe to this because, of course, they're a part of the AAG anyway. So normally finds that a version of that guidance on their own website if you get a chance. Okay. If it helps, we've been using it as well. So we use it in our firm, and I did such a call this morning with one of our clients with the ID docs to satisfy myself that he was the person they said they were, because that's the kind of the bit. So I don't want to get too much detail about this. This bit is the missing bit, if that makes sense. So if you're verifying the identity of a client, you might choose to do an online check. You might use one of the many online check providers, and that will confirm that the identity of someone exists. The bit that's missing there is the person claiming that identity actually that person? And that's where this video call stroke what used to be physical meetings come in to confirm the person is who they're claiming to be. So basically matching them to their ID docs, government issued ID docs. So that's a very important stage there, maybe trying to replace the physical meeting or the certification process that might have been done before. Okay, moving on from there. again, speaking to a lot of accountants would do across the course of last year, what we discovered very quickly was that people were, mad busy, first of all, doing all sorts of stuff. The kind of pandemic has led to a lot of new pressures on accountants because, of course, suddenly they're doing more business advisory work, more support to clients. They've got involved with applications for government support, financial support, be it furlough, be it a bounce back, civils, preparing forecasts, etc. Self-assessment, self-employed income support scheme, for example. All those things, of course, tended to need help from accountants. Now, what I heard from a lot of accountants was they're almost giving that time up almost for free in the first place. Now, I'm perhaps being over summarizing of that because obviously people would look to recover those fees, but they were running around, and you're all running around really fast, really hard to get this stuff done. And my concern in that, again, is we come back to that first point, is there a risk that when we're all mad busy, the risk is we drop our compliance requirements. We don't consider what's going on around it. We don't see the obvious sometimes. Okay, and I'll pull this back into context in the next couple of slides if I can do. Okay. Right. So this, in fact, the next slide. My apologies. So straight to the next slide about this one is about this government support and the fraud around the government support. Okay. Now we go back to my first slide about proceeds of crime. Now, if you as an accountant are operating as an accountant in practice, an external accountant in practice, so you are regulated for AML, you have an obligation to report to the National Crime Agency if you come across criminal activity or even a suspicion of criminal activity. Okay, that will come to the Proceeds of Crime Act. You may well be familiar with that. So if you're finding that you think, and I'm not suggesting this is happening all the time, but be aware of the fact if you come across something you feel someone has criminally obtained money backing support from any of these government schemes, then it's a problem. You may well need to be considering reporting that to the National Crime Agency, because otherwise, if that comes to be found out later, you may well find that you are in fact potentially being a party to that fraud if you haven't actually done your report correctly. You haven't considered this issue. Okay, so please have a good open eye to all the applications for this stuff. What will happen, in my view, is that things like the bounce back loans, furlough fraud, furlough schemes, etc., they're going to be really in the spotlight. I think potentially up to 5 years, there's going to be an ongoing investigation to all these lending, all this borrowing, to work out where it's gone to, who's had it that shouldn't have it, who's been in trouble for that. So just be careful you don't leave your back door open by not picking up on something you should have reported or something you should have considered. So I'm just really saying, be careful around the government support stuff. Be careful that you have not seen anything that seems unusual. Someone obtaining a bounce back loan for £200,000 when their turnover is £25,000, for example. The really obvious stuff, just be careful you don't miss out for that. And also be careful that some new clients you might have come across your desk, you may or may not take them on, are being set up purely to do illegal stuff. They're purely being set up to take advantage of the government schemes. And look out, of course, for payroll things as well, people setting employees up that never existed. Just look out for all that stuff. I know it's an extra burden on you, but I think this issue will run for many years, and let's not make sure we're not being dragged into that by, just to say, leaving the back door open. Okay. What else are we looking out for? We've got clients who are going about their business as far as we're concerned. They're running around trying ever so hard. Some businesses are doing really well from COVID-19. I know that's perhaps a minority, but lots of businesses are. Some businesses are struggling through COVID-19, and we'll all have that mix of clients. Maybe we specialise in certain sectors. Who knows what our areas are. Look out, though, for those clients that don't look to be performing in the way you would expect them to, okay? Because the suggestions that there are, in fact, money launderers looking to place funds elsewhere to legitimise them in the way of potentially making payments to companies that wouldn't otherwise have had income, maybe making deposits, cash deposits on work, whatever it might be. So, and the potential suggestion also there may be lending, so what you might call, unregulated lending taking place to companies who are struggling, who maybe couldn't get a bounce back, or couldn't get civils, or running out of cash. And this borrowing is coming in an unregulated fashion. Those funds may well be laundered funds. They could be proceeds of crime. Those funds have been invested and they're looking to wash them through these businesses, either by way of putting money in, taking them out, or by way of putting borrowing in and getting it back at a reasonable rate, probably. But the point is the money comes out clean, is what we're saying. And so just look out for all that sort of things around there. I've mentioned the government-backed stuff already. So just look out for stuff that doesn't really make sense, because that's your job at the end of the day, isn't it? You've got to keep an eye out for this stuff. You've got to look out for the unusual, you know, because that's you're there to look at that. If you've got two clients in the same sector, one's doing really well, what's not? What's happened there? Why's that? Why is that? So just keep on your toes, guys. All I'm saying, guys and girls, just look out for that. Okay. Question just popped up. Hello, Tony. How are you today? Providing a SAR in case of incentive fraud is given, but should accountants consider additional action? Providing incentive fraud. I'm not sorry, Tony. My apologies. The incentive fraud bit is bemusing me slightly in terms of the context in which you're seeing that in. So apologies for that. But the answer is, should accountants consider additional action? Well, I think the SAR report, first of all, is going to satisfy the AML perspective. Whether you as a firm then chose to continue to work with the client after you made that report is another issue. You could consider a report to action fraud, you consider a report to HMRC, but from an AML perspective, that SAR report is your protection. That's very important. You consider that and do it when necessary. Okay. Very conscious of time, guys. Again, we have apparently we have 10 minutes to go. We should be fine, guys. Should be fine. So just going to dive in now also to national risk assessment. Now, those of you who like a good read will no doubt have been through the national risk assessment in great detail and thought how amazing it was. Personally, being slightly flippant, actually it's a really good read. If you have any interest in AML at all, and you've not read the December 2020 national risk assessment, you want to begin to get your understanding of AML, maybe don't know much about it, read that through. It is a fantastically well put together document in my view. It's the third one. The first one was 2015, 2017, end of 2020. That to me, the latest one is the best by some margin. Definitely worth a read if you get the opportunity, if you want to bring yourself up to speed with stuff. Okay. Part of that national risk assessment sets the government's kind of opinion of the UK as a whole, global risk, etc., and then comes down to individual sectors. Now, the accounting sector, unfortunately, has come out as high risk again. Okay, so the third time we're basically being shown as a high risk for money laundering, I suppose, is money laundering. Low risk for terrorist financing, so that's not unusual. You don't see a lot of activity in that area in our sector. That's not to say you shouldn't be looking out for it, of course, but do keep an eye on for that. But high risk money laundering exposure. Okay, a number of the issues that have come up are largely repeated from the previous years, and some of those issues will never be able to be addressed, in my view. But we'll come back to those in a second. Let's pop on to those issues and see what we've got from there. If I can, make my mouse back up. Okay, right. So compliance. Okay, we need to be conscious that we need to do our bit for AML. Okay, it's not that big an ask in my view, because actually it's such a good thing to do, good intention piece of legislation, and very valuable to us as a country, as a sector as well. So there is no excuse for poor AML compliance, full stop. You know, that's it. And the supervisors are all tasked to do, whoever your supervisor is tasked to make sure your compliance is up to scratch, if not far better, in my view. It's not difficult to do it, should be achieved, in my view, should be there and should be fine. But however, they are suggesting that compliance as a sector, there are evidence of poor compliance to AML within the sector. I'm not saying everyone, plenty of people doing very well, absolutely sure they are. Let's just put this in context very briefly again. We've got this OCBAS, which I mentioned later on the slide. OCBAS you might have come across before, basically government body whose job it is to supervise the AML supervisors. There is a bit of a inconsistency between perhaps OCBAS and the supervisors, in that I think what sometimes is not recognised is that the supervisors actually are doing the work to make this happen. I know that OCBAS has a role to do to say, have you done it? But actually the work is being done by the supervisors, the work is being done by the members of those supervised bodies. Okay, so it falls to all of us to have our part to play in that. Okay, what we will struggle to deal with as a sector is how do we deal with those who are not regulated for AML and choose not to be? Because if you're not a member of a professional body and you haven't registered with HMRC, then how are you tracked down? You might say, well, they could, of course, register as a tax agent. That's a possibility, of course. So there's a potential gap that could be plugged. Don't know. But generally, if someone sets themselves up as a bookkeeper or accountant and doesn't bother telling them about it, who's going to find out when? So that's a big question that may be difficult for us as a sector to overcome without basically restricting the use of those terms, bookkeeping, accounting, etc., in doing so. Okay. There are unfortunately some accountants who are complicit in money laundering. They're actually actively doing stuff to help money launderers and running practices for that very purpose. I'm hoping that's a minority. Liquidation falls across my desk there a bit. There is a concern that people are laundering money in a company and then try to drop it into liquidation at the end of it in the hope it doesn't get picked up. But there is quite a robust investigative duty on liquidators, so we do look at that from that side. And then there's this issue about inconsistency between AML supervisors, okay, which we understand as being a potential problem there. But of course, OPBAS and all the supervisors are working hard to get that right, I suppose. Okay. Very conscious of time. I'll flick this on quite quickly now. This is my experience from talking to accountants in the sector. The most likely thing you're going to come across is tax evasion. Okay, I've just picked up the definition for the National Risk Assessment here for your benefit. I think we all know what it is, okay? And I'll go on to explain to the sort of the extent to which this is the case, okay? HMRC have a view of the tax gap. They think it's actually, this is 1819, 4.6 billion pounds of tax gap. That means money that was not paid through intentional tax evasion, okay? There's a further 4.5 billion pounds from criminal tax, for example, smuggling, etc., where revenues are not paid on the duties are not paid on the import of goods, etc. So again, it's a big figure, guys. Just be conscious of that. Be aware, and it's interesting, given the pressure we're all seeing financially and have seen in the last 12 months or so. Does that mean tax evasion might be more of an incentive to people? Question mark. I'll leave that for you to think about. But just keep your eyes on the ball, guys, if you can do, please. It is a, guys and girls, it is something that is really happening. It's a live thing. Don't get yourself in the end of one of these cases where you, in fact, haven't spotted it or haven't dealt with it. Okay, haven't made your report if you needed to. Okay. Some real nice sort of thoughts here. And this is again from experience, from discussions with accountants. When they come to me with a query, they say, "Oh, we've got this situation. What do you think?" The biggest risk I find is people trying to help other people, and that sounds stupid, but doing someone a favour. Oh, I'll help them out with that. And I'll give a very brief example of this, bearing in mind we're very short on time now, which is a friend of mine, in all fairness, came to me with a question. He'd been approached by someone from overseas who had been working in the UK. They needed to get a tax refund. Apparently, the tax refund had to come to an accountant's client account. And the accountant was willing to receive that refund from this individual who'd been working in the UK briefly, who was not a client of theirs, put it in their client account and paid over back to the home nation individual. Now, to me, their initial thought was, oh, I was trying to help the guy out. To me, alarm bells everywhere. I'm hoping most of you are seeing that as alarm bells as well. Look out, we don't try and accidentally bend the rules by trying to help someone out, okay? Stick to your compliance rules every time. Have your thinking head on. Look out for that voice saying to yourself, are you sure? Are you sure you should be doing this? It's the same thing you think about when you're looking to your NCA reports, your SAR reports. Look on it, have someone looking over your shoulder and mentally looking over your shoulder saying, are you being a fool? Are you missing something really obvious? Should you even be questioning this? Okay. Just a quick brief touch on these bits briefly now. We're almost there, I think, guys. So I'll be literally a couple of seconds now. The EU money laundering exit regs, quite important for us, came in 15th September 2020, 21 days after that. You may or may not have picked up the PSC discrepancy reporting has been changed to only when you establish a business relationship with a client, not to all the time. That's in there. That's also picked up later on in a second. And there's also some later bits there in regard to trust. So if you get involved with trust at all, pick it up later on. Okay, look out for trusts and be aware of what's going on with that. Okay, a couple of bits here which we kind of touched on this morning. Sorry, a bit earlier on about this. Someone claiming the identity of someone. Are they actually that person? Okay, really important from that side. And they brought a little bit of depth into that by saying it must be to a degree that is necessary for effectively managing and mitigating risks of money laundering, terrorist finance. Kind of useful, but just helps to say to yourself, how are we doing that? Okay, this is where, again, the traditional providers of online identity reports do not address this issue in my experience. Okay, so look out for this, make sure you are addressing this issue. Okay, very briefly now, we've got the AML gas, which was issued in January last year, which has not been actually stamped by the Treasury yet. That should be quite soon, I understand. So look out for that. Okay, that's got a few bits in there that will help us. It's already been updated, those EU exit provisions I mentioned. So well worth having a look at that when it comes out. And I shall update. I think I've got a couple of articles sat on Accounting Web on this, so I'll update those articles when this comes out to make that up to date. That comes through from there. A couple of points to pick up on there, which is about the agent training. There was a basic reference to needing to train agents in the new regulations back in 2020, early 2020. It helps us to understand it. Basically, an agent includes a person who, whilst not an employee of the business, is engaged to carry out work or provide service on its behalf. So you could be, in that case, in my view, if you're outsourcing your work to a third party, if you're using an overseas third party, for example, look out to make sure you're ticking the boxes for AML training from there. Okay. Okay, things to look out for very briefly. You're not really seeing your clients so much potentially. You've already seen a bit of this, so look out for that. How are you going to address it? How are you going to manage your risk? Okay. You may only see your client's documents online. You may never see a physical document. So again, how are you going to address those risks? How's it going to help you? Okay. Does the client really exist? If everything's received by you digitally, is it actually there? Is it a real thing? So again, more risk coming from that side. Look at the Company House reforms. It's going to help everyone there with the beneficial ownership stuff on Company House reforms going through. That, folks, is it. I'm sorry it's been a whistle-stop tour. Thank you ever so much indeed for your time today. I hope you enjoy the rest of your session. I don't know if Neil, you've got time for a couple of questions, or whether you're happy to move on to that. Very excellent from that side.
We've got one question that's come in from Graham. Why are accountants so poor at putting forward SARs?
Well, there's a long answer to that, which I'll try and keep as brief as possible. What the industry, in my view, is not picked up for is the amount of work it does to prevent money laundering. So, and it's set out AML gas that if, as an accountant, you come across a matter that you're concerned your client may be about to make a mistake, shall we say, and it is an error, and it was all detailed out there, you can ask that client to correct that error, provided it doesn't fall into certain broader or more defined categories. The client then can correct that error, then there's no report to be made because there is no offence taking place. So in my view, I don't think we always get the credit for how much we prevent by just saying, oh, you shouldn't do that, don't do this. And I think that's one of the reasons why we get that. Bearing in mind, again, if you look at it compared to other sectors where they're automatically producing these reports, ours are very much thought about and discussed and individually selected. I mean, when I ever make it, I'll make a report on our business. I'm relieved to make it, so I'm always glad to make a report because it keeps that pressure off me, but I'm also looking very closely at it before I make that report. Slightly different for us, of course, ours is retrospective insolvency work, so we don't have the ability to correct those errors. It's been and gone. How's that?
Thank you. I think that's all we've got time for, Richard. Thank you so much. Great to see you, and we'll be in touch soon.
Look after yourself. Take care. Thanks very much.
Thank you.
Thank you.
Karen, I'd now like to welcome Karen Young, Director for Hayes Accountancy. Hi there, Karen.
Hi, Neil.
Karen's session is entitled Jobs for You, the state of the current job markets for accountants. And I'm sure there's lots of people tuning in for this one. So Karen, I'll hand over to you and I'll start sharing your slides shortly.
That's great. Thank you. So good afternoon. I'm delighted to join you today at your conference, discussing what the future of accounting and finance looks like, and indeed what is the new normal. My name is Karen Young. I'm UK Director for Hayes Accountancy and Finance in the UK, and I'm the strategic lead for a team of about 300 finance recruiters at Hayes, who help someone to find a great job in finance around about every 10 minutes in the UK in normal conditions, and I'll come back to that shortly. A little background for those who don't know me, or perhaps haven't seen my Dear Karen column in PQ magazine. I have over 24 years of finance recruitment experience, and people tend to count on me for help with CVs, interview guidance, career planning from a personal perspective. And I guess I've become somewhat of a trusted advisor on industry trends and market insights in the accountancy and finance job market here in the UK. So what am I going to cover? If you could move on, please, for me, Neil. This is what I'm going to try and cover today. We do have a great position at Hayes to be able to provide you with insights in real time of what we're seeing in the job market. And it's a bit like what's known as a crane count, if some of you have come across that in the construction and building sector, that you work out as you arrive into a city by train or car, how active new construction projects are, because you count the cranes and you kind of go, God, that's really busy. Well, we interact with hundreds and thousands of people every single day. organizations looking to hire great talent, and individuals looking for that great finance job. So as you can see in front of you, I'm going to share some of what we see with you today. I'll share with you some headlines from our brand new Hays Salary and Recruitment Guide for 2021, which just came out a week or two ago, and will be made available online. This also enables us to look at what skills may be changing in terms of what employers are looking for in the people they hire now. So we'll have a look at what job searchings look like during COVID-19, skills in demand and what's changing in this new normal. And finally, I have just taken the opportunity to pick out a few short tips on CVs, interviews and social media, particularly in relation to what may have changed or be changing in these areas kind of post or COVID-19 pandemic. And I should add that my view is largely UK focused, because that's the area that I'm responsible for. But if we do have delegates who've joined us today from overseas locations, I think there are a few, you'd be most welcome to get in touch with me, and my details will come up on the final slide and after the conference, and I can try to put you in touch with a recruiting expert in your local country or territory. So if we could move on to the next slide, please, Neil. For those of you that don't know anything about Hays, we are the world's largest professional recruitment company, operational in 33 countries. And in the UK and Ireland, we have over 90 offices. And on the left, you can see how many people we help. This was in a normal year, it was pre-COVID, to find temporary or permanent work. And accountancy and finance is one of the largest parts of our UK recruitment business. And within that, as you can see on the right-hand side there, we offer a pretty wide range of services. So what is the job market doing in the UK? If we can move on to the next slide. Has any recruitment been happening? I don't know what your answers are because I can't hear you, but I mentioned earlier that my team helped to find someone a great job in finance in the UK about every 10 minutes in normal conditions, and we've certainly not had a normal year. Well, during the early stages of the COVID crisis, so if I think back to March and April in particular in 2020, it dropped to about every 50 minutes. But we were still recruiting. And right now, as it stands today, we're back to finding someone a job around about every 15, 16, so 16 minutes. So you can see where it dropped to, but you can also see the recovery that we've had. And there are great new finance jobs registered for employers every single day. Not quite back to February 2020 before it really hit us, but definitely en route to it. And I hope that's good news for all of you listening, whether you are someone that might be looking for a job soon or in the future, or indeed an employer. It's good to know that the job market is in a good place. So if we can move to the next slide, I'm now going to take you through just to look at some of the headline findings for accountancy and finance, specifically from our brand new Hays Recruitment and Salary Guide. To give you a brief overview, you can see there on the screen in front of you, but this is the 7th year that we've produced this guide in this particular way, and it covers 15 specialist skilled and technical areas. Accountancy and finance is one of those, and it's supported by regional data for most job roles. And I'll give you some details at the close of this section on how you can gain access to the full information and request a copy. So about 23,000 people responded to this, and there were nearly 4,000 responses from that number who work within accountancy and finance, employers and employees across various sectors, specialist areas, organisation sizes and different types from all across the UK gave their voice to this. And this year, kind of more than ever before, the insight is what we all need to help guide our decisions in this new era of work that we're in. So I'm just going to take you through some key headlines. If we can move to the next slide. So recruitment plans do remain in place. 54% of accountancy and finance employers in telling us that they're intending to hire over this coming year. And areas of accountancy and finance where recruitment plans highest include within professional services, so tax and treasury and public practice, all the job roles within that and the talent pipeline, qualified accountancy, part qualified accountancy and payroll. But what employers tell us is they are still experiencing quite acute skills shortages. They certainly did in 2020. And what they're telling us is that is negatively impacting on productivity, the ability to deliver projects, and actually also, really importantly, given what we're all going through, on employee morale. So half of employers said they have found it difficult to recruit permanent staff over the last 12 months, and just under a third telling us that they're struggling to recruit for temporary staff as and when they need to. So if we could move to the next slide, please. I've decided to focus this a little on skills. as the world has changed, so have the skills that employers need the most, but finding them is going to be a key challenge for employers to overcome in the year ahead. So what skills are the most in demand? In terms of the more technical learned skills, not a surprise, most are in need of finance skills, good administration skills, and operational skills, which is quite broad ranging. But more importantly for me, that the top soft skills in demand, employers telling us they need communication and interpersonal skills, the ability to adopt change, and that is a new one in the survey this year in terms of making these top 3, and problem solving skills. So I think as we all think about what we're doing in work and in our personal lives, they're probably pretty important skills to have right now. And the speed with which businesses, organizations have had to adapt to new ways of working in light of COVID is really likely to have made that ability to adopt change such a high priority, along with the wider transformation that's impacting the accounting profession in many organizations, and a little more on skills later, actually. So if we could move to the next, there's just a little bit on numbers. As you can see in front of you, the overall average salary increase came out at just under 1%, so less than last year, and a little bit disappointing, if I'm honest. And it was slightly below the overall increase that we saw across all of the professions, which was 1.2%. But don't let this mislead you too much, because within accountancy and finance, some areas saw higher demand for talent and salary increases above that average. And you can see some of that in front of you: accounts receivable, payroll, part qualified accountancy, treasury, public practice roles as a whole. And we also do need to bear in mind that quite a few directors and executives of organisations, as we've read about, I'm sure, took executive and board level decisions to take pay cuts during the COVID crisis too, to help support their organisations and businesses. And all of that must be considered, because a finance director or CFO would have been one of those who might have tended to be part of that executive decision to support their businesses through obviously what was an unprecedented time. If we can move on to the next one, when it comes to considering moving jobs, COVID-19 certainly is acting as a catalyst, a motivator to change, if you will, and especially by those who are feeling maybe frustrated by its impact on your career progression, but also maybe as an inhibitor for employees who feel it's too risky to move at the moment. And there is a little bit of sentiment out there with regards to actively job searching and people being a little bit worried about it. Certainly when you have conversations with individuals one-to-one, and certainly when it comes to friends and family and them having a view on whether you should move or not. But generally, accountancy and finance employees told us that they're still planning to consider moving jobs, with 53%, as you can see there, anticipating a move in the year ahead. Now, it's actually not that much different to last year. And interestingly, the most movement out of the different parts of accountancy and finance seemed to be looking as if it was going to be coming from credit control at 60%. So not too different to 53, but if you're an employer, head of finance, a financial controller, a finance director joining today's session, just something to bear in mind. So why are people wanting to move? That's obviously a key question. Largely, this hasn't changed too much really with the 12 months that we've gone through, but largely it's because of a perceived lack of future opportunities. This is followed by salary or benefits, money does talk, and also concerns about job security. So perceived lack of future opportunities. So how an employer articulates where someone's career might go, and making sure that there is discussion and communication about a plan is really important, again, if you've got an employer hat on today. We can move to the next slide. I have chosen to pick a piece around remote working and work-life balance, really key for well-being and mental health, which are obviously really important for everyone at the moment. So the move to remote working for many since March 2020 has shown mixed impacts on work-life balance. So our survey results show that while some professionals have seen their work-life balance improve, others have seen it worsen. So it's probably no surprise that, a year grappling with remote working, If you're a parent forced to juggle kind of childcare and homeschooling on top of professional commitments, for example, or caring in other ways, the most important factor to accountancy and finance employees when considering a new role, apart from salary, is work-life balance. And this is something that's been coming to the fore in our survey over the last couple of years now, but I think certainly COVID will have accelerated it. So employees are now looking for new benefits to support their well-being. This includes things like additional days off for well-being, hybrid working. So employers are really needing to look at their benefits packages and probably will need to make some changes in light of the COVID-19 pandemic, so that they can better reflect the benefits that employees now most want. And this is indeed the new normal that we're working through.
What? Oh, for money.
Okay, so I've only given you a few key headlines. Sorry, I had a bit of noise disturbance there from the findings, but just to sum up what we've seen, there's some recommendations that we're making for employers. It's clear that employers still need to ensure they've got access to talent to be successful in the year ahead. So these are sort of recap of recommendations. Upskilling, vital. Employers told us they're facing skills shortages, and things are changing so fast that the skills are changing that people need. So tapping into people's existing willingness to learn and develop their skills and have personal development, and it will help in obviously retaining those people too. And part of this is going to be ensuring that people understand the skills that are most needed to be successful in the new world of work. So adopting change, we've mentioned project and change management skills. I'll come on to this shortly. But there's many ways to support the upskilling of your workforce, and we recognise the need for upskilling right at the start of the pandemic, certainly during lockdown, the 1.0, and that led us to set up a free training platform called Hays Thrive, which helps employers give their teams the skills they need. So if anyone wants info on that at the end, please do reach out to me. Secondly, how we work and how we recruit has changed. So looking at the remote working piece, recruitment, onboarding processes, and getting those right is really key. And thirdly, after a challenging year, has shown a little impact on certainly pay increases. Being really transparent and ensuring that there's clarity about how pay structures are set is really going to help improve salary satisfaction and staff retention. So this can be showing how promotion structures are agreed. How can people do better? And publishing pay levels within your organisations where you can would help improve transparency. Fourthly, long-term hybrid and remote working policies, really important. At Hays, we have an interim policy in place, or we did have before we went into lockdown, which will come into play as and when we can return to offices, but we'll be looking to put in our formal working policy in place from the end of our financial year, which is 30th of June. So it's something we are looking at and exploring all the time at the moment. So, with the door open for more employees than ever before to work remotely, which is going to be pretty hard to shut, the genie's out of the bottle, then as an employer, it's considering what impact that has on hiring, but also as someone, in your career, how's that going to have an impact in how you work and how you work at home? Really important. And flexibility is really key here. One size doesn't fit all when it comes to all organizations or even the different departments within one organization. So it does need time and attention. And lastly there, the importance of obviously work-life balance and well-being. The stresses of this pandemic have taken their toll on everyone, on working professionals, on everyone, and it's changing what people want out of their job. So looking at the benefits package, as I mentioned earlier, and possibly extra days off for well-being. So just a quick glance on the next slide just tells you how you can access and request a copy of the full results. So hays.co.uk/salary-guide. If you just click to the next one, Neil, and just bring that up, and that's how you would access the guide. Okay, so on to a bit more specifics in terms of the job market in the UK. I mentioned earlier that my team were helping someone to find a great job in the UK around about every 10 minutes, that it dropped to about 50. and then we're not quite back to February, but it's en route to it, which is good news. So if we click to the next slide, I've just got a few bits of data here to share with you what we're seeing in the job market in terms of key job titles and locations and industry sectors over the last 6 months. So you can see finance manager, credit controller, finance business partner, management accountant have been very much in demand as usual. COVID hasn't changed that. And indeed, all of the job titles on there that cover a range of transactional, part qualified, entry level roles for students and graduates and qualified accountancy roles are usually up there. So COVID hasn't changed that much. Don't worry, London hasn't disappeared off the face of the earth. I typically remove it because it skews my bar chart too much. London has by far the most volume of job registrations for accountancy and finance jobs. It still does, but I've taken that off. So London at the top, and then just to show you some of the other major centres that have been active in terms of finance recruitment. And it'd be likely that there'd be one of these locations, hopefully not too far away from you unless you're overseas, but many other locations are obviously active too in the UK. And then finally, sector. Really interesting for me that retail still seems to be very active in terms of requiring hiring of finance skills into those organisations. And the type of roles do vary quite a lot, actually, if you go into the detail, but quite often they are more data focused, people to work with big data, part and qualified skill sets, analytical roles, finance analysts, finance business partners. We all know in retail, if you change something on the shop floor tonight, it can affect your sales tomorrow, and that kind of real-time information is key. So obviously when they've been having either busy times or challenging times, depending on what they retail, that's been pretty key. Not a surprise to see tech and software firms up there too. Perhaps more of a surprise to some of you to see travel and leisure, but then organisations are having to go through major transformation sometimes to survive, and skills are needed, and also planning for probably a pretty huge upturn as and when we are allowed to pack our suitcases and go off and travel further afield. And indeed, the same probably applies for the pressure on charities and not-for-profit organisations. The pressure has become very great, so different skills are needed, hence requirement to hire. So that's what I thought was quite interesting. And then just glance on the next slide and you can click straight on to the one after that, Neil. I thought I'd just show you a snapshot of some of the jobs that we've been hiring at Hayes Accountancy and Finance recently. By no means is it all, but it shows you the vast range of job types and titles there in front of you now. So you can see from credit controller to CFO, audit senior to assistant accountant, corporate tax manager to company accountant. And these are in locations the length and breadth of the UK. So I'm big on my alliteration today. What can I think of? Guildford to Glasgow, Bradford to Belfast, Chelmsford to Cheltenham, all types of organisations, from the very small to the medium to the large corporate, and in public sector and not-for-profit too. And as I mentioned about the charitable sector just a moment ago. It's also worth noting the strong demand for talent pipeline we've seen from the practice firms throughout the very early stages of the COVID crisis, through the recovery in 2020 and continuing strongly in what we've seen so far in January and early February 2021. Every week bar one that I can remember, it's been one of the strongest volumes of demand from an industry type, if I may call it that. Manufacturing, tech, software, engineering, construction, local government and housing have always been up there pretty regularly too, just changing kind of their order of position. And I do find that it's interesting because I remember in the middle of the recovery period, it can vary from one part of the country to another. In the summertime last year, it was all about manufacturing firms in the East Lancashire area. If I think to Burnley, there was a real need for accounts payable skills from manufacturing businesses that were manufacturing into the supply chain for COVID. Same time in the Thames Valley, it was about the tech and software firms, and their demand was for part qualifieds, undoubtedly. So if you're a student listening, and I think there's quite a few of you today, hopefully, there's some strong kind of advice in here, and that is about being sector smart and thinking about where demand is more likely to be. So if you're beginning to think about or are already applying for jobs, or indeed you're sending off speculative applications, there is a certain amount of thinking, well, who is most likely to be hiring? And that might help you obviously secure that great first role as a graduate or preparing to be a graduate. Okay, so skill sets. What are we seeing happen in terms of skill sets, and what's the new normal? If you can skip past the next slide and onto the one after, please, Neil. So what you can see in front of you is a slide in which I've pulled out some of the attributes, the competencies, the softer skills of a great finance professional. What makes up the DNA of someone that's really good at their job in accounting and finance? And there shouldn't probably be any surprises there. You'd expect someone in finance and accountancy to be a problem solver and accurate and detail orientated. So those are kind of key elements. In the dark blue, if I'm not sure if that reveal is going to work. If you could click again, hopefully it will. Might not do. Yes, there we go. In the dark blue, you start to see competencies that come up, and I've picked these off multiple person and job specifications out of the thousands that we see come into our business. Are the skill sets and competencies that you would need to be developing or already have if you were looking at applying for a management or a leadership role. So the strategic elements, the ability to motivate teams because you're likely to be managing staff, the change management, but that actually is coming further sort of through into other positions now, not just management and leadership, and kind of commercial nous, to use a really northern term. If we click again, what you should see now in front of you should be some the blue again, click again, and then once more, please, Neil. It should be some words in green. And this is the interesting part, because these are the skill sets that are starting to come through from real life person and job specifications. And these are changing. Now, they were already starting to change pre-COVID. I've been talking about this for a little while, but it seemed a good opportunity to talk to you about it today. So digital literacy, critical thinking, cognitive thinking, interpersonal judgment, social dynamics, creativity. And these are really important, because particularly creativity, it's coming up an awful lot. And I wrote a blog on it some time ago. But the ability to solve problems and provide creative, innovative solutions is absolutely critical at the moment. And I don't want anyone to be caught out at an interview by someone maybe asking the question, tell me about a time when you've used your creativity to come up with a solution to a problem. And for anyone who's listening to be caught like a rabbit in headlights, you should be ready for that question. And just to be clear, it's not about creative accounting, it's about your creative competency. If you're an employer who's been used to a certain set of questions when you're recruiting, have you thought about this? Have you thought about what's changing and what you need to add to your job and person specifications, given the changes in the world of work? And are you making the changes? Are you thinking about what is most important other than the technical skills to hire? And also, very importantly, are you thinking about how you will assess the types of competency-based questions that you'll be ready to ask fairly and consistently to each applicant in an interview and selection process? And if not, then my advice would be that you should be. So that's a little bit on skills. And then now on to a few tips in terms of job hunting during COVID-19 before I draw the session to a close. So as I prepared my thoughts for this session, I thought about how I've been feeling, how people I work with have been feeling, friends, family, customers. And it's safe to say that I'm sure that all of us will have felt some of the emotions in the dark blue on the left, and some of the emotions, I hope, on the right-hand side as well, because COVID's unlike anything we've seen in recent history. It has dramatically changed our day-to-day lives, and it's changing how organisations and professionals have had to adapt to this new world of work and take on new challenges. But there are whilst there's been challenges and it's been pretty stressful, yes, there are also some positive things that are coming into the world of work. And I think this kind of the human factor element of that is really important. I don't know about you, but I genuinely think when people now say, how are you, Karen? I feel that they really mean it, and that they're really listening to what I've got to say in response, and are genuinely concerned that, I'm actually okay. So I think these are things that are coming into the world of work, and it's given us a bit of a wake-up call really for us in terms of what matters, what really matters in our lives, and a perspective change of what's important in your working life too, and what you want to prioritize now. So I just sort of sense on that from an emotion perspective. If we click to the next slide, different ways in which our attitudes to work could change due to the pandemic. These are softer topics than obviously your presenter previously, but they're really important. As we've celebrated the fantastic work our key workers have done around the world, we've certainly seen sentiment coming through from people saying, I want to give something back. I want to work for a more purpose-led organisation. So people are seeking out that when they're looking at whether they apply to an organisation. So note to self, if you're an employer, how do you demonstrate that? Certainly, we've already talked about a renewed focus on work-life balance and flexibility. The mental health piece is huge. And there's demand for greater humanity in our workplaces. And I genuinely hope that stays. People who are, have had to experience furlough and have taken that time to study and upskill will have retained a thirst for more learning. Very apt, obviously, with the university connection today. And thanks for obviously working with PQ Magazine and hosting the conference. And then the rise in side projects. So again, some people have worked out that they still like their job, but there's actually a passion, a hobby on the side. And we will see more people probably running these side projects. It's not, another job to do in the evening. It is a passion usually that people have. And some people will have made decisions to make complete career changes and reskill and retrain in certain areas. So I think those are really interesting just to have a look at. And again, we've got quite a few blogs. If you chose to follow the Hays UK company LinkedIn page, there's quite a lot of information that we share on there. So some top tips on career moves during COVID-19. I'm conscious of time, so they are fairly straightforward in themselves if we move to the next slide. Certainly, one of the first things is obviously about confidence, but whether you were starting to look for a job during COVID-19, you're starting to look now, you think you might look later in the year. What's really important is to remember what I've been saying about that we are recruiting, that there is actually a pretty strong professional job market out there, and it is possible to find a job during this time. And our CEO, Alistair Cox, says the world is going to need talented people. That hasn't changed. So being confident is really important. If you are confident, and it's a way of, the more confident you are about your career as you look for a new job, the more effective you're going to be in your job search and in terms of marketing yourself. So a good way to look at that is looking back at your accomplishments, your achievements, your successes, and just building that kind of confidence in yourself. Being open-minded when you're considering opportunities is really important at the moment. So it might well be that next upwards career move isn't there right now, but what could be really beneficial for you could be a horizontal career move. And I mean sideways into a role that could build you a skill set that maybe you don't have at the moment or that you need more of. So like a finance manager, maybe they've got a really strong skill set in management accounting and profit and loss, but the job that they aspire to have in a few moves' time might be their first go at a finance director role. You're looking at job specifications and you realise that you haven't necessarily got those skills of preparing statutory accounts and managing the balance sheet. So to do that, move across into a more technical financial accounting role, a horizontal move, and it might not take you immediately into that role, but it will then give you the chance to obviously make that upwards move once you've developed that skill set, just to give you an example. What else would I pull out? Reflecting on what you want from your career, I've touched on already, and demonstrating your soft skills. We've just been talking about that in the DNA of a finance professional and what things are changing. So the upskilling part's key, and then updating your CV for the new year of work. I've got one slide on that shortly, so I think we can probably move that on again with the remote interviewing skills. But do stay positive and look after yourself is really, really important. And talking to a recruiter like me, we do have usually an objective view. Okay, so last few minutes, few tips, CVs first. I could do a whole session on putting together a good CV. So what I've chosen to do is rather just to focus on what would I be doing different in my own CV right now. And there's not an organisation out there, I don't think, at the moment who can say they're not going through any form of change project or indeed larger scale transformation project, whether they're small, medium or large, public, private sector, public practice firm. So an employer will be looking to see more of this change management skill set, for example, more clearly on a CV when deciding whether to interview you or not. I'm by profession a recruitment consultant. I help people to find jobs. I help organisations to find talent. But right now I've got two major change projects I'm leading for our business at Hays in the UK, kind of on the side, if you will. So it's likely to remain like this for all of us for some time. So think about this and think about how, if you're a student, how are you taking steps to develop as many transferable skills of this type as possible, taking in mind what I've mentioned a few moments ago. And if you're already in the world of work and you don't have enough of that experience, be alert and make sure that you put your hand up to get involved with projects as and when you see the opportunity. Do not let the opportunity pass you by. And remember things like ability to work independently, creativity, ability to change, ability to adopt change, flexibility, adaptability, problem solving. These are all key and they should stand out on your CV. And on a more technical or learned basis, anything tech or digitalization related is key. So Kaplan, the training provider, gave me an example the other day that if you're an employer who usually took on 2 AAT students a year, then try and take on 2 AAT students and maybe a data technician for the 2021 intake. So the digital courses that focus on the skills that maybe historically weren't covered so much in the traditional accountancy qualification. So, you know, what do we need? Manipulating and linking different data sets, tools like Excel to look at patterns and trends in data to help people like me, summarizing and explaining gathered data to non-finance people, and storing and managing and distributing data in line with kind of data security standards and legislation. So those are the type of things I'm talking about here. Interviews, to the next one. A year ago, would I have imagined where we would be now? That we'd have helped hundreds, thousands of people to find jobs through various lockdowns and social distancing restrictions, that people would interview purely remotely, be offered and indeed accept a job without seeing the office, what's that, and meeting their boss to be, and that some of those people that we have helped have still not actually met their boss in person, but they're loving and enjoying the challenges that a new career move should bring. I wouldn't have believed you if you told me that in January, even February 2020, when this all started. So what have we learnt? What are my tips for virtual interviewing? I think, you know, my first tip would be that ultimately the good practice that you would have on a normal interview face-to-face, if I can use the word normal, are still absolutely there. So doing your research, looking at your person and job description, coming up with your competency-based examples that demonstrate the competencies that are on the job and person specification are absolutely key. But the top practical tips are ensuring that as quickly as possible, when you know you've got an interview, you find out what tech is going to be used, and also that you practice looking at what your camera looks like, where your camera is on your phone, your tablet, your laptop. So it's quite easy when you've got faces on a screen that your eye contact drops down. And let's say now, I hope I've been trying to make eye contact with you. I'm mindful of where my camera is, and I'm still not wonderful at it, but I'm better than I was 12 months ago. And you're drawn as a human to the face on the screen. But if you're then talking to that person, which is what I'm trying to demonstrate to you now, the connection of eye contact that you would naturally have face to face in the room is lost. So these are really kind of practical things that just help you get that competitive advantage. The backdrop behind you, making sure it's professional. And a quick example was at some point last year, we had some interviews happening. One of the individuals hadn't used Teams before. The interview was going to be on Teams, and they had to do a 10-minute presentation with slides. So at some unearthly hour of the morning, because it was good for my diary and this individual's, there we were in the dark doing this session on Teams, and he was practicing sharing and unsharing the slides and getting comfortable with that technology for his interview. So there's just an example of things that you can do to help yourself. Practice where your camera is with friends or family. Think about your backdrop, and then do everything else that you would have done previously for interview. And last bit on social media. I often get asked, if we can move on just past that one and then to the next slide, thank you. I often get asked what's the difference between your CV and social media profile. And you do have to kind of ask these days which one your recruiter is going to assess first, your CV or your LinkedIn profile. That depends on how you apply for a job, right? So if your initial job application didn't require you to submit a CV, so you might be using something like LinkedIn Easy Apply, then your recruiter will search for you on LinkedIn first. However, on the other hand, if you register with a recruiter or apply for a job using your CV, whether that's through a job board, a recruitment website, or directly with the organisation, it's going to be a CV that's looked at first. But the main thing for me is how you kind of stand out on LinkedIn. And again, lots of different content on this, but having that photograph, having a compelling headline that accurately reflects what you do. So making sure your skills and experience are up to date, but it doesn't have to be an absolute mirror of your CV, that you've got endorsements and recommendations from other professionals in your network. And the beauty of LinkedIn is that you can make it interactive. You can attach videos, you can attach projects you're currently working on. You can really kind of showcase who you are, and get involved with things like forum discussions as well. So it's much more interactive. Right, about to close. So hopefully that's been a useful insight into hot topics I get asked about in my job every day, which is where I've sort of chosen to share with you, by employers, by students, by job seekers. But if you need more info, we've got a whole host of content on hayes.co.uk. What you can see on the screen in front of you is actually for job seekers, but there's a great section for employers too as well, with how to do remote interviews well and make your interviewee feel comfortable, and tips on how to onboard remotely too. And as I mentioned, if you follow the Hayes UK page on LinkedIn. Finally, my contact details, feel free to reach out to me. Connect on LinkedIn. I share quite a few articles and blogs and events that we're doing on there. So thank you for listening. I'll hand back to Neil to see if we have got some time for any Q&A for a few minutes.
Fantastic. I'm gonna leave your contact details up there actually, so
Sure,
people can just jot them
yep.
down. Thank you so much. I love it when our events are packed with kind of like practical tips and takeaways for people. And these are really accessible for kind of like our students, but also the rest of us. One thing I'm like really keen to kind of like elaborate on is like those soft skills and transferable skills. I know at LSBU that's something we really bring into our courses, but our employability teams are something as well. How would you if people kind of like are not at university and
Yep.
they kind of like they're kind of in the world of work and they want to develop those soft skills, how can they go about kind of like learning them at a later age?
Well, I think there's going to be a big shift on this, and emphasis to a responsible employer, and the fact that they're needing to obviously help people with these skills, because we're talking about what's needed at entry level in many respects, and digitalization. But there's a whole workforce out there that, like myself, needing to work in this environment. And the things I've learned in the last 12 months and around remote interviews and things is probably a classic example. From a practical level, the wonderful thing is everything is on the World Wide Web, isn't it? To use quite an old-fashioned term, but you can look up person and job specifications online for the job you want next and the job you think you want after that. And that's always my top tip with career planning, and see what people are putting on there and how that's changing. And by being on today, you're doing part of that, aren't you, to keep yourself up to date with what you think's needed. Obviously there's lots of courses through training providers, through universities that you can do, and actually we're constantly developing. I mentioned Hayes Thrive, which is something that if you're an employer on today, do contact me if you're interested in that, because it's actually free training and content that we can provide to your organization, with a core element of free contact for 12 months actually, that you can make accessible to your employees, and upskilling in various key areas. There's kind of courses and elements on things like well-being as well. So talk to your employer as well. I've worked out this is where I want to go. You're having that open communication about your career plan. They're aware where you want to go, so hopefully you'll get someone to sort of sponsor you through that move. These are the skills I think I'm really good at. Do you agree? Yes. These are the ones I need more help with. What's available to me? Who could mentor me? How can I do this within my organization? It's proactive, great conversation that shows that you're committed, that you want to stay, and that you want to develop.
Thank you. Alex asks how to get an entry-level role in accounts when everyone is working from home and therefore training is very difficult, impossible. And I know you kind of showcased that it's not impossible, but it might be difficult for some people.
Yeah, I think that, being really honest, it's where organisations, including the leadership team here at Hayes, it's where we're having to work really hard and use our creativity to work out how we give the best experience when we do need to hire trainee roles in whatever that might be: trainee finance, marketing, salespeople. So most organisations are grappling with this now. Organisations, the accounting firms where there's a really structured training program are probably better at that already than people like us at Hayes. I'll be really honest. I'm now looking to the left, Neil, because my camera's moved over to the left and I need to look at my camera. So I need to practice what I preach. So I think organisations are learning very quickly, are putting things in place, and I think whilst it's been a tough 9 to 12 months, and it's definitely had an impact on entry-level roles. I just kind of reassure everyone's trying to get in order on that, because we recognise that people are going to have this plan ready to be able to onboard people remotely for now and ongoing, because whatever happens, we're going to have more of a hybrid way of working in most job roles going forward. So just keep your faith, keep confident, keep looking online, keep building your connections, and just a little bit of time, and I think we'll come out the other side on that.
Thank you. Just off the back of that, hybrid way of working, what would you say to those companies who are going to kind of like try and get people to come back en masse because they haven't seen people for a while and they want people under their roof? What would you say to those companies that might be inclined to do that?
I think I'd say, my advice would be, if you force people's hands, do it kind of at your peril, really, because I'm not saying that employees can call all the shots. It's got to be a two-way communication piece, and there is a solution that will be, I hope, positive for both individuals. And it's not going into battle about this, but the point is, people have had more autonomy over this year in their job roles, in probably every job role than they've had before. And gosh, I would be desperate to go and walk through the door of my local Hayes office right now. I do prefer being in the office. I can hear the conversations, I can pick things up, but and it's different for everyone, but it is about working that through and talking to your employees and working out what the solution will be, and it'll be different for everyone. And as I said, it'll be different for different job roles, different departments, different parts of the business, and certainly from one organization to another. Before we went into this current lockdown, our sort of an interim hybrid working was 1 to 2 days from home and 3 in the office. That was where we were at, and I can't speak for where we'll get to with obviously the board, but it's likely that it'll be something like that for us going forward. But some organisations, just quickly, I know we're sort of coming close to time, Neil, but we're okay, are we? Certainly, the jobs that are coming in and being registered with us every day, and I've noticed it from probably September, October time last year onwards. Obviously, temporary positions and interim roles largely are coming in saying this is fully remote working at the moment, and it can be for the duration of the project. Although, when lockdown does have some easing, it might be that someone could come into the office. But even some permanent roles, some employers are actually putting the stick in the sand and saying this can be 5 days a week from home. And there's finance business partner roles I can think of that have come through in that way. And what they've said is it would be nice if someone kind of either lived near one of our locations, so if they want to kind of walk under the brand banner and come into an office and bring their laptop, they can, and they can talk to people that work for the same organization face to face and sit in the canteen and have a coffee. But equally, they're kind of going, well, as long as someone's prepared to travel to this location, head office, wherever it might be, once every 10 to 14 days, then the rest of it can be done fully from home with how we've equipped ourselves. So what that does to the demographics, it's quite fascinating, mind-boggling, and a little bit scary, but also an opportunity, because not quite frankly, if that was me and someone said, well, our head office is in Nottingham or it's in Bristol, and I live up in the northwest of England, only need to go there once every 10 to 14 days for a day-long commute, or maybe an overnight stay in a B&B, and the rest working from home. If you enjoy working in that way, why wouldn't you do that? So the opportunities that opens up for employers to broaden where they look in their talent pools, and the opportunities it opens up for people looking for that next career role to work for organizations that maybe wouldn't have previously been on the list, on the radar, because they were too far away. Where that goes over the next 2 to 3 years will be fascinating.
It's a bit exciting to see, and as the title of today's suggests, the new normal. So,
yes. Indeed.
Thank you so much for joining us. It's been really, really insightful. I'm sure that everyone who's on the call, student and people far into their careers, have kind of taken on a lot of those practical tips. So thank you so much, Karen. Really good
pleasure.
to see you. Thank you so much.
Thank you for having me.
Thank you. We are ready for our final panel discussion of the day. So I'd like to invite our panelists for this afternoon to join us on screen. For a panel discussion entitled "Have Accountants Risen to the Challenge of the Pandemic or Hidden in Their Bunkers?" And Graham will be moderating our panel today. So Graham, if you'd like to join us as well. Hi there, Mike.
Hi Neil, how are you?
Good, how are you doing?
Yeah, good, thanks.
So Graham, I'm going to hand over to you.
Thank you, Neil. Big thanks to Karen there for a fantastic session. And remember, you can read her advice every month in PQ magazine. She's our agony aunt, and with so much experience, it's great to have her. Hello and good afternoon, everyone. Welcome to the last session of 2021 and beyond, the new normal for the accounting profession. For those who missed me earlier, I'm Graham Hambly. I'm the editor of PQ magazine. Do get your Q&As into us, please, and keep it flowing. And our panelists at some point will endeavour to, hi Ivor, hi Karen. It's great to see you all joining. We're nearly all there. We're just, yeah, are we all here? Yes, I think we are all here. That's fantastic. So do get pop your questions in the Q&A, and that'd be great. I've been writing about accountancy for 36 years. I know it's a terribly long time, and the profession has changed incredibly in that time. I think so much more for the better. We're more connected, we're more digital, and we're a much more transparent profession. Accountants can't hide in those silos anymore, and they have to add value to the figures. Remember, the robots are coming, and so that's going to free you up from your spreadsheets and all those figures. Sorry, everyone. Today's panel are, in no particular order, maybe I'll go with Mike Day at the top. I don't know if everyone's screen's the same. So it's Mike from Xero, he's the Director of Education there. We've got Ivor down at the bottom from London South Bank Business School. We've got Claire Mannell from CM Bookkeeping and Consultancy Limited. Someone really on the coalface there. Are you in your shed today, Claire?
I'm in my cabin down the end of the garden. This is my office. I had it built 2.5 years ago, pre-COVID.
Fantastic. And last by no means least is Anna Pellin, who is from Rogo, who are real cutting edge providers of lots of tech stuff that are making big changes in education today. So what I'm going to do is ask everyone, I'll start with Anna, if that's all right with you, to just give me a brief introduction about maybe a bit about yourself, and then how the pandemic has been for you, the company, and just your general thoughts about accountancy and the world in general.
Yeah, no problem. My name's Anna Phelan. I'm the product manager of Rogo at Eintech. Rogo is an e-assessment and e-learning platform, and many of you on the call may have actually used it. We're quite prominent in the accountancy learning and training space, along with the assessment space. So if you've taken an accountancy exam or you've prepared for one, the likelihood is that you've used our software. So I mean, the space has changed massively for us. We're in a situation now where a lot of the awarding bodies have digitized in a way that, you know, they wouldn't have needed to previously. It's really necessitated that growth and move towards more digital kind of offerings. And what we're finding is that a lot of these providers have moved towards remote invigilation. And for everybody on the call, remote invigilation is basically where you're invigilated through a camera, so through a screen, and you know, you're checked for cheating and all that sort of stuff. And what that means is that students don't have to go to a test center anymore. They don't have to, you know, expose themselves to coronavirus or any worry like that. And a lot of the organizations are choosing to keep this past COVID. So it's a great time for movement in the space when it comes to technology, I would say.
That's great, thanks Anna. And Claire, I'm going to come to you next. You're on the coalface. You're dealing with clients, you're dealing with businesses, you're seeing the effects of maybe when the Chancellor makes an announcement about grants and budgets. You're the person that's going to have to make sure that the people fill out the forms right and do their due diligence. So what's it been like this last year? It's been a year. What's this last year been like for you on the coalface?
Okay, well, thanks ever so much for inviting me. It's really great to be here. And as Graham said, I run well, as you can tell from the title of my business, I run a bookkeeping practice, and we merge into some accountancy as well. I work primarily with small businesses and micro entities across a range of industries, and I try to work locally. I'm based out in Surbiton, just outside London. But I have had a few clients in London, which the reason I say that is because actually that's one of my most significant changes. I've actually lost those clients in London because they've had to close their doors. They were also some of my biggest clients, but one of the great things, despite that, you know, every cloud has a silver lining. is that I've been able to pick up a few smaller businesses locally, which was always my intention over time, and that's just been expedited. But on a practical level, yes, can you believe it's nearly a year since the Chancellor got on the TV and started spouting out about all these amazing schemes I remember it being a Friday, late afternoon, and straight away I had to get an email out to my clients saying, don't fire anyone. On that Wednesday, I had sent out for one client 30 P45s because they were just having to make everyone redundant because the bottom had dropped out of their business. They were a bar and sort of bowling alley type club over in Shoreditch, and literally the city had emptied, and nobody was coming in, and they were P45ing, and I was sitting here at my laptop on the Wednesday afternoon in absolute floods of tears sending out P45s. It was heart-wrenching. And then on the Friday afternoon, I was kind of going back to him going, we're reverting these P45s, you're going to claim furlough. And that hasn't stopped for 12 months. Whenever you think it's getting a little bit better, you have a few less furlough claims. For want of a better word, they're obviously not called that. They're the coronavirus job retention scheme. And but sadly in January, that number went back up with businesses, again, shutting their doors while we're all in lockdown. So for me, that's been one of the biggest parts of the job. And as you said, then there's grants. Most of those have been fairly automatic, actually. A few clients have applied for Arts Council type grants, and that's needed a bit more in-depth information. And then just quite a lot of hand-holding through legislation, through cash flow, through loan applications, and constantly evolving and changing. And at the same time, still needing to do the day job of running payrolls, VAT returns, and bank reconciliations and all those other lovely bits we do. Thank heavens for automation, because actually if we were manually doing a lot of that day-to-day grassroots work plus all this stuff, it wouldn't be very doable, really. It'd be even more stressful. So yeah, so that's a bit of a brief introduction to where I've been at for the last 12 months, certainly.
No, that's fantastic insight. Mike, we talked about automation. Maybe we should give you a go then. How's it been for Xero?
Yeah, well, from an internal operations point of view, we run everything on cloud. Literally everything we touch is cloud, and so you'd expect us to be pretty good at this online stuff, and we are. It hasn't really affected us internally in our operations that much. The switch to home working was relatively painless for us, but that's not to say that being able to connect a computer to work is everything that this is about, as we're probably going to be talking about for the hour. The whole thing around well-being, the communications, just the human factor. It's not easy, definitely not easy. So we've tried to really emphasize that it really is okay not to be okay. That's really been one of the main communications within Xero internally. But operationally, we haven't really hit any hurdles or missed a beat. Obviously, from our customers' point of view, and that's small business and also our partners, bookkeepers and accountants, different story altogether. So we've been obviously very mindful about that. That's been our focus in terms of, as Claire was saying, that's a very real situation. On a Friday, 30 people were going to be fired. And so that's really been our focus. But day to day, being able to work from home as an organisation, we've got 3,500 people. We've been okay.
Okay. And Ivor, what about the academic university field? What's that been like? Because you've had to work quickly to make things work, really.
Indeed. Yes, just a little bit of background about myself. My name's Ivor Pingy. I'm a chartered accountant. I'm a senior lecturer in accounting and finance at London South Bank University, but I'm also in practice. I'm also a senior partner in a local accountancy firm. So I very much mirror, in fact, what Claire was saying as far as my practice is concerned. And my role there has been very much helping with government grants and so forth, and checking the self-employed grants. And interestingly, some of my clients have actually done quite well in this situation. Some are enlarging their practices, whereas some are in a very difficult position indeed. And a lot of my time has been spent around business consultancy. As far as the university is concerned, yes, a bit of a roller coaster in terms of having to shift from face-to-face to going straight onto online. And luckily, we were able to do that quite seamlessly. And the experience has been the best that we can provide for the students. And then we went in line with the government regulations around being able to meet. We then had a blended learning situation where students could either stay remote fully, or they could come in for some days, and we started doing that. And I actually enjoyed that, actually having that contact, albeit socially distanced and so forth. And I really enjoyed that. But now we're back to completely online. In fact, I gave a session today to the students. And yes, it's challenging, but we're getting through it. And I think this whole idea of new normal is quite an interesting one. And I go back to one of the previous speakers actually that was talking about the DNA of a finance professional. And as I was looking at the slide, I was actually ticking off each of the ones that I'm actually making use of now. So yes, challenging, but enjoyable. Yeah.
And I suppose the title of this panel discussion is have accountants had a good pandemic? It was in its very nature, we wanted to be slightly provocative. So Claire, can I come to you? And then Anna, I'll come to you afterwards. But Claire, do you think accountants have had a good pandemic?
I can only really talk from first-hand experience because I haven't really had time to go out. A, there hasn't been networking. B, I've struggled to have time and to be in contact with many people. But from a personal experience, my practice has had a good pandemic, actually. In fact, my revenue has increased over the last 12 months, which is incredible. And I haven't charged for additional services to do with the pandemic. So my business has just naturally grown. And I've guided my clients through different things. And as I say, just not charged because I've felt that some of the services I offered weren't required anymore, or temporarily. So I filled the time with giving different services. And with that, we've grown somewhat. And I think it's really interesting what Ivor said, because he was saying about some clients have thrived, and actually it made me remember I've got a chap who runs an outdoor cafe in Kingston along the river, and he has had his business for 4 years now, but for the first 3 years he's made the most astronomical losses you would believe. And in the last 12 months, because it's an outdoor cafe, he's been able to open, and because everybody is outdoors, walking, exercising, seeing their friends, whatever it is, he's had a bumper year, and he's wiped off half his losses in a year, which is incredible. So that kind of goes back to specific clients, but I just think there's great stories to be told. There's some really sad stories that are going to come out of this. There's some really amazing stories about how people have diversified. I've got a couple of pubs as well that I look after, and they've had to diversify just to break even, because although the government's helping with furlough schemes, they've still got national insurance and pension commitments to make to some of these for payrolls. And I think accountants are coming out well, because I think I have to swear my allegiances to zero. I am a zero practitioner, and the reason I'm saying that is because actually I went to one of their amazing conferences a couple of years, and they had a chap called, is it Gerd Leonhardt, who talked about automation, and it kind of really revolutionized what I was trying to do in my practice. And I think most accountants and bookkeepers are trying to move to automation, because actually we've all got pretty good brains. We don't want to be manually inputting invoices. I've got a client that generates 500 purchase invoices a month. My time's far too valuable and expensive to be putting input invoices. So I'm a real believer in automation. And I think anyone that was worried about going that route is starting to realise there's just as much work out there as an advisor, and people still want to talk to a human, even if there's a screen between them. So personally, yeah, CEM's had an amazing 12 months, tough, hard work, stressful, brain dead most days. I suspect most accountants would say the same. But out of it, I think we've already, where perhaps we've had to quickly advance where we might have been going in the next 5 to 10 years to now. And I think the advice route and the trusted advisor that people talk about has become imperative. And we've found the niche much quicker than perhaps people thought we would as accountants. So
fantastic, thanks, Claire. And Anna, do you think accountants have had a good pandemic?
Well, I suppose I'd mirror what Claire said in that it's very much dependent on the accountant. But overall for the profession, I would say that yes, it's been a catalyst for huge change that needed to happen and was on its way to happening, but albeit over a longer period of time. So what we've seen is a lot of digitization. Even the kind of facilitation of this learning online is going to mean that it's far more accessible for all sorts of different people in the future. So that can only be a good thing. And then the way in which accountancy services are actually offered or procured may change as well, because it's no longer dependent on location. You could, if you want to pick a bookkeeper in the Highlands of Scotland that has a particular, experience that you might like, you're free to do that and you'll get a similar service as you would one in London. So there is that kind of change there as well. So yeah, overall, individually, very dependent on circumstances, and obviously it's been devastating for so many people, but as a whole, really a good move forward when it comes to change.
And Ivor, do you think accountants have had a good pandemic?
Well, from a practice perspective, I would echo very much what Claire has said. As an academic, I'm telling my students that the role of an accounting professional and the role of a finance professional is very much around problem solving, very much around business strategy, very much around those skills to be able to deal with change. Because I think one of the things that is coming out of the pandemic is the fact that we have to be adaptable. Adaptability, I think, is going to be key moving forward. And I think as accountants, the skill set that we have, it's not just about creating a lovely set of accounts. It's about being able to interpret them, being able to talk about the strategy going forward, but also dealing with economic turmoils and being aware of how we as accountants can actually assist our clients in that direction. And as an academic, I think it falls on our shoulders to actually train the future accountants to be adaptable individuals and adaptable professionals, adaptable from the way they work to what they're actually doing. So I think adaptability is key.
Okay, and Mike, finally, you've got all those people using your products, but do you think accountants have had a good pandemic?
Yeah, I know you've chosen the word good on purpose.
Of course.
Because I shouldn't really separate work life from home life. So I think it's a tricky word, good, I think, in this context. But certainly, even before the pandemic, we surveyed all of our accounting and bookkeeping partners and all of our customers. And pre-pandemic, when we ask our customers who's the most trusted advisor out of everyone they get advice from, it's the accountant. So I think the word good is relevant in terms of, I think we're just going to see that go from strength and strength to strength. If it was like that pre-pandemic, I think it's just going to be amplified massively over this next year and a couple of years. So I think that it's good in that way. We've also done some case studies and some blogs with quite a few accountants over this period. And there was definitely a massive movement. Probably more change in a year than in 5, maybe even 10 years. It's that extreme, really. And then the adoption of cloud and adoption of technologies at a really high rate of pace. cash flow management being one of the obvious, debt chasing, analytics. All of these things have really been implemented, and especially migration from desktop. So there's been definitely some goodness, that's for sure, over the period.
That's great. One of the things I'm particularly interested in what you've got to say about this Anna, is how well the professional bodies have been doing. For me, being the editor of PQ magazine, I've had to look at when the pandemic hit, sort of all the exam centres were shut. We moved to remote invigilation, and some bodies did it better than others. Some were able to cope better, but it's radically changed the way that people are learning. It's radically changed the way that people are examined. How well do you think the profession, employers, trainers have coped with that change?
I think it's been exceptional. The awarding bodies have done an incredible job, considering that some of them were paper-based before all of this began. So not only do they have to deal with the change that comes with the remote invigilation piece, but they have to put their assessments online. A lot of awarding bodies already had their assessments. Well, some already had them online, but you went to a test center and did it. So it was through a computer, whereas, as some of the awarding bodies that we worked were completely paper-based. And so in a matter of weeks, they had to have all of their assessments online. They had to feed in all that information about learning outcomes. They had to make sure that, all of their questions in their banks were weighted accordingly. They had to go through the QA process, get that all up. And then they had to go through the process of having these exams remote invigilated and dealing with, students who had never used this technology before. We're just on the forefront of this technology. It had been used in the past in, very particular circumstances. Maybe somebody has a special dispensation or something like that, but not on such a large scale for high stakes exams. So you're dealing with hundreds of people at a time that are all using the same exam. And a lot of lessons learned, I think, from a lot of the awarding bodies, a lot when it comes to documentation, that sort of thing, just making sure that, you're being as clear as possible, because what we're seeing is there's such a variance in technical adoption. Like, there's some people that can email, there's some people that can't email. There's certain things that I've seen that I'm quite surprised by. So, that's a lot for them to consider and think about, when previously, maybe they just, it had already, the pathway to delivery was already sorted out. They knew what a test center was, they knew what the issues were, and they were, few and far between. They understood that, and there was no reason to change it. They really took the, they knew that they had to digitize. So there was, these boards, these committees to talk about it, maybe like a little bit of discovery. But they really previously, could be seen as taking the, the idea that if it's not broke, you don't fix it. But then it did break, and they did need to fix it. And I think they did an amazing job. And it's the same with the training providers and the employers as well. Very important for the employers to have like a constant stream of qualified people to fuel their services. So they need that accreditation to continue to happen. And the training providers need to continue to, train the students in order to do the exam. So it's that ecosystem that needed to tick away, and it needed to become digital, or wholly digital, because a lot of it was blended before, a Moodle type platform, and then online, classroom learning and things like that. But it needed to be wholly digital in a matter of weeks. And I know there was reports of certain things that did happen with certain technologies, but I think lessons learned by the industry, and coming out stronger than ever, really. So very impressed.
Yeah, me too. I've been very impressed with how they've coped. And CIMA for March, it took them 7 weeks to have all their exams remotely invigilated. Either from the university's point of view, that you've got the learning, and now you're going to have the exams remotely. That's new for you too, isn't it?
Yes, completely. From a situation where students would sit and take their exam under full invigilation for 3 hours, we went to a situation where they were able to do it remotely and submit. So yes, quite challenging. And looking back, I think I'm amazed at how well we coped. We're talking about, and looking at your comment about a good pandemic, I think that there's nothing good about the pandemic, of course there isn't. But looking at the way that we've moved forward from the digital perspective and from the way that we've adapted in such a good way, in that way, I think it's been good, yes.
And Claire, I know the ICB had all their exams remotely invigilated weeks, actually. I think they beat SEMA. I think they were the first to go totally remote invigilated exams. Have you sat any with them recently?
No, I haven't. I hate exams. Why did I get into this profession? So I did what I thought were my last exams a couple of years ago so that I could do micro-entity accounts, but actually they've upgraded the syllabus. So it is something I need to try and explore this year. But so I haven't actually taken any exams, and I'm a little bit out of touch with the education system. But I do have students that come to our Surrey branch of bookkeepers that are, ploughing on through their exams. So something's working, which is great and really exciting.
Yeah, they are working.
Yeah.
And I know, Mike, you have you have zero accreditation. You have lots of stuff going on with you, so people are always online trying to get that. I think we're working with you to offer that free accreditation with zero. That's PQ Magazine, of course. So how's that all been working? Has it been very popular?
Yes, it has. So there's a number of certifications and badges that you can do with zero. And it's been very popular. It's that anytime, any place, anywhere, any device thing. Again, it's built for that. So yeah, there's been a nice surge on that. It's globally as well as the UK.
Okay, that's good. What I wanted to get to now is perhaps a little bit more about the actual pandemic and think about how it's changed the way we've worked. If I can come straight back to you, Mike, and talk about how you think, perhaps you can use some personal experience here, sort of how have you changed, and also how you think maybe the role of accountants will change, and whole working from home stuff. I'd like to know from all of you whether you enjoy work from home. Obviously, Claire's got her own shed in the back garden, so so she obviously loves it. But sort of give me some little bit of personal insight also, and any sort of any ideas that you think that might help people who might be struggling at the moment. Mike, can I start with you?
Yeah, of course. Yeah. Yes, from a personal point of view, it's been a mixed bag really for me. There's been, excuse me, there's been some elements of it that I've really enjoyed. I do enjoy the flexibility of home working as well as office working. Our CEO, Steve Amos, has already said that as far as he's concerned, the big word is and. He thinks that we're going to be in an environment where it's home working and office working. So I enjoyed that. I like that flexibility. On the other hand, the Groundhog Day, excuse me. This also helps as well because it's gin. So that's
yeah, absolutely. It's about that time for everyone. Don't worry.
The Groundhog Day I haven't liked. My role is usually jam-packed full of diversity, going out to see universities and training providers and colleges. I love all that. I love all the face-to-face and human aspects of my role, and it's all been replaced by Zoom. So I'm on my 14,000th Zoom call or whatever it is by now, and it's I don't enjoy that.
I'm sorry about that, Mike, but you are on Zoom now. You do know that, yeah.
Yeah, 14,001. Yeah, and I don't know about everyone else on the panel, but it's very, very tiring. I think there's some academic papers coming out as to why it's so tiring, but it certainly is tiring. It's also that kind of always on aspect of this. You're always accessible, you're always on, you're always available. So it's been a mixture. There's been some real pros and home time with the family. And in terms of any advice to anyone, the biggest thing for me has always been getting away from this screen. And usually that means dog walking. And literally getting away has been the most important thing. At the start of it all, I did the usual thing. I just ploughed on, and it was just a mistake. I don't do that anymore. It just, it definitely impacted my health. So I have a regime where I definitely get away at certain times, and it's in my calendar. And everyone at Zero understands that, and everyone respects it.
That's good. No, I think that's really important. How about you, Claire? How have you coped with it all, and sort of looking at how you may, sort of how you think you might change practices and things like that, how you see the future? I suppose you're working from home anyway, aren't you? You've experienced this before any of us.
Because I set my practice up coming up 7 years ago with the idea to work more from home. I'm not married and I haven't got a family. It was just more, I got fed up with commuting. I used to teach at a college in London, and I was commuting in, same journey for 13 years. And I used to have that little feeling of Groundhog Day. Oh God, I've got to do this walk once more. So yeah, some of it was a lifestyle choice to just work from home. And I used to work out of the little box room in my house, and the walls just started closing in on me. And I had a very horrible garage down the end of my garden. So I had it knocked down and had this built instead, coming up 3 years ago. So way before everyone was talking, and apparently the price of these buildings has now rocketed to about twice what it used to be pre-pandemic. And you can't get one for love nor money because everybody wants a building in their garden. So I preempted. I feel quite proud of myself. I'm normally a follower, not a leader. So I've always worked from home quite a bit, and really 4 days a week, sometimes a bit more, sometimes a bit less. And I was going out to clients here and there, going up to town just occasionally. So, and the commute was always a little bit different because it depended where the client was located. So, but it's taken me 10 months to use the phrase Groundhog Day. And it was only because my brother said it the other week, I was suddenly, that's what it is. It's that repetition. And it sounded really silly. I got fed up of unloading the dishwasher every single day. Even though it's just me, because you cook all your meals at home, you're not going out at all, you're not seeing friends, you're not. And so for me, where I'd perhaps always been more work from home anyway, the bit I miss is seeing my clients in person. And I think the future is a blended approach. I sound like a teacher at this point, where that Mike was saying, part in, part out. So I can't wait for the day I can go around to my clients again and just sit and have a good conversation with them, and then come back and do some of their work. And equally, I like the time in my office, particularly in the summer. It looks out on my garden, and it's last year it was so hot. It was wonderful. But I do think that's going to be the way forward for most people, actually. My worry is on the slightly economic front of most of our pension funds, if we've got them, are probably investing in properties in London that rely on rent. So we might see the bottom drop out of our pension funds while these people decide to work from home. But for me, it's been about finding balance. And as I say, despite the fact of Groundhog Day and everything else, I still think I would just sit here and work and work and work. I would take my weekends off, look after my mum who lives very close by. We had a bubble before they talked about bubbles. And that's still very much the case, but now I'm just trying to get a bit of time out each day to go for a walk. Although yesterday I was told I should be walking 18,000 steps a day. That I have got quite long legs, but it would still take me 2 hours, and I don't physically have that time to give to it. But it's about getting out and about and getting some air, and it's grey and it's miserable. I've got my sad lamp now to try and help me get through winter. But it is just getting that balance, definitely. And I think people are prioritizing. I think we used to be a nation that we lived to work. And I think we will still be a highly productive nation even after COVID. But actually, I think we will also find a bit better work-life balance and time with families, if you have them, quality time spent with children. One of the things I love seeing when I go out for a walk is seeing, dads and their children, which you never used to see. And I just think that's speeding up that role change that was always happening anoway. But I think we're all learning new priorities and what's important to us. So.
Okay, and how about you? How you see the future? How do you keep sane and safe? How's that all going?
As Claire said, I'd say that most businesses are going to have a blended approach now. They see that productivity is up, and with people working from home, they can see that they can trust their employees to have agency and not, they don't need to monitor them all the time. So definitely see that being the way forward. For us at Eintech, it was a relatively easy transition because, we're a software company and we already had a lot of the facilities in place to interact online. We were already doing that, probably very similar to Mike's company. So that was actually fine. Myself personally, I suppose it's the same as the guys. It's making sure that you get out every day and making sure that you log off. It's super important to step away from your desk at a certain time and stick to that time. And yeah, just exercise, things like that really helps. And spending time, or even if you can't physically spend time with the people you love, like making sure that you stay in contact with them, things like that, super important. And just, as Mike said, it's okay not to be okay. So reaching out if you ever feel in any way blue or anything like that, I think it's super important. Yeah.
Okay, and Ivor, how do you see how you working? How just a little bit about the future and how do you see yourself keeping sane?
Yeah, I really, really miss my colleagues and the students at LSBU. I mean, LSBU, I think Sarah mentioned in her introduction that we're a family, and we just love being with each other. So not seeing the students, not seeing my colleagues. I mean, for a brief time when we were able to go in, I remember there was a time when I was standing there and another colleague came. We're both in our masks, and it was actually Sarah Abdullah, and she was like, and she started doing this, and we wanted to hug each other, but we couldn't, and we were so excited to see each other. And it was so great seeing the students and so forth. But I'm really looking forward to going back to that. I'm really looking forward to that. In terms of working from home, I echo what Mike has said. I mean, the work-life balance can be quite challenging, and there have been times when I've literally spent 14, 15 hours in this room, and it's a very nice room and all that, but getting out. So I've done some practical things. I now have a bike, and I'm actually a car person. I'm actually a car person, but I realized I wasn't getting much exercise going out in the car. So I bought a bike, and every week we've sort of created a bubble locally, and we go cycling. I've cycled from where I live in Southeast London all the way down the river to Tower Bridge and so forth. So I am trying to keep fit in that way. And also another practical thing that I've done is to have a meditation app on my phone, which sends me motivational messages every so often. And some of them are just great, in terms of getting you through the day and letting you think about that it's not all bad, because sometimes when you look at the news, and that's another thing I've stopped doing, I normally would watch the news constantly, and I was getting fed this negative energy coming through. So I've stopped doing that, and I will listen to music. I will go into the garden. So I'm taking some very practical steps, and I would really recommend that to people, that you take practical steps. You take time out. As Mike said, you actually take that time out. You spend time with family. You do something different to looking at a computer screen. Yeah, so that's what I do. But I miss the students. I miss my colleagues. And yes, I see them on the computer screen, but it's great to be able to speak with them and have a great laugh with them. I really miss that.
Yeah, that's really sound advice. You do need to look after you. I think that's a very, very important thing, especially at this time. Getting back to more sort of more accountancy based things, we've got a budget coming up in March. Mr. Sunak will be in charge of that. I'm sure it's going to be very interesting. What are you hoping for he's going to do for UK PLC? So we, sort of, which will help you in your work, maybe help you with software, Mike, will help you how do you see it's going to be quite it's going to be quite a big fundamental announcement. It's how long we've got to, how much more money he's going to put into extending the furlough, how much money he's going to put into trying to build the infrastructure and spend. I don't know if anyone listened to Richard Murphy's piece about we don't have to worry about the tax, which was great news for everyone. If you missed that earlier, just go back to Professor Richard Murphy's piece just before lunch, and he says it doesn't matter. We don't have to worry about all the money they spent because we've already paid for it. So that's great news, and I'm going to take him at his word. So I suppose I could ask you, if you were going to be the Chancellor, what things would help you? What things you think would help accountants do their job better? Maybe Claire and Mike, what? So I'll go back with Ivor. I'll start with you first, just to try and to make it all fair, that people, give you time to think, Claire.
I think I'm going to put my political hat on for a bit and say that there is a lot of inequality that is coming to the fore. And I think if I was the Chancellor, I would want to invest in removing that inequality, particularly around school children and their accessibility to learning. I would certainly want to look at that. I would also want to look at getting the economy moving again in a way that is fairer to everyone. There have been certain sectors, I think, that have missed out, and I think that that would certainly need to be looked at. As an accountant, I can see many opportunities moving forward. I think that one of the things that we are very good at doing is being able to look for opportunities, look for business opportunities, strategic development of businesses. And also, as one of my specialisms is accounting theory. And there are other ways of preparing a set of accounts that make businesses more accountable and adaptable. And I think I would like us to be looking at that. So looking at the COCOA, for example, the capacity to adapt rather than just the figures, because we can see that in this dreadful time that we're in, those that couldn't make the numbers failed, even though they were good companies. Whereas if we could account for, and I know this is a little bit controversial, I suppose, in terms of saying, look, why don't we just have a fresh look at what we're actually accounting for? And as an academic, that would be one of the things I would ask the Chancellor to do. Let's have a root and branch examination of companies and the way that they account for the things that they do, as well as looking at social and environmental accounting. I think that should be a part and parcel of what we are doing moving forward, because there are so many elements that we don't really take into account that now I think we should. People, planet, and profits. People first, planet next, profit last, I think has to be one of the things. And I'm going back to last year's conference, that accountants can save the planet.
Okay, Anna, and what do you think? If you could be Chancellor for the day and change the world, and what sort of things would you be looking to do?
Well, it's beautiful what Ivor just said. Yeah, here on that. Yeah, people first. Definitely. I mean, I think kind of a more immediately, perhaps some sort of incentives again for the hospitality sector, tourism sector. It's such a a beautiful thing that we have, and I wouldn't want it to be eroded in any way. And I think it's so important for the economy and also just culturally. All of the great institutions that are here in Britain really need to be protected in whatever way they can be. So for me, yeah, it would be that. And of course, yeah, people, as Ivor said, investing in youth and making sure that, there's less of that inequality there, because we're missing out on, great opportunities for people that, are so intelligent and could have so much to offer to our economy, and they're not being, supported in the way that they should be. So definitely that if we bring certain people up, we'll bring us all up. And I think that would be the way forward for sure.
Okay. And Mike, what are you thinking? What you're hoping for come March and looking forward?
Well, I'm definitely hoping for recognition of just how important SMEs are for the UK economy. 6 million of them, and 99% of all businesses are SMEs. So really, I'd be looking for recognition of that, and also recognition of the role that digital skills and digital technology is going to play in this recovery. So I'd love to see SMEs getting some sort of grants from the government. Obviously, there isn't an endless pot of money, and this is such a, can you imagine some of the decisions that are having to go on here? It's just mind-boggling. But I do think UK PLC can come out of this if there's that focus on SMEs, and if there's focus on the SMEs getting investment in both digital technologies and digital skills agenda.
And what about you, Claire?
Well, interesting. I think Ivan's thoughts are lovely, actually, and I think it's a tricky one. I sit on the fence a little bit. I mean, we are ploughing money in, basically printing money on a daily basis, ploughing into the economy, and there are businesses that need it. I originally trained in hospitality, and you know, they're on their knees. They are going to need all the help they can get to get themselves back up and running, and it's going to be a killer. So I do think we're going to see an extension of the furlough. I don't think he's going to take the risk of putting any taxes up at the moment, politically, manifestos, all that sort of thing. But I think we have to be realistic that in time that will happen, and it might come kind of through the back door. It might not be really obvious. It'll be on the little bits where you get some enhancements through, you know, perhaps at the moment you don't pay tax on pension, you know, pension contributions come out before tax, and all sorts of things. I think some of those are going to change over time. I think we have to be realistic. But what Mike said was very much in some of my notes, actually, pre discussion, that it has to be about small enterprise and entrepreneurship. You know, they're small, they're agile, they work hard, they've got great ethos, great ideas. You know, entrepreneurship has always been the UK's biggest skill to promote. I look back to as a teenager in the 80s, and you know what Michael Heseltine did for trade and industry, and the grants he pumped in so that people like Richard Branson could make their name, and you know, and subsequently so many others. And I just think that it's not about tax, it's not about, you know, constant giveaways and grants and goodness knows what. There's got to be a time when we stand on our own 2 feet. I would like to see the Chancellor give a little bit more respect to the small business owners. He made a little slip up back in March last year and implied that all directors are tax dodgers, and we're not. And most small business directors have been absolutely hammered by the schemes in place and not been able to make any sort of financial claim. And they're not tax dodgers, they're just trying to be efficient, and they're not making that many savings a year because HMRC is already pretty clever and got it sussed. But it's meant that there's been very little financial give to directors. You know, their employees have been okay, their business in itself has been okay-ish, but you know, to the director, you know, like myself, if I needed to, I might have been moving out of my home by now, because he just badly worded a phrase back in March that I've not quite forgiven him yet for, although I think he's done some remarkable stuff subsequently. Yeah, and I think that not so much a budget prediction, but HMRC, I don't know how they built that website in the speed they did to do furlough claims, and it did not fail. I think 1 quarter of an hour session in the first afternoon it was launched. Other than that, it's never failed. But I do think there'll be more digital. I think you'll find self-assessment will quickly go quarterly, and that will help the cash flow for the government and things like that. But that's not particularly a budget area. I just think those are some of my predictions. I think we'll see a lot more tax going digital and that. So yeah, those are my thoughts.
It's going that way anyway. Neil, I wanted to know if we had any questions and answers from our delegates. I thought perhaps it might be, instead of me asking for retrobate's questions, I thought we might, sorry to call you retrobate, would be, but I know one of you definitely is Ivor. I wonder if we had any questions and answers. answers on the question answer board?
We've got a couple in the Q&A box, but we've got lots of questions. We've got lots of comments in the chat box. So we'll do the Q&A box first. Question from Mike. Does Xero offer courses where a certificate is offered at the end of the course? And I believe that's one of our students.
Yes, it does. Yeah, there's a range of them. The most famous is called Xero Advisor Certification, and it's free of charge, and it's an e-learning pack, self-contained, and actually they can do it via PQ Magazine.
From this month?
There you go. PQ Magazine rules.
It does. That's great.
Thank you. Second question, and I don't know what all these letters mean. So, question to panelists: do you believe we should now move from EBITDA? Does that? Yep. Right. Okay. Yep. To EBITDAC with the C being coronavirus.
I saw that on a mug, a kind of meme, way back in about April, and it just made me laugh. And as a bit of a jobbing bookkeeper, I just thought how appropriate. And I think there will be for a while, actually. I think there will be for a while. In my previous life as such, when I was teaching, when I first went into teaching, all the students were doing dissertations around 9/11 and its impact, and it went on and on and on. And in the end, we just used to, after a few years, we just had to go, no more of this discussion of the impact of 9/11. Life is moving on and there are other things out there. But I think in study and I think in research, and I think there's going to be a lot around post-COVID and its economic impact. So I think while, it was a good meme, whatever, however you say that, a few months ago, I think it's a reality that it will be there. It's not something I use a huge amount as a calculation with small businesses, so it might get a little bit lost on them, but they might well talk about it in much more colloquial terms. But yeah, Ivor, you're the academic here, so where do you think?
Come on, Ivor. You answered the question.
I think that it will actually be part and parcel for a while. I think it has to be. I mean, if you think of some of the considerations and advice coming out of IFAC, for example, it's all around the effect of COVID and so forth. So yes, it's going to be around.
And just to say that if anyone wants any more on this, there's actually a feature in the latest PQ magazine on this very subject. So if you just go to our website, which is pqmagazine.com, you'll find a feature which will answer your questions.
Thank you. We have a comment in the chat box. Really good panel discussion. I'm enjoying listening and agree with so many points. Listening to Mike about how he's put that wellbeing time in his calendar. This is something I started towards the end of the year and it worked well. If I get to a week and I've neglected to do so, I don't make up the time. There's a really good tip to have. I think people are really appreciating the extra efforts that's going for wellbeing. Polly says, great panel discussion, especially our ICB member, Claire Manel. Hi, Polly, it's been a while. Samantha says, that's a really valid statement you made, Anna, about it's okay not to be okay.
Mike too, I think, as well. I think.
Cool. I've got another one. Thank you, LSBU PQ Magazine, for a catch-up. Obviously, kind of like it's great to get lots of people together that people know. It's our 4th annual conference, and we are going to be working on the 5th very soon, which is very exciting. That's all we've got coming up in the Q&A box and the chat box. I guess we will bring the conference to a close slightly early if there's nothing else coming through. But just to we touched on this a bit earlier, and I asked Lord Sikka this. We've got a lot of students on the call right now who are kind of like from LSBU and kind of beyond, and it would be really good to kind of like leave them with some inspirational words at a time when probably they could do with a bit of inspiration. So what would you like to share with them?
Okay, who would like to go first? Anna, would you like to go first? You've got the gift of the gab. We'll give you the chance, and while everyone else can think.
So my inspirational wisdom, just don't be too hard on yourself. Keep plodding along, the usual. It'll all be fine in the end. it's not all right, it's not the end, all that sort of stuff. But yeah.
No, that's very true. Yeah.
Yeah, and in terms, sorry, Graham.
So I was just going to say, the days seem very grey, don't they? And I think when the spring comes, the schools will start be opening again. We had a great lunchtime chat with people, with delegates, and one lady called Sarah, her son who's 3, was having a nursery lesson, and we had to find something yellow. We could hear she had to find something yellow, but she had her headphones and she was still attending the conference. And, it's people are just trying to cope, get through, and we will come out. That there's light at the end of the tunnel.
Sarah has just commented in the chat box saying that was me. That Go Find Me is a great Zoom game to play if you're ever looking for a kind of team guilding engagement game. Go Find, and asking someone to go and find their work pass tends to be the most entertaining thing at the moment. Ivor, obviously, kind of you work with students. What would you like to share with your students in terms of?
I would like to say, just keep going. It's going to get better. You're embarking on a great dynamic profession. Hang on in there. That's what I would say. Hang on in there. Look after yourself. You will be great. You will do well.
Fantastic. Claire?
Well, I'm reading a book at the moment. It's a little bit scary and implies that computers are going to take over the world. And one thing that I have learned is that we're in control of the computers. So my kind of words of inspiration are a little bit, don't let the computers take over the world. But actually, more importantly, because I think that accountants and bookkeepers like myself are in an ever-changing environment where people are starting to go, do we need you? If everything's automated, do we need you? They do. Don't forget your personal skills. Don't forget your communication and your personal skills, and develop those just as much as when you're studying for all your exams and all those kind of things. Just remember, we do still communicate with humans, and those skills are going to be even more important because computers can do so much more for us. So yeah, that would be my kind of little inspirational thing to go away and think about. Yeah, developing your communication skills and how you work with people.
Thank you. Mike?
Yeah, I think that's a really good point from Claire, definitely. And although Zero is big into artificial intelligence and machine learning, one of our big sayings is the next big thing isn't AI. The next big thing is people. And that really goes back to what Claire was saying, is that the robots are coming, but actually there's going to be benefits as well as some of those things which some of the novelists like to write about. And if you're involved in financial skills in any way, good for you, because that's the bedrock for all business skills. So I started off as an accountant, but I didn't end up being an accountant. And I don't regret it for a second, because it gave me absolutely foundational skills. Also, accounting is full of technology these days, and it's also sexy. So
well,
accounting has become
we've got to end it on accountancy is sexy. We leave it there, Neil, surely.
Well, I was going to ask Graham if you would also like to share.
Yeah, I mean, actually, tomorrow is Time for Talk Day. I don't know if anyone knows that. It's a mental health initiative, and they're saying and it's talking about the power of small conversations, like a little conversation we've had today. So I think for a lot of students, I think as well, is they may not be getting the sort of experience they thought they were having, but what they need to do is make connections with their fellow students, bring them up, get a bit personal, and have these sort of Zoom calls with people in your class, and try and you can make friends that you're going to have for a lifetime, and the ones you get at university, and it's really important you don't miss out on that, and enhance these guys are so good with the technology. Enhance the technology, don't hide inside your silo with the technology. Use it to reach out to people, reach out to tutors. I mean, those tutors are sitting there bored, you know, they want to chat to you. So, you know, contact your, email your tutor, keep asking them questions, push them, you know, get the money, your money, value for your money that you've paid. And people like Ivor will be there and they'll talk to you. And just try and create the experience you wanted. And it won't be perfect, but, you know, sort of come next year, unless it's your final year, you know, you'll have friends already, and it'll be great to meet them in reality.
Thank you.
That's my advice.
There's lots of really positive quotes. So Vicky says, thanks so much, everyone. Really enjoyed this webinar. My quote for the day: we may not be there yet, but we are closer than we were yesterday. Pedram, this was my first experience at such a conference. It was great. I learned a lot. Big thank you to all involved. Roberta says, BBC Sherlock said, brainy is a new sexy. And Claire said, thank you all, great day, and actually helped listening to you all while working from home, a bit like being back in the office, feeling regenerated now, stay safe and looking forward to the next conference. And Sarah, who's one of our students who comes to a lot of our events, really engaged, says, I find being a student in a pandemic, especially being a first year, I feel like I have to work extra hard to make friends and form friendships with my peers. Which is completely valid, and so, you know, reaching out is important. I think one of the things that we're doing at LSBU is a lot of these events and hopefully creating kind of a warm sharing experience with people. And there's just lots of thank yous, so keep your thank yous coming in. And I think that's pretty much all from me. We will be sending out certificates, and we'll be sending those out probably in the next couple of weeks, along with a recording so that you can catch up with any of the sessions that you missed, and we'll share that with all of our speakers as well. That's it on a logistics point of view. And Graham, I'm going to hand over to you to officially close the conference.
Okay, well, I want to thank all our panelists today. Thank you so much for that real useful advice, and thanks everyone, all the speakers from Tom Scott this morning all the way through to Karen Young. We've had some fantastic speeches. I'm trying to think of all the things that people have been talking about. But chief value officers, we've talked about, I think we've talked about there's a new branch of accountants that's going to be the sustainable social value accountant. We've had Prem doing his thing, talking about audit needs to change, and perhaps we haven't gone far enough with that. We've got Richard, as I said earlier, who's told us we don't have to worry about all the money we've spent because so the taxes won't have to go up. It's been a fantastic day, and I think if you get the chance, do go back. We're going to put everything up on Facebook, aren't we, Neil? And people will have a fantastic opportunity to just go through it again. There's been some really great things. I mean, Mervyn King was just wonderful this morning, talking about how corporate governance needs to change. Extinction accountants still there, sustainability. We've got so many themes that we need to then pick up and take forward to next November. We'd love to see you all back here in November. We'll have a new sexy, obviously sexy is the word now, Mike, thanks for that. We'll have a new sexy accountancy conference ready for you. In fact, we might just say accountancy is the new sexy, Neil. What do you think?
New, brilliant title, brilliant title.
that may be the title of the conference for 2021. Okay, well, thank you panelists again. That's been really useful, really insightful. I'd like to thank all the sponsors as well again. Without them, this wouldn't be possible. And particularly Sarah Moore-Williams, the Dean, for being so clever, knowing that this really works. Sarah for all her work, but mainly for you, Neil. You've done such a great job.
It's a pleasure working with everyone, and it's a team effort, including our attendees. Thanks for bringing the conference to life with your engagement, your questions, and your interest in everything that we're doing. So thank you so much.
So thank you, everyone, and we'll hopefully see you soon.
Okay, thank you.
Thank you.
Bye.
Yes.